your input tax credit chapter. Coverage wise, the most important chapter of your entire indirect taxes. That's the importance of this chapter. Quickly, we'll move to the provisions. Sections and all, it's given in bird's eye view. I'll be just telling the sections exactly when we're discussing the provision. Right. So, here at least have a clarity that when you talk about taking the credit, it's section 16. No credit, block credit, section 17. Proportionate credit is also under section 17. Section 18, ITC in special circumstances. Section 19 is all about your job worker. It has to be read with other sections like section 143, rule 45 and rule 55. And finally, when you're talking about 20 and 21, it talks about your input service distributor. Obviously, there are rules also. So when we see the provisions, correspondingly the rules will also be seen. So initial provision is all here about your section 16. The main provision here are your section 16 and section 17. Only when you read your section 16 and section 17, you can read in this way. This is all normal part. Section 16 and section 17 is the first part, when you can take the credit. And when you talk about section 18, 19, 20 and 21, they are all special cases. The one section is itself named as ITC in special circumstances. 18 will not be applicable for everyone, only if at all you are having manufacturing being done by your job worker. 20 and 21 only if you are having input service distributor registration. So they are all special cases. This is a normal situation and this happens to be your special situations. Now, we'll try to see the definitions quickly. What are the definitions which are there? When you talk about input tax credit, make one thing very clear. Your focus is on your purchases. Purchases. Credit is always on your purchases or expenses or fixed assets, capital goods. So what can be your types of purchases? Inputs, capital goods, input services. So when you talk about inputs and capital goods, both are goods. Inputs means goods which are other than capital goods, and capital goods means goods which are capitalized in your books of accounts. That's it. Inputs is other than capital goods is which are capitalized in your books of accounts. Input service means any service. Whether it is inputs, input service or capital goods, one thing is very common, that they should be used or intended to be used in course or furtherance of business. That is one of the important criteria for taking credit in section 16. It should be used or intended to be used in course or furtherance of business. Now, as I said, the entire focus is on what? Purchases, expenses or fixed assets, which means the focus is on your inward supply. Inward supply means what? Inward supply means receipt of goods or services. Either it can be by way of purchase or acquisition or any other means without consideration. Even if I have got something as gift or free samples. Now I am not talking from the angle of output. I am talking from the angle of input, recipient. I can take the credit. Tata Limited has given me free samples or gifts. If it is paying output tax, I can take the input tax credit. I can take the input tax credit. There is no consideration being paid by me to Tata Limited. But still, if Tata Limited is paying output tax, because it is covered by para 1 of schedule 1, I can take the input tax credit as a recipient. Outward supply definition is repeated, that of supply. It talks about the same thing. Outward supply is nothing but supply of goods or services by way of sale, transfer, disposal, barter, exchange, license, lease, rental, in course of furtherance of business, with or without consideration. Same thing. I am not repeating that. And moreover, the focus is never on outward supply. In this chapter, the focus is only on your. At times, you will be talking about your output tax, but the objective will be input tax credit. The end will be input tax credit. If I am paying output tax, I can take the credit. If I am not paying output tax, I cannot take the credit. I am not trying to discuss about output tax. I am setting a condition for input tax credit. If I pay output tax on my output supply, corresponding input tax credit I can take. If I don't pay output tax on my output supply, corresponding input tax credit cannot be availed. We are not talking about your sales or outward supply. We are discussing about your outward supply to find out the answer for your input tax credit on your inward supply. The focus is only and only on your inward supply. Now, what is input tax? What is your input tax? Input tax can be anything. Input tax is normal tax charged on supply. CGST, SGST or IGST. If supplier is charging CGST, SGST, I will be taking the credit of CGST, SGST. Supplier is charging IGST, I will be taking the credit of IGST. Input tax also includes IGST on import of goods. On customs, on import of goods, I'll be paying BCD plus SWS plus IGST. I cannot take the credit of BCD and SWS. It will be added to the cost, but I'll take the credit of IGST. Input tax also includes tax payable under RCM. RCM tax is paid by recipient. Right? RCM has to be paid by cash in one hand, surely by cash ledger. Immediately, same month, you'll be getting the credit in your credit ledger. So you have to pay by cash, but you'll get the credit in credit ledger. After all, it is your purchase. So RCM tax is not RCM output tax. It is RCM input tax. You pay RCM input tax by cash ledger. Same month, you'll get RCM input tax credit in your credit ledger. So it includes RCM credit. You'll pay by one hand, cash ledger, you'll get the same thing in other hand, credit ledger in the same month. In the same month. But it does not includes or it excludes composition tax. You cannot take the credit of composition tax. Moreover, a composition scheme dealer will not charge tax on his bill of supply. You cannot take the credit of composition tax. Also understand the fact that if I am purchasing from a composition scheme dealer, throughout this chapter, I will be the recipient. If I am purchasing from you, you are a composition scheme dealer. What is the tax that you will be paying? Composition tax. Will you collect it from me? No. You will be giving me bill of supply where you will not collect any tax. So that also you have to understand. So your input tax means CGS, CSGST, IGST. Also IGST on import of goods. Also RCM tax, but it will not include composition tax. These are all your input tax. It is not necessary that you will get the credit on all your input tax. Assume that there are items which are covered by block credit section 105. There is input tax on your food or on your motor vehicles, but you cannot take the credit. When it becomes input tax credit, only if you are able to take the credit of that input tax, it is input tax credit. Input tax is purchase tax. Credit is when you are able to take the credit, it becomes input tax credit. You have supplied me motor vehicle. You have paid output tax, it is input tax for me. If I cannot take the credit, it is not my input tax credit, it is my input tax which becomes the cost. If at all I am able to take the credit, it becomes my input tax credit. If I am eligible, it becomes my, I can have a lot of examples. One is block credit, other is, supposing I am purchasing from you all and you are all charging output tax. It is my input tax. But I don't have any output tax on my output supply. If I don't pay output, I cannot take my credit. So that is input tax, but I cannot take the credit. It is added to my cost. It is added to my cost. And when you talk about input tax credit, there are two steps which you are going to focus on. First step is availment of credit, and the second step is utilization of credit. When you talk about the first step, for availing the credit, you have to satisfy the conditions given in section 16 read along with section rule 37, 37A and 38. You have set rule 36, 37 and 37A. This is section 16. You have to satisfy all the conditions. And once you have availed the credit, one of the conditions to avail the credit is you have to avail the credit in time. There's a time limit to take the credit. Beyond that time, you cannot take the credit. There's a time limit. Whereas, once you take the credit properly, satisfying all the conditions including time limit, you have to utilize the credit in a particular sequence. There is no condition, there is restriction. This credit can be used only for this in particular manner. There's a sequence. There's no condition. You have to use in a particular sequence, restriction. And moreover, once I avail the credit, I can utilize it at any time. I can use it in the same month, next month, 3 months later, 1 year later, 3 years later, 5 years later, 10 years later. There's no time limit for utilization. Time limit is only for availment. No time limit for utilization. This is all explanation for input tax credit. Two-step process. One is availment, second is utilization. And when you talk about a person called as registered person, why we are discussing this definition is, we'll be seeing in the condition that only a registered person can take the credit. So what do you mean by registered person? Only a person who is having GST number as per section 25, he can take the credit. That's the meaning of registered person. That's the meaning or the definition of registered person who is registered under section 25. Only he can take the credit. Now, registered person excludes a person who is having a special number called as UIN. International bodies will have unique identification number. they cannot take any credit. So registered person excludes UIN. In simple language, registered person means a person who's having GSTIN but not UIN. UIN is only by international bodies. So why we are seeing registered person? Because only a registered person can take the input tax credit. Now there's something called a zero rated supply. Why are we seeing the definition of zero rated supply? Because sometime back I said you a concept. If you're paying output tax on your output supply, you can take the input tax credit. If you're not paying output tax on your output supply, you cannot take the, but there's an exception for zero rated supply. Even if you're not paying output tax on your output supply, you can still take input tax credit. Not only that, you can go for refund also. You can go for, so here, that's a normal thumb rule formula. Pay output tax, take input tax credit. You're not paying output tax, no input tax credit. But for zero rated supply, though you're not paying output tax, you can take input tax credit. Not only you can take input tax credit, but also you can apply for refund of that input tax credit based on a particular formula. Right, based on a particular formula, you can apply for refund as well. Normally, you cannot take the refund of input tax credit. Normally, no one can take. There are only two exceptions, out of which one exception is zero rated supply. Zero rated. Now, what is zero rated supply? Zero rated supply is equal to export plus supply to SEZ. That's it. Zero rated supply is equal to export plus supply to special economic zone. SEZ is like foreign territory within India. So when you're talking about zero rated supply, this definition, by the way, is not in your section 2 of your CGST Act. It is taken from your section 16 of your IGST Act. Section 16 of your, needless to say, all the other sections are taken from, definitions are taken from section 2 of CGST Act. But this is section 16 from your IGST Act. Zero rated supply is equal to export of goods or services plus supply to SEZ of goods or services, be it special economic zone unit or developer of special economic zone. For zero rated supply, what is the speciality? Even though you are not paying output tax because you are going under letter of undertaking, even though you are not paying output tax, you can still take the credit. Not only that, you can go for refund. You can go for refund. Now let us focus on the conditions for taking the credit. These are all the definitions relevant for this entire chapter, and we have seen the relevance of each of the definition where it is being used. Now conditions for taking the credit, you have to number it properly and see how many total conditions are there. The sequence would be a bit different from what is given here in the text. Now first condition, only if you are a registered person you can take the credit. If you are not registered, forget about credit. Second condition, you can take the credit only if the goods and services that you have purchased are used or intended to be used in course or furtherance of business. Simple language, business nexus. They are used or intended to be used in course or furtherance of business. So first criteria, registered. Second criteria, business use. Business use. Third criteria, you should be having a proper document. Should be having a proper document. For taking the credit, you have a proper tax paying document. Now what is the tax paying document? Normally it is tax invoice. At times it can be supplementary invoice, which is otherwise called as debit note. So if the supplier is increasing the price and the tax, he'll be giving you a debit note. He'll pay extra output tax, you can take extra input tax credit. These are normal cases. At times it will be self invoice. Self invoice is not in a normal case, it will be in rare case where you are going under RCM and supplier is not registered. It is RCM plus supplier is not registered. Then it is bill of entry when you are talking about import of goods. For import of goods, we will be paying BCD plus SWS plus IGST. You cannot take the credit of BCD plus SWS. You can take the credit of, what is the document? Bill of entry. And if at all you are having multiple registration along with input service distributor for distributing the credit of common input services, head office, which is ISD, will give you the distribute the credit. So what is the credit that will be taken by the branch office, which is distributed by the ISD? What will be the document? Head office invoice, that is ISD invoice. Head office invoice, that is supplier will give invoice to ISD. ISD will give invoice to its branches. Branches, when they are taking the credit, it is based on what? ISD invoice. ISD, always understand that as a recipient, you need not worry whether all the details of tax invoice or debit note or self invoice or bill of entry or ISD invoice should be there. For supplier, they have said that lot of conditions, lot of items should be there on your invoice. But as a recipient, for me to take the credit, what are the details that I should be worried of? I should be worried of what? 5 details. Whether the invoice is having GST number of supplier and recipient. Whether the invoice is having description of goods and services. Whether the invoice is having value of supply. Whether the invoice is having tax. Whether the invoice specifically mentions place of supply if it is interstate supply. I need not worry about all the other details. All I should worry is 5 contents. GST number of supplier, recipient, description, value, tax, and finally place of supply if it is interstate supply. That is the third criteria. Fourth criteria, I should receive the goods and services. I should receive them. For me to take the credit, I should first receive the goods and services. I should receive document as well as receive the goods and services. Obviously, I have to satisfy them together. So it is whichever is later. It is whichever is. If I receive the document on 2nd April, if I receive the goods services on 5th April, I can take credit only on 5th April. It is whichever is later. Now, when I receive the goods and services, there are 2 exceptions. There are basically 2 exceptions to this principle. Exception A and exception B. Exception A is a beneficial exception which tells that if a third person receives the goods and services on my behalf, it is as good as I have received the goods or services and I can take the credit. If you are the supplier and I have said that, okay, you don't send the goods to me, you send the goods to my job worker or you send the goods to my customer, XYZ person. You have billed it to me but shipped it to my customer or job worker or anyone. Who will take the credit? I will take the credit. Did I receive the goods or services? No. No, I did not receive the goods or services. But can I take the credit immediately? Yes. Receipt of goods by third person is equal to receipt of goods by me. I can take the credit. That is a beneficial provision. Now, there is a stringent provision. The stringent provision tells that if at all the goods are given in lots or installments, there is a single invoice for the goods, but they are given in lots or installment. As a recipient, I cannot take the credit in the beginning. I can take the credit only upon the receipt of last lot or installment. Supplier will pay entire tax at the time of first lot or installment. As a recipient, I will take entire input tax credit only at the time of receipt of last lot or installment. I would have received the copy of invoice right from the beginning. But when can I take the credit? Only when I receive the last lot or installment. There is no pro rata calculation as well. I have to wait till the last lot is received. The plant and machine is dispatched in multiple lots against a single invoice. Till I receive the last lot, I cannot take the input tax rate. But for supplier, it is different. Supplier, when we see time of supply, he has to pay entire output tax before removal of first lot. Recipient, you take entire input tax only after receipt of last lot. After receipt of last lot. But the important thing is, this is only for goods. The first beneficial provision was there for both goods and services. The stringent provision is only there for goods. Only and only there for goods. That's the fourth criteria. That is your fourth criteria. Right. Now, when you're talking about your fifth criteria, you have to file your returns. You have to file your returns for you to take the input tax credit. If you have not filed the returns as a recipient, I'm not talking about supplier and all. You have to file your return to take the input tax credit. I can have crores of rupees of credit in my books. But if I don't file my return under section 39, basically, which is GSTR 3B, basically, it can be GSTR 5 as well at times. But basically, the focus is on GSTR 3B. If I don't file my return, as a recipient, I cannot get the credit in my credit ledger. Only if I file my return, the credit which is there will be reflected in my electronic credit ledger. As a recipient, I have to file my return. As a recipient, I am required to file my return. I have to file my return under section 39. That's the fifth criteria. That's the fifth criteria. Registered, business use, document, goods services, written. Now, sixth criteria. I cannot take depreciation on GST portion. I can take depreciation on the price portion. No worry. I cannot take depreciation on GST portion. Do not mix both. If I have purchased a capital goods worth 1 crore plus 18 lakhs GST, can I claim depreciation on 1 crore? Yes. I should not claim depreciation on 18 lakhs. If I claim depreciation on 18 lakhs, I cannot take the input tax. Either it is my cost or it is my input tax rate. It cannot be both. It cannot be both. So do not go with the misconception that I should not take depreciation itself. Believe me, when you're in practice, you'll face these issues a lot. Even with bigger companies where you think that compliance is very good, but you'll be surprised to find compliance worst at that level. If the person in charge is not proper, they'll tell that no. If at all I want to claim depreciation, I should not take the credit. Therefore, we have added to the no. You can always claim depreciation on 1 crore price. You cannot claim depreciation on the tax portion. You cannot claim depreciation on the tax portion. Sixth condition. Seventh condition. When you're talking about the seventh criteria, what is the time limit for availing the credit? This time limit will be repeated in 3 places. So we are trying to close it here itself. Right. One is your time limit for taking input tax credit. Other is you will be talking about your time limit for raising your credit note, and other is time limit for rectification of your returns. Rectification of your return. Same time limit. Same time limit. What is the time limit for all these? For taking input tax credit, for raising credit note, for rectifying any mistake or omission, any error or omission. Either it is an error, mistake, or an omission. You omitted it. What is the time limit for that? It is 30th November of the next financial year. To which the invoice or debit note pertains to. If invoice or debit note pertains to 23-24, it is 30th of November 2024. 30th November of next financial year, or actual date of filing annual return, whichever is earlier. Annual return for that year. Actual date of filing annual return for that year, whichever is earlier. If at all you're talking about financial year 2023-24, what is the point that I am trying to tell? It is 30th of November 2024. Next financial is 24-25. So 30th November 2024, or actual date of annual return of financial year 23-24. You have time limit till December 24. You might have filed any point of time. Whichever is earlier. If at all your invoice pertains to 23-24, or debit note pertains to 23-24, it is accordingly that. If invoice pertains to 23-24, debit note pertains to 24-25, for debit note, you see the base as 24-25. That's it. That's the time limit. But one common mistake that is being made, whether it is ITC or credit note or rectification return, when they tell 30th November, it is not November return. The last return in which ITC can be claimed, or credit note can be raised, or rectification can be done, is October 24 return. That's the last return. And that too, it should be filed on or before, assuming that annual return is filed after that. If I don't tell this point specifically, I'm pretty confident more than 50% of the people, in spite of you going through the subject a lot of times, will have a mindset that 30th November means November return. No. Because your November return will be filed in December. Whether it is ITC or your credit note or your rectification return, they want that correction to be done before 30th November on the portal. When it is possible to correct that on the portal? It's not October. Last return is October. It can be September 24. It can be, please don't think it's always October. It can be any return, but on or before October. Last return is, so what I have written here, the last return in which you can take the credit, or in which you can raise the credit note, or in which you can rectify your mistake is October return. That too it should be filed on or before 30th November 2024. Can you rectify your mistake in September 24 return? Yes. August 24 return? Yes. But for all of them also the last date for rectification is 30th November. See, it is highly possible you are filing your returns late. You are rectifying in September month return, but you are filing after 30th November. Not possible. Not possible. Two criteria put together. Any return on or before October 24, which is to be filed before 30th November 2024. And this is an understanding that I have not yet filed my annual return. This is with an understanding that I have not yet filed my. Understand that for exam, they will always give an annual return date, which is say August or September. Practically, annual return is always filed after 30th November. If at all a client is coming and telling that please file my annual return on September, my tax audit is over, tell him wait. We'll do audit, finalize it, and wait till 30th of November, because if any correction is there later on, be it raising your credit note, be it taking your unavailed ITC, or be it rectification of return. Supposing you have wrongly put your customer GST number to another customer, even that has to be taken care. Correct? Instead of customer 1, I have put GST number customer 2. If I file my annual return in haste on say 4th of October, finished. What will happen? My customer 2 will customer 2 will tell that I have not get my credit and I don't have an option of rectification now. So though it is ready, file it only after 30th November. Statistically, you will find by that 99.99% or more than that annual returns are filed only after 30th November on or before 31st December. That 1 month gap. Who is that 0.01%? You have to find. You have to see those minds and see what an appreciation they deserve. That just because they have completed the work, they have filed their annual returns. Might be a few associates who don't have any transactions. And that too, the limit is 2 crores because every year government gives an exemption that if it is up to 2 crores, you are not required to file any. And it is not in a section. This is an yearly exemption. That being the case, you don't have it for your exams. Right. So this is the last date. I'm not going to elaborate on this last date in other places. In other places, we'll just go like this. What is the last date? 30th November of next financial year. Actual date of annual return of that financial year, whichever is earlier. Whichever is earlier. It does not mean November return for sure. The last return in which you can rectify is October return of next financial year. That too, it should be filed on or before 30th November. So that is the time limit for 3 cases. ITC, credit note, rectification and returns. Now, that is the 7th criteria. 8th criteria. If at all your supplier has done fraud and now he is trying to pass the credit to you, you cannot take the credit. If at all your supplier has done fraud, there is a demand order against the supplier telling that your rate of tax is not 5%, it is 18%. And after that, he is trying to pay that 13%. And he calls you and tells that, okay, I'll be raising debit note. I'll pay extra 13% tax. You take the credit. Anyways, you can take the credit. Right. So government is very clear. Supplier did a fraud. It was not a bona fide case. It was a fraudulent case. Therefore, the extra 13% that the supplier is paying, recipient cannot take the input tax credit. Recipient cannot take the input tax credit. What if it is a bona fide case? It can take. Whether it is a fraud case or bona fide case, 5% tax, input tax credit, recipient can take. Why? What was on the tax invoice? 5%. Supplier will pay output tax, recipient will take credit. The differential 13%, if supplier has done fraud, recipient cannot take the credit. If it is a bona fide case, recipient can take the credit. Recipient can take the credit. So that is your condition number 8. Condition number 8. Condition number 9. Condition number 9 tells that if at all you want to retain your credit, retain. You have already taken the credit. You want to retain your credit. you have to make sure that you make the payment of value plus tax to the supplier within 180 days. If not paid, to the extent of non-payment, proportionate ITC has to be reversed. That too with interest. It does not mean that reversal is permanent. After 180 days, immediately after 180 days, you have to reverse with interest. At the time of invoice, take the credit. If you are paid within 180 days, nothing to worry. This provision itself is not attracted. If you are not paid within 180 days, reverse with interest. As and when you make the payment, immediately thereafter, as and when you make the payment, immediately thereafter you take the credit. But interest paid cannot be claimed back. What is the criteria? You get the invoice, take the credit. You make the payment within 180 days, nothing to worry. You're not making the payment within 180 days, you have to reverse with interest. Interest is the cost. And after 2-3 years you are making the payment, you can re-avail the credit, but interest cannot be claimed back. Interest is a cost. Whatever interest you have paid, that is a cost. Now something about interest. Interest calculation will start from the date of availing the credit till the date of reversal. From the date you avail the credit till the date you are reversing it. Not from the end of 180 days. Not from the end of 180. It will start from the date of availment till the date of availment in your return, date of reversal in your return, not in your books. Availment in your return, reversal of ITC in your, if it is August month credit. So August month return you have filed on 18 September. So interest will start from 18 September. Supposing you have reversed in October of next year. October month return you have filed on 15th November. So it will be till 15th November. Availment is in your return, reversal should be in your return. And you have to make that payment in your GSTR 3B in the tax period immediately following 180 days. After 180 days only you are going to make the reversal. Not just because you have to pay the interest, you are not going to do the reversal before that. So when that 180 days is completing, in your next GSTR 3B, you have to reverse it. So what if I don't reverse the credit and finally I make the payment? Which means I availed it, I was to reverse but I did not reverse. I was to re-avail, I did not re-avail. Still interest calculation will be done. Still you have to pay the interest. But this time interest calculation will be there till the date of final payment. Because you could have re-availed only at the time of final payment. Not relevant for your exams, just focus on this part. 180 days, if you make the payment, nothing. No payment, pro rata basis. Partial, what if I have made partial payment? Only partial reversal will be there. So pro rata basis, I have to reverse the credit with interest. Starting from date of availment in your return till the date of reversal in your return. After I make the payment can happen after 2 years, 3 years, 5 years, 6 years. Finally, I have settled the payment to the supplier. Can I re-avail the credit? Yes. But can I re-avail the interest that I paid? No. Is there any time limit for re-availment? No. There's no time limit for, and that is the reason I've been telling I'm making the payment after 2 years, 3 years, 5 years. Don't worry. Time limit that we have discussed is only for availment, not for re-availment. It's only for availment. It's not for re-availment. This is the entire provision. There is an exception that we'll discuss finally when we compare all the conditions together. So this area we'll see finally. Now if you see the total number of conditions, how many conditions we have seen? In totality, we have seen 9 conditions. Registered, business, document, goods services, return, depreciation, time limit, fraud, and you're talking about 180 days. You're talking about 180 days. Now, the condition which is there is all about 10th condition. The focus is on the 10th condition here. It talks that if I want to take the credit. Now, why I have taken last 2 conditions or last 2 points separately. If you see in the earlier page, I did not take one portion. I did not take a portion. These are nothing but your condition number 10 and condition number 11. which is again explained here, condition number 10 and condition number 11. Why these two are not taken? Because these two are dependent on your supplier. All the other 9 conditions, you are in control. You are going to do something based on which your credit is decided. You are going to do something based on which your credit is decided. But when you talk about the last 2 conditions that we are going to discuss, you are not having control. You are at the mercy of the supplier. You are at the mercy of the supplier. Now, what is this 10th condition? 10th condition tells that supplier should have filed his GSTR 1 or IFF, and I should have got the same in my GSTR 2B for me to take the credit. Supplier should have filed his GSTR 1 or IFF on time, on or before due date. On or before, because the focus is not on GSTR 2A, it is on GSTR 2B, which is static. It freezes. It freezes. Supposing it is April month sales. For you, it is April month sales. For me, it is April month purchase. All your GSTR 1 and IFF, you should have filed on due date. On 14th of May, I'll download my GSTR 2B. Those who have filed your GSTR 1 and IFF on time, I'll get the transactions. I can take only that credit. Few of my suppliers would not have filed their GSTR 1 and IFF on or before the due date. I cannot take the credit in April month 3B. I have to take when it is going to reflect. I'll call you and tell that you have not filed your GSTR 1 or IFF, invoice furnishing facility. Please file so that I can take the credit at least in next month. So if you guys are filing after 14th May, but on or before 13th June, I'll be taking the credit in my May month return. So I am at your mercy. I am at your mercy. Right. I'm not elaborating what is GSTR 2A, 2B. We are not going for a marathon discussion. Understand that 2B is static. So I should get in my GSTR 2B, which is static. Which means you guys should have filed your GSTR 1 on time. If you did not file on time, I cannot get the credit now. I have to postpone my credit. Out of all my recipients, the total credit of which is 1 lakh. Amount pertaining to 80,000 I have got in my GSTR 2B. I can take the credit only of 80,000. 20,000 what will happen? I have to postpone. I have to follow up with my supplier and tell that at least file your GSTR 1 or IFF now and report my transaction so that at least in the next month I can take the credit. So I have to keep a track. I have to keep a track. The tracking will be very unique. Current month credit plus previous month credit taken now minus current month taken credit postponed. Current month credit plus previous month credit taken now because it is reflecting in GSTR 2B now minus current month credit postponed because it is not reflecting in GSTR 2B now. It will reflect later. That I have to do the calculation. Are you guys clear with this understanding? But this condition is again not applicable for certain cases. This condition is again not applicable for certain cases. What are these cases? If at all you're talking about RCM, that too if the supplier is unregistered, or import of goods where I'm taking the credit of IGST portion of customs duty, or ISD invoice, or I have purchased from NRTP. We are not talking about ISD, we are not talking about NRTP. We are talking about I getting the invoice from input service distributor. I am purchasing from NRTP. So the focus is not on ISD, NRTP. The focus is on recipient who has taken the invoice from ISD or NRTP. If these invoices are not coming into GSTR 2B, even if they are not coming in GSTR 2B, I need not worry. I can take the credit. This we call it as special credits. Whether or not they are appearing in your 2B, take full credit. Take full credit. Balance credit. Only if they are appearing in your 2B, take the credit. These items, RCM from unregistered supplier, IGST on import of goods, invoice from ISD, invoice from NRTP, whether or not you are getting in GSTP, take full credit. Do not see your 2B. Other items, only those which are appearing in your GSTR 2B, take the credit. Take the credit. Right. In reality, how the calculation will be there? 4 special items. take full ITC. You need not see GST to be. Balance items. Balance items. Take ITC only of those which are there in your 2B plus books of current month. Your 2B will contain the details of current month as well as previous month. Your 2B will contain the details of your current month as well as in previous month. Those suppliers who do not file their GSTR1 IFF on time but file later, it will come in your current month GSTR to be. To make it very clear, if it is April month supply, just a quick walkthrough to A and to B. If it is April month supply, supplier 1 has filed on 10th of May, supplier 2 has filed on 15th of May. As a recipient, you will get that information in GSTR 2A as well as 2B, both. But in which months GSTR 2A? In which months GSTR 2A? When you talk which months GSTR 2A? Whether it is supplier 1's transaction or supplier's 2 transaction, as far as GSTR 2A is concerned, you will be getting in GSTR 2A of April month. 2A keeps updating. It is dynamic. 2A keeps updating. Initially, I will find only supplier 1's transaction if I download it on 10th of May. But if I download my GSTR 2A on 15th of May or say the next day, 16th of May, I will see supplier 1 transaction as well as supplier 2 transaction. But what happens when GSTR 2B? In GSTR 2B, supplier 1 transaction I will get in my April month GSTR 2B because it is static, whereas supplier's 2 transaction I will not get in my GSTR 2B of April, I will get that in GSTR 2B of May. Why? It is filed after 13th of May but on or before 13th of June. So I will get that in my May months. I will get in my May months GSTR 2B. But when I see my 2A, I will find my both transaction in my GSTR 2A. 2A is not used for monthly return, it will be used for your annual return. 2B will be used for your monthly returns. Right. Coming back here, so balance credit, I will be taking based on my 2B of current month. Current month transaction reported in current month. I will also add ITC where I will see 2B. In 2B I am seeing in current month. In books it was in previous month. In first stage in 2B of current month transaction, books also it is of current month transaction. The second portion is in my 2B I will have even old month transactions. So 2B I am getting in my current month. It belongs to old month, but I am getting that in my current month because the suppliers were of supplier 2 category, they filed their GSTR1 IFF late. So it pertains to old month. But in my 2B I am getting in current month. It pertains to previous months, but I am getting the credit in my current month. Minus. I am not going to do minus because if I follow this method, I am going only with my 2B. What is the credit that I am not going to take? I will postpone my credit. I am not going to do subtraction. I will postponing it. ITC, which is there in my books in current month, but it is not there in my 2B in current month. I am not subtracting it. I will postpone it. It depends on what way formula I am taking. I am going to postpone it. Why I am going through this formula? Because I have started with my formula in this way. ITC, which is there in 2B as well as books. Therefore, there is no question of subtraction. There is no question of any ITC which is there only in my books but not in my 2B. I did not include it. There is no question of any subtraction. That I will postpone. I will keep a track. ICA has asked very basic questions, not the in-depth questions that we have worked out in your main book. But for your exam, this much is sufficient. Remember this thing, 4 special items, whether or not you get in 2B, take the credit. Balance, if you get in your 2B, take the credit. That can pertain to current month books or it can even pertain to previous month books. Please check in your previous month whether you postponed. Even in the previous month you did not postpone, you took the credit already. There's no question of taking it again. There's no question of taking it again. So that is the criteria. That is this criteria, 10th criteria. That is actually a 12th criteria which is not there because rules are not notified yet. A dangerous criteria which I have discussed in my YouTube lecture 2 attempts back, and I was praying it is never notified. So even at that point of time, if you see the recording of a year back, I have elaborated this for at least 1.5 hours and finally said I pray this is never notified, and thankfully till now it is not notified, and I am not sure whether it will be notified or not. It is so dangerous, highly dangerous. As the rules are not notified, we are not touching it. As it was there for an amendment 2 attempts back, a discussion was done, but finally it was said that not allowed for exams because rules are not yet notified. Even after a year, rules are not yet notified. So that dangerous condition which is there, which means it is a triggering time bomb. It is there in the provision. What is not there is an effective date, which means as of now the provisions are drafted. Effective date has not yet come. The moment they notify effective date, it will be live. It is not yet live. So we are not touching that. We'll see the 11th criteria. 11th criteria, again I am at the mercy of the supplier. If supplier pays the tax, I can take the credit. But unlike condition number 10, it is a bit different. In condition number 10, I am dependent on my supplier that supplier should file his GSTR1 or IFF. Here they tell that supplier should have paid his output tax, which means supplier should have filed his GSTR 3B. Supplier should have filed his GSTR 3B. There is a difference. Please compare the difference. There it is supplier. The focus is on supplier and the focus is on supplier filing GSTR 1 or IFF. Here again the focus is on supplier, but supplier making the payment, and when he makes the payment, when he is filing GSTR 3B. Payment is always along with GSTR 3B. Without payment you cannot file your GSTR 3B. Right. Second difference. There, unless otherwise you get in your 2B, you cannot take the credit. You have to postpone. Here, initially you will take the credit, assuming that supplier will pay tax. Assuming that supplier will pay tax. Initially, what you are going to do? You are going to take the input tax credit on the assumption that supplier will pay tax. Later on, you will do a check. What checking you will do? You will check whether the supplier has filed his GSTR 3B including that particular transaction and paid the tax on or before 30th September of the next financial year. By the way, this 30th September is of no use. We'll discuss why it's of no use. Initially they tell that it is 30th September. Later on they tell that if at all supplier has not included the transaction in GSTR 3B which is filed on or before 30th November. Suddenly they change the hand. On or before 30th November. Again, 30th November does not mean you are talking about your November return. It means October return which should have been filed on or before 30th November. Then you have to do the reversal, and that reversal has to be done with interest. By the way, interest will start from where? This interest will start from 1st of December. This interest will start from 1st of December. I said something that 30th of September is of actually no relevance. If supplier has included in October month return, supposing the transaction is of financial year 23-24. If supplier has included that transaction in October 2024 GSTR 3B, which is filed on or before 30th November 2024. I availed the credit in the beginning. Because this condition does not tell that only after payment I have to take. This condition is different from the 10 condition. This condition tells that you take the credit. Assume that supplier will pay tax. Later on, you do the checking. Now, if supplier has not paid the tax, this is very clear. When supplier has included my transaction in October return, he has not paid the tax on or before 30th September. He has paid it only after that. But he has included in October return filed before 30th November of the next financial year. Will I reverse my credit? No. No, not required. Not required. Even interest starts only from 1st December. So there's no question of reversal of credit. There's no question of re-availment of credit. There's no question of reversal of credit. There's no question of. In essence, 30th September is of no use. You can only remember 30th November. You can only remember 30th November. If I change this question and I tell that for financial year 23-24, I purchased the goods from you and I took ITC. It got reflected in my GSTR 2B. I can mix both the conditions now. Let us try to mix both the conditions now. Condition 10 and condition 11. I am the supplier, you guys are the recipient. You have supplied me something in the month of April. The supply happened in the month of April 2023. As a supplier, you have filed your GSTR 1 of April 2023 on 17th June. 17th June. And you did not report it in April GSTR 3B. You reported that in GSTR 3B of December 2024. December 2024. Obviously, payment was made then. Supposing which happened, the payment was made on say 18th of Jan 2025. The payment was made then. To make it more interesting, I did not report in GSTR 1 of April. I missed that transaction. I reported in the month of May. Highly possible. I missed the transaction in my GSTR 1 as well as GSTR 3B of April. I included it in May 2023 GSTR 1. I included that in December 2024 GSTR 3B. But the transaction pertains to, if at all you have been seeing your GST returns at your office continuously, you will understand this very highly possible scenario. Highly possible scenario. Correct. Now, when will I take the credit? We are trying to merge condition number 10 and 11. When will I take the credit? Which return? As a recipient. As a recipient, when will I avail the ITC? I will avail the ITC while filing my May return or June return. May return means GSTR 1 or IFF should be filed on or before 30th of June, which has passed. It is after 14th of June but before 13th of July. So when will I take the credit? I will take the credit in my June month's GSTR 3B. My 3B. Now I am not focusing on suppliers 3B. My GSTR 3B. The question was all about suppliers GSTR 1, suppliers GSTR 3B. Now I am telling when will I take the credit? In June month's GSTR 3B. I am mixing both. Be prepared if at all ICA wants to give a 4-mark questions only focusing on 10 and 11th condition. This is a very beautiful question where everything will be tested of your condition number 10 and condition number 11. Now should I reverse the credit? Yes. Condition number 10 is real time. Condition number 11 is not real time. It will be checked later on. Whether supplier paid the tax on or before 30th November of the next financial year. I am telling 30th November, forget about it. Just focus on, don't focus on 30th September. Focus on 30th. Did the supplier pay the tax? No. So what should I do? I should reverse the credit. I should reverse the credit. When I am reversing the credit, please understand that this reversal will be with. So I am going to reverse the credit with Interest is always at 18% from 1st of December 24. No, till the date of reversal. I don't know when I have reversal. Till the date of reversal. It has got nothing to do with 18th of Jan. Till the date of reversal. It is till the date of. Supposing I am doing that reversal in the month of in the return of November, which means while filing my November GSTR 3B, understand surely there will be some interest. Why? November 3 GSTR 3B will be filed in the month of December. So there will be some interest, right? Starting from 1st December till I have filed my 3B of November month. 3B of November month. Will I re-avail the credit? Will I re-avail my credit? Yes. I'll re-avail my credit. While filing my, this is June 23, this is November 24, this is Jan 25. Jan 25. While filing my Jan 25 GSTR 3B, my supplier has now paid the tax. While filing my Jan 2025 3B, I cannot include in my December. I don't know whether he has included in Jan. I'll come to know after he has filed it. So it is not in December 24 return. It is in Jan 25 return, because supplier will now tell that I have included in my GSTR 3B of December, which is filed on 18th of Jan. So recipient will get this information only in Jan. So he will be taking the credit only while filing Jan 25 return. Clear? Look at the interesting facts. Availment was there in. Transaction pertains to April 23. Availment was there in June 23 GSTR 3B. Reversal was there in November 24 GSTR 3B. I can do my reversal even in October. That will be without interest. If I do in November month, that will be with interest. If I am waiting till 30th November, I will end up paying interest. If I am waiting till 30th November, I will end up paying interest. Right? Interest starting from 1st December 2024 till the date I actually do the reversal in my return. Right? If I don't do reversal, interest will continue. So I have not written any date till the date of reversal. And finally, re-availment will happen in Jan 25 GSTR 3B when supplier has finally paid the tax. Though he has included it in December 2024 return, but yes, the payment happened in Jan 25, and as a recipient, I'll get to know that information only in Jan 25. I'll re-avail the credit in my January 2025 GSTR 3B. For re-availment, there's no time limit. I have merged your condition number 10 and 11. Forget theoretically, in the example, I have merged your condition number 10 and 11. That is your condition number 10 and condition number 11. Are you guys clear with this understanding? These are all the criteria for taking the credit. All the criteria for taking your credit. But when you talk about your condition number 9, 10 and 11, 180 days, GSTR 1 IFF payment. All these three conditions are not applicable for RCM cases. Why? I myself pay my tax. Condition number 9, 180 days. 10, supplier filing GSTR 1 IFF. 11, supplier making the payment. In all these three cases, these conditions are not applicable for RCM. As simple as that. Why? I will pay my tax, I will take the credit. So 180 days criteria is not relevant. I will pay the tax, I will pay the credit. Whether or not I pay to the supplier is not relevant. Correct? Even in your 1 and IFF, we have seen 4 special cases where condition number 10 is not applicable. It includes RCM. Condition number 11, supplier making the payment is relevant only when he is required to make the payment. In RCM, who is required to make the payment? Recipient is required to make the payment. So for these three cases, condition number 1 to 8 and condition number 9, 10, 11, 1 to 8 are applicable for FCM cases as well as RCM cases. 9, 10, 11 are applicable only and only for FCM cases. Only for FCM cases. 9, 10, 11 means you are talking about 180 days payment. You are talking about reflection in GST or 2B. You are talking about payment by the supplier. Payment by the supplier. And even when this 180 days criteria is not applicable for other logical cases, if it is a schedule 1 transaction, there is no consideration. Forget about payment within 180 days. Schedule 1 case, there is no consideration. Forget about 180 days payment. If at all, payment is made by the recipient to the third party on behalf of supplier. Payment is already made. So there is no such criteria of 180 days for that payment. Supposing total payment is 10 lakhs, out of which 2 lakhs payment is made by the recipient to the third party on behalf of, will I check that 180 days for 2 lakhs? Because though it is not paid to me, it is paid to third person on my, it is as good as payment is done. So this 180 days will be checked only for 8 lakhs. Will be checked only for, I repeat, supposing the value of your transaction with me is 10 lakhs plus GST. And you have asked me to make the payment to third party 2 lakhs. The moment I have made the payment to the third party 2 lakhs, it is as good as I have made the payment to you. For that 180 days payment will not be, 180 days criteria will not be applicable. For the 8 lakhs payment that I have to make to you, I will apply 180 days criteria. 180 days criteria. Logical exclusions. Need not focus or by heart. These are all logical exclusions. But what you need to remember is for condition number 9, 10, 11. These three conditions are not applicable in RCM transactions. These are all the conditions for you to take the credit, for you to avail the credit. So when you're talking about availment of credit, we are done with your availment criteria. Total conditions are 11, 1 to 8, 9 to 11. 1 to 8, FCM as well as RCM. 9, 10, 11, only FCM cases. 12th condition, as of now, it is not live. So forget about the 12th criteria. It is not yet notified. Now, when you talk about your availment of credit, we have understood the availment of credit, that you can avail the credit of, if it is an intrastate supply, CGST, SGST or CGST, IGST, sorry, CGST, UTGST plus compensation cess. If it is interstate supply, IGST plus compensation cess. If it is import of goods, only IGST and compensation cess. You cannot take the credit of BCD, social welfare surcharge and other special import duties. That credit you cannot take. That will be added to your, that we have been discussing right from the beginning. That will be added to your cost. Once you avail the credit, the next step is utilization. How are you going to use the credit? Mandatorily, there will be a question of utilization. Either availment and utilization, or at times separately utilization. Mandatorily, it will be there. So when you talk about your utilization portion, 100% it will be there. Make one thing very clear, utilization, you go with a particular proper formula. So if you are talking about your utilization, first step for a master question, detailed question, first step should be calculating gross output tax. Second step, it should not be ITC, it should be RCM. Step number 3, it should be ITC including, now you understand why second step should be RCM. Do not go by your ICI method, because ICI changes its mood. Every now and then it will change the answer pattern. Question pattern will be the same. Answer pattern will keep on changing. 1 table, 2 tables, 3 tables, 4 tables, consolidated table. You will not be able to understand what is the written. Your understanding of the provisions will be right. But when you crack your answer, the moment you see the way of presentation, you will be lost there. Forget about the presentation of ICA. Follow this particular presentation. Fourth step, net output tax to be paid in cash. Now when you are calculating that net output tax to be paid in cash, how are you going to calculate that net output tax to be paid in cash? Here your utilization formula will come. The focus is on the fourth step. First, here you have to write RCM to be paid in cash. Because RCM you have already included in second step, but you have to pay that in RCM paid by cash, get in credit. Pay by cash, get in credit. And please make sure that the pattern is always ICS. It is never CSI, it is always ICS. So here that will be the first step. We are discussing in detail how to calculate the payment in cash. Fourth step. That the second step will be net output tax to be paid in cash. So rather, the fourth step is total payment to be made in cash. In the total payment to be paid in cash, one is RCM portion, one is other portion. In the other portion, you have to write gross output tax less ITC, which includes RCM ITC, that is taken from step number 3. Gross output tax taken from step number 1. Your ITC taken from step number 3. And this RCM to be paid in cash is taken from step number 2. Correct. Now, when you get this calculation, the answer, the formula is not yet over. You have to split that. First, you have to use your IGST, ITC, then CGST, ITC, then SGST, ITC. So here you have IGST, output tax, CGST, output tax, SGST, output tax. You will be writing your output tax figures here. You will be writing your output tax figures here. First, IGST, ITC you will be using. What are the sequence? IGST, ITC will be first used for IGST, output tax, then used for CGST output tax, SGST output tax, any ratio, any proportion. That is where your intellect will come, and you have to see where you can balance. You have to do optimum balance, utilization. Otherwise, if you don't do optimum utilization, you will end up paying more in cash, having excess credit in your hand. So here you have to play and see whether you can do any adjustment. This is the only area of adjustment. All the other places it is freeze. You cannot do anything. Then next, you are going to go with CGST, ITC. First use for CGST output, then use for IGST output, then being used for IGST output. CGST, ITC cannot be used for SGST output. Finally, it is SGST, ITC. First use for SGST output, then use for IGST output. SGST input tax credit cannot be used for CGST output. So this is the way we have discussed both the utilization formula, also the master question which will come containing, the high end complex question which may come is including all these transactions, and this should be the pattern of your working out answers. Right? If I were to tell only utilization formula, first use IGST, ITC for IGST output, then for SGST output, CGST output, any ratio, any proportion. Then you start using CGST input first for CGST output, then for IGST output. It cannot be used for SGST output. Finally, you touch SGST input. First use it for SGST output. If balances that, you can use it for IGST output. But SGST input cannot be used for CGST output. So you will get something in cash here. When you subtract both, you will get something in cash here. But do not stop that. If you add both, you will get the payment, total payment in cash. If you add Roman number 1 and Roman number 2, Roman number 1 is RCM to be paid in cash, Roman number 2 is net output tax to be paid in cash, which is gross output minus ITC. You will get the total payment in cash, which is nothing but total payment in cash. But you don't stop here. You write something extra which will cross check your answer. ITC carried forward. ITC. So if you have ITC carried forward, double check. Is there any place where you have gone wrong? The only area where you can go wrong is point 2 of utilization, where you have not properly planned your other places. You will not go wrong. So write also ITC carried forward. Clear? This is how your utilization should look like. So all your questions in your question bank, master question bank, train your brain. Whenever you see the pattern, I think I've clearly explained in the initial part. Do not think TYB is mere consolidation of ICA questions. No. The efforts that we take for SRK and QR infographics, both together, we have to take extra efforts in TYB. Because we work out the answers in a very different manner, a standard pattern, and we keep changing the sequence and we keep updating the questions. Lot of questions in your TYB will have a word updated, adapted. It means now if you go to ICA website and see that question, it is not of any use. You have to see the updated answers because the provisions have been amended. You have to see the updated answers. And one such case where we do in a TYBs, make sure that the answer pattern also remains the same. For a master question, it will always come in this way. Step 1, gross output tax. Even if gross output tax is one line answer, sale value is given, rate is given, even then there will be a separate table. If you try to club all the tables, you will go wrong. There are chances of making silly mistakes. If you try to work out in steps, the chances of making silly mistakes is gone. Right. That is all about your utilization. And needless to say, compensation says input tax credit can be used only and only for compensation says output tax. It can be used only one on one. That is all about your utilization principle. Now moving on to the next part, important part of your ITC. Majorly, ICI focuses majorly on section 16 and section 17. The conditions for taking the credit and your block credit. And your block credit is simple if you bifurcate your items in a separate manner. First bifurcation you should do what? First is all of related to motor vehicles, vessels and aircrafts. Second part others. First related to motor vehicles, aircrafts and vessels. What will happen with respect to motor vehicles, aircrafts and vessels? When you're talking about your motor vehicles, aircrafts and vessels, what is the criteria? The criteria is more in depth for motor vehicles. If the motor vehicle is used for goods transportation, if it is used for passenger transportation, if it is used for special purposes, if it is used for special purposes and goods transportation, no need to worry, take full ITC. Take full ITC. Only and only if it is used for passenger transportation, there's a need to worry. You have to again bifurcate. Whether we are talking about more than or equal to 14 passenger seating capacity or less than or equal to 13 seating capacity. If it is more than or equal to 14 seating capacity, basically you are talking about buses. Company purchasing the buses, they tell that okay, here there's no chance of any misuse. You will be using only for your business purposes, take full credit. If it is less than or equal to 13 passengers, as a normal rule, you don't get the credit. But there are 3 exceptions. In these 3 exceptions, you will get the credit. What are the 3 exceptions? Further supply, or you are there involved in passenger transportation service, or imparting driving schools. So when you talk about further supplying that item, further selling that item, automobile companies, all the automobile dealers, they purchase it, then they sell it, you will get the full credit. Or passenger transportation service sector, red taxi, classic example. I'm not taking the case of Ola because they don't basically own the vehicles. But assuming all these red taxis and other cases where they use it for passenger transportation, take full credit. Or driving schools. Driving these three sectors without having the motor vehicle, they cannot do their business, take full credit. So why have you taken aircraft and vessel separately? Your aircraft and vessel directly start from here. Directly, first itself they tell that no credit. Starting itself they tell that no credit. Then they tell okay. If at all you are covered by exceptions. What are the exceptions? Further supply, passenger transportation sector, or driving schools, navigating schools. You can take the credit. Indigo Airlines, can it take the credit? Passenger transportation. Correct. Passenger transportation. So it can clearly take the credit. In Coimbatore, there is an airplane academy. If you go to race course, you will find. Right. Not only that, they even teach you. Right. Now, these academies will purchase the aircrafts. Can they take the credit for training purposes? Yes. But what if Reliance Limited is purchasing aircraft for travel by Mukesh Ambani? It is not covered by the exception. It is not covered by the exception. Are you guys clear with this understanding? You may tell that, sir, it is only used for business purposes. Forget about it. You cannot take the credit. You cannot take the credit. That's all about the purchase portion of your motor vehicles, aircrafts and vessels. Purchase portion. What if I take them on hiring or renting or lease? And there are other related services. If a motor vehicle, aircraft or vessel is eligible for input tax credit. If a motor vehicle, aircraft and vessel is not eligible for input tax credit, based on what we have discussed. Based on what we have, if it is eligible means, basically if you would have purchased it, credit would have been given. If it is not eligible means, basically if you would have purchased, credit would not have been given. In such a case, if you purchase that motor vehicle or take that same motor vehicle, aircraft or vessel on lease, or have repair and maintenance on that motor vehicle, aircraft or vessel, or have general insurance service on that motor vehicle, aircraft or vessel. Answer is the same. Whether you purchase it or take it on lease, hire or rent, or there is repair and maintenance services, or there is general insurance services. Obviously, you will take all credits. If at all it is ineligible, if at all it is covered by ineligible category, what will happen? What will happen? Whether you purchase it or go for lease, hire or rental, or have repair and maintenance service on it, or have general insurance service on it, you will not get any credit. As simple as that. If it is an eligible, if it is an eligible asset, whether you purchase it or go for lease, rental or hiring option, or you have repair and maintenance services, or you have general insurance services, everything is tick mark. If it is not an eligible item, say for example, Mukesh Ambani, Reliance Limited has purchased an aircraft for the travel by managing directors. Not eligible. Whether you purchase it or take it on rental, hire or lease, or go for repair and maintenance service, or go for general insurance service, you will not get the credit. Are we clear with this understanding? Are you guys clear with this understanding? Now, there are few exceptions to this principle. When you talk about repair and maintenance service and general insurance service, though it is an ineligible item, you will still get the credit for two sectors: general insurance company and manufacturer of motor vehicles company. Very simple example. Tata Limited is manufacturing nano car. It is manufacturing a 4-seater car. If I purchase that car for my academy purposes, I cannot take the credit. But Tata Limited will not purchase that car. Tata Limited will purchase raw material and then manufacture that car. Don't you think that Tata Limited will have thousands and lakhs of that cars? Don't you think that Tata Limited will have repair and maintenance on those cars? Don't you think that Tata Limited will take insurance of that cars, which will be a stock in trade for Tata Limited? Don't you think that it is a very normal course of practice for Tata Limited? There is no scope of any misuse. Take full credit. Take full credit. Two sectors. General insurance company. Why general insurance company? Why general? Reinsurance concept. Right. A general insurance company has given insurance for Reliance Limited's airplane. Reliance Limited cannot take the credit. As the insurance company is feeling the risk, it has passed on a part of risk to another insurance company. So now that insurance company, that is general insurance company 1, general insurance company 2 and Reliance Limited. This Reliance Limited has taken insurance on what? It's aeroplane. Reliance Limited, which has taken insurance. Insurance is on what? Airplane. Reliance Limited cannot take the credit. General insurance company will pay output tax, but Reliance Limited cannot take the credit. But general insurance company 2, it is going to give service to general insurance company 1, it will pay output tax, and general insurance company 1 will take the credit. Subcontract. This is the main contract. This is the on subcontract. Always you'll get the credit because subcontract is very important for your business. Not only for this point, even for the following points we'll be discussing. It is very important for your business. You'll get the credit. You will get the credit. To make you understand this, there is a point which we'll be discussing in the next page. On food and beverages, you cannot take the credit. On outdoor catering, you cannot take the credit. Reliance Limited have organized an AGM for which it requires food and beverages, outdoor catering services. Outdoor catering services. Outdoor caterer 1 is providing services to Reliance Limited. And outdoor caterer 1 is not able to manage the work. It has given the work on subcontract to outdoor caterer 2. Outdoor caterer 1 will pay output tax, but that credit cannot be taken by. So this is true for Reliance Limited. Whereas outdoor caterer 2 now becomes a supplier. It will pay output tax on which outdoor caterer 1 can take the ITC, subcontract. Very important for the business. If you look from Reliance Limited's point of view, in both these examples, 1, insurance of aeroplane, Reliance Limited cannot take credit. Outdoor catering, Reliance Limited cannot take the credit. But the supplier, if it is not able to do the full work and giving part of the work as subcontract, that supplier now becomes a recipient for the subcontract. That supplier, your insurance company 1 or outdoor caterer 1 becomes the recipient for the subcontract. It can take the credit. It can take the credit. So I'll be using the term subcontract. Subcontract means credit is available. Right. There is this one exception, and the last exception here is when you talk about your ineligible assets. See, the issue is all about ineligible assets. Ineligible is generally no credit. Exception is for what? That exception that you discussed was for repair and maintenance services and general insurance service for 2 companies, not for all. General insurance company and manufacturer of motor vehicles. There is an exception number 2, which is only for leasing, hiring and rental. If at all, it is due to statutory obligation. Statutory obligation. You can take the credit. If at all it is because of statutory obligation, you can take the credit. Not on purchase. The statutory obligation point is not there on purchase. In Delhi, it is a mandatory requirement that company should provide night transportation facilities specifically to its female employees. Now, if a company decides to purchase cars for transportation of its employees, it cannot take the credit. But if the company decides to hire the cars for transportation of its employees, which is because of statutory obligation, it can take the credit. It can take the credit. Right, so there is a difference above. For purchase, there is no exception, only for lease, hire or rental, that is an exception. That is all and all about your motor vehicles, vessels and aircrafts. Other items. Once you're done with motor vehicles, vessels and aircrafts, major portion of block credit is over. Other small items. Other small items includes here 6 categories. Food and beverages, outdoor catering, just now we have discussed. Next, beauty treatment, cosmetic and plastic surgery. And next, health services, life and health insurance services. Normally, no credit. If a company incurs any of these expenses, it cannot take the credit. Be it food and beverages, be it outdoor catering, be it beauty treatment, cosmetic plastic surgery, be it health services, be it life or health insurance, no credit. Exception. There are 2 exceptions. First exception is statutory obligation. And one more exception is subcontract. In case of subcontract and statutory obligation. In case of subcontract and SS, statutory obligation and subcontract. Take the credit. Take the credit. You already discussed one example. Outdoor caterer 1 to Reliance Limited cannot take the credit. But outdoor caterer 2 to outdoor caterer 1 can take the credit. Can Reliance Limited take the credit at times? Yes, if it is due to statutory obligation. This can be even applied for, cosmetic plastic surgery, beauty treatment. Right? Hospital to an actor or actress for cosmetic and plastic surgery. Actor or actress cannot take the credit. But that cosmetic and plastic surgery is not done by the hospital doctors. Hospital, a lot of times, rather most of the times, will have a specialist. A specialist has come and performed the cosmetic surgery. Right? Now, that is nothing but subcontract. That specialist was not employee of the hospital. He was a consultant of that hospital. He will be charging professional fees. Can the hospital take the credit? Yes. Subcontract. These 6 cases. Then there are other 2 cases. Why they have been discussed separately, you will understand. Membership of a club, health and fitness center, and travel benefits to employees when you're talking about vacation. That is leave travel or home travel concession. Not when they are on business trips. If an employee is on business visits, that credit can be availed. If at all, employee is going for vacation which is sponsored by the company. Though company in terms of your income tax can claim the expenses, but it cannot take the ITC. Here there is only one exception. Statutory. Here there cannot be a concept of subcontract. And statutory obligation, please understand that India is still a developing nation. We are yet to go to that level where government will force a company to sponsor for the membership of a club or health and fitness center of employees. Government will force the companies to tell that no. Company, the employee will work 10 months, 2 months, you have to sponsor the vacation of employees. If that happens, then this exception will actually work out. As of now, actually the exception is only in theoretical terms, not in practical side. There's no such state, forget about country per se, no such state which tells that we will not go by economic index, we'll go by happiness index. Therefore, what we'll do? We'll make sure that all the companies are sponsoring 2 months vacation of employees, mandatory. That comes up, then that credit can be availed. For those companies who are sponsoring, that credit can be only theoretical point. So 6 plus 2. 6 plus 2. Are you guys clear with this understanding? 6 plus 2. And the next part is all about works contract and construction. Works contract and construction. I guess when we have discussed your schedule 2, we have differentiated what is works contract and what is construction. Now understand that if at all I want to construct a civil structure, there are 2 options. Either I go for works contract service, or I tell that no, I'll purchase the goods, you give me only construction service. You give me only construction service. Possible? right? That works contract or construction service, that is goods plus construction service, can be for a civil structure including telecommunication towers and pipelines outside the factory. It can be for plant and machinery. It can be for plant and machinery, and both of which we are talking about immovable. We are not talking about movable plant and machinery, there's no issue per se. Now, basically, what are they trying to tell? They're trying to have a very different logic per se. The amount is more, we'll not give you credit. Amount is less, we'll give you credit. Right? When you talk about civil structure, telecommunication towers and pipelines outside the factory, this telecommunication towers and pipelines outside the factory is got because the definition of plant and machinery in terms of section 17, not in terms of section 2. Section 17 tells that it excludes telecommunication towers and pipelines outside the factory. Basically, your telecommunication companies and oil and natural gas companies, where the investment in towers and pipelines is huge. They tell that they have a very typical formula. If at all you have capitalized, if at all you have capitalized in your balance sheet, if at all you have charged in your profit and loss account, if you have capitalized, it means amount is huge. Sorry, we will not give you credit. If you have charged to P&L, it means amount is less. Why not you take the credit? Take the credit. Take the credit. That is for your civil structure, pipelines outside the factory and telecommunication towers. What about plant and machinery, which is immovable? There, government cannot have this illogical formula. It is pakka illogical formula. Right? Whether it is capitalized, taken in your balance sheet, or whether it is charged, taken to profit and loss account, obviously they have to give full credit. Obviously they have to give full credit. The only extra criteria that they add is if at all you're talking about a plant and machine which is immovable, which is capitalized and taken to balance sheet, and if you're taking the credit, make sure that in addition to having business connection, it is having connection with outward supply. It is used for making outward supplies. They demand something extra. Business connection is always required. These plant and machine should be used for making outward supplies. Outward supplies. That's all about this particular area, but obviously there will be an exception. Whenever you're talking about cross, no credit, there will be an exception. What is that exception? Subcontract, you'll get the credit. In case of subcontract, surely you'll get the credit. If I am the builder and constructing a civil structure for Reliance Limited, it cannot take the credit. But as a builder, I am not able to complete the entire project. I am giving part of the work as subcontract. Now, can I take the credit for the other suppliers output tax? Yes. So, there is a builder 2 charging GST from builder 1, subcontract. That credit I can take. That credit I can take. Subcontract is always an exception. Right from the time when we are discussing your motor vehicles, subcontract is always an exception. You will always get the credit because it is very important for your business to be there. You can take the credit. So that's all about your works contract and construction sector. And finally, small miscellaneous point. If at all it is composition tax, can you take the credit? No. If at all supplier is a composition scheme dealer, I am the recipient. As a recipient, if I am purchasing from a composition scheme dealer, I cannot take the credit. Remember your definition of input tax. Input tax excludes tax charged by a composition scheme dealer. I cannot take the credit. If at all goods or services are used for personal use, I cannot take they are repetition. They have been already discussed. They are now coming as a repetitions. Now, NRTP cannot take any credit except IGST portion on import of goods. IGST portion on import of goods. We are talking only about NRTP as a purchaser, as a recipient. NRTP cannot take any credit except IGST portion on import of goods. None other credit can. Okay, let us categorize all these persons. RTP, CTP, NRTP and composition scheme dealer. Regular taxable person and casual taxable person can take all the credit, but not credit if at all they are purchasing from composition scheme dealer. NRTP cannot take any credit except IGST on import of goods. Composition scheme dealer cannot take any credit. Cannot take any, forget about it. If you see composition scheme section 10, it cannot take any. So if the recipient is RTP, CTP, it can take all the credits including purchases from NRTP. Including purchases from NRTP. The center point is RTP, CTP. They can take all the credit including purchases from NRTP, but not purchases from composition scheme dealer. NRTP, center point. It cannot take any credit, including purchases from RTP, CTP or composition scheme dealer, etc., except IGST on import of goods. Composition scheme dealer. It cannot take any credit. It cannot take any credit. If at all goods are lost or stolen, no credit. Initially you would have taken the credit, now reverse it. Destroyed. Initially you would have taken the credit, now reverse it. Written off. They are there with you, but initially you have taken the credit, now reverse it. If you again write it back in your books, as of now you are writing it off. You write back. Re-avail the credit. Re-avail the credit. Given by way of gifts of free samples. We have discussed in supply. If you take input tax credit, pay output tax. If no input tax credit, no need to pay output tax. And finally, the last point where if the supplier has done fraud, this also is a repetition. Recipient cannot take the credit. This also is, see, these 3 points are repetitions. They were already discussed. If you are purchasing from composition scheme dealer, no credit. If you are using the goods or service for personal use, no credit. If you are, if the supplier has done fraud, no credit. Now what they have defined? They have defined what is fraud. Section 74, fraudulent case. Section 129, Section 130. These are all fraudulent cases. If supplier is paying tax under Section 74, 129, 130, recipient cannot take the credit. If supplier is paying tax under Section 73, bona fide case, recipient can take the credit. That's all about your blocked ITC. Blocked ITC. So when you see your entire discussion now, we are done with your conditions for taking the credit, read along with block credit. When you read both, that will result into availment of ITC. Condition plus block ITC will give you availment. Then it is utilization. Condition plus block credit will give you availment. After you avail it, then you have to apply your utilization formula. Now when you are talking about your section 9.3 type 1 RCM, we will call it as type 1 9.3 RCM. We will be saying 9.3 RCM along with your corresponding exemption. If at all there are any exemption notification under 12 bar 2017 CT rate, 9 bar 2017 IT rate, we will read that along with it. By the way, the entire RCM notification are given in 13 bar 2017 CT rate and 10 bar 2017 IT rate, which means section 9.3 read along with 13 bar 2017 CT rate, 10 bar 2017 IT rate. But what we will do is we will even read it along with your exemptions, if at all any. So first, when you're talking about your services that of Goods Transportation Agency, GTA. Now what do you mean by GTA? GTA means a person who is providing transportation service entirely by way of road. Full transportation is by way of road and issues a document called as consignment note, which will be a part of your invoice but containing extra details. Entire transportation is by road plus consignment note. So when you talk about your GTA, we'll see directly RCM and exemption combo. First, you should ask to whom GTA is supplying the services. If the supply of services by GTA is to pure TDS deductors. Who are TDS deductors, by the way? Government. So pure TDS deductor means department or establishment of government, local authority, government agencies. They don't include governmental authority, they don't include governmental society, they don't include governmental public sector undertakings. They include only the initial part. Central government, state government, local authority and government agencies. Pure TDS deductors. What do you mean by pure TDS deductors? That department or establishment of government or local authority or government agency is having only GST TDS number. It is not having normal
GST IN number. It is having only GST TDS number. It does not have GST IN number. The person can have multiple numbers in that way. You can have normal GST number. You can have GST TDS number. You can have GST TCS number. You can have your ISD number. You can have your ISD number. So basically, if at all I tell what are the types of GST number, one is normal GST number. Then you have TDS, TCS and ISD number. Directors number, collectors number and distributors number. Now this government is only having GST, TDS number. No GST, exempt. No GST. It is exempt. This is first category. This is first category of exemption. It is based on person. Now there's one more exemption again based on person. If at all you are talking about persons other than specified persons. Now in simple language, I can tell that this persons other than specified person is unregistered, not registered individual or HUF. Unregistered individual or HUF. How I came to this conclusion? What do you mean by specified person? Specified person, there's one more criteria. Specified person means a factory which is registered under Factories Act or society under Societies Registration Act or cooperative society under established under any law, or you're talking about body corporate, or you're talking about partnership firm including AOP, whether registered with Partnership Firm Act, not GST, whether registered under Partnership Act or not. It may be registered, it may not be. The deed may be registered, the deed may not be registered. Other than GST registered person, including registered CTP. One way, remember this. Other way, forget about this entire thing. Remember that it is unregistered individual and HUF plus not having factories under Factories Act. It is not having factories under Factories Act. Everything else is taken care. It should be, or you can remember this way, that you are talking about individual or HUF. All other persons are covered there, which is not registered under GST Act, which is not registered under Factories Act. That's it. Individual or HUF, which is not registered under GST Act and which is not registered under Factories Act. If GT is supplying services to individual or HUF which is not registered under GST Act as well as not registered under Factories Act, that service is exempt. That service is exempt. Two persons, it is exempt. Pure TDS directors, individual HUF not registered in GST Act, not registered in Factories Act. If at all it is supplying to other persons, now this is goods based exemption. If at all it is supplying to other persons, evaluate on the basis of goods. Remember NAMO RD. NAMO, registered newspapers, agricultural produce, which includes wheat but not rice, which includes paddy and wheat but not rice, milk, salt, food grains including flours, pulses and rice. Now rice is covered here separately. Milk, salt, food grains. No sugar and all. Salt is thanks to whom? Mahatma Gandhi. So always you will find a speciality when you talk about your salt, Dandi March. Right. Not a successful march, shown as a successful, but nevertheless, it is for milk, salt, food grains including flour, pulses and rice. Organic manure. NAMO. So you are talking about NAMO, and NAMO stands for a person, and obviously when you talk about that person, he is RDX for the neighboring country. So RD, you are talking about relief materials for the victims of disasters, natural disasters or calamities or mishaps, defense and military equipments. If you see the last two categories, they don't talk about a particular item. They tell that it is relief material, it is defense material. That's it. Any kind of relief material, any kind of defense materials or equipments. If these goods are transported, exempt. Now, when finally, you will find it taxable. When it is not given to specified persons and when it is not given, when the goods transported are not NAMO RD. then it is taxable. Then it is taxable. If it is taxable, who has to pay GST? If GTA decides that it want to go for FCM, GTA itself will pay. But who will decide that? GTA. It has to give a declaration beginning of the year. It has to decide. If nothing is decided, by default it will be under? By default, it will be under RCM. The default provision is RCM. If GTA decides that it want to pay under FCM, then FCM. But what is by default rule? It is RCM. The recipient will pay. The recipient will pay. So exemption come RCM for your GTA. Please understand that all the RCM entries we are going to see, if I change the condition, it may result into FCM. So don't try to buy out the names and tell that it is RCM. It is no. There are conditions for all the types of entries under RCM. Next, you are talking about services by an advocate, services by an advocate, services by arbitral tribunal, services by advocate, services by arbitral tribunal. We are clubbing both. If services are given by advocate, if services are given by your advocate, any advocate, you have the two categories: senior advocate other than senior advocate, any advocate, or your arbitral tribunal, arbitral tribunal. If the services are given to government, exempt. If the services are given to non-business entity, exempt. If the services are given to business entity in taxable territory, but they are small business entity. What do you mean by small business entity? No, it is not registered. No, they may be registered, but still they are called as small. Why? The previous year aggregate turnover is less than 40, 20 or 10 lakhs as the case may be. The criteria is not that you are registered or not. You may be registered, but still you may be a small business entity because your previous year turnover is up to 40 lakhs, 20 lakhs, 10 lakhs as the case may be, whatever is applicable for you. You are not saying current year turnover because to decide whether you are small or big, you always take the reference of previous year. Your previous year aggregate turnover is up to 40, 10 or 20 as may be applicable for the recipient, small. Are we deciding based on registration? No. The small business entity in India may be registered, but still the service by advocate to small business entity will be exempt. Ulta, if it is to a business entity in taxable territory which is big, this big business entity means your previous year aggregate turnover is more than 40, 20, 10 lakhs as the case may be. Though it is more than that, it may not be registered. One example could be, it is a fraud person. Second example, it is dealing only with exempt supply. Correct? Now, registration is not the criteria. You are a big business entity because your previous year aggregate turnover crosses 40, 20, 10 lakhs as the case may be. Threshold limit for registration. Then it is taxable under RCM. What if it is to a business entity in non-taxable territory? If it is to government, exempt. Non-business entity, exempt. Whether Indian persons or foreigners. Non-business entity means non-business entity, exempt. Small business entity in India, exempt. Big business entity in India, it is taxable but under RCM. Business entity outside India, you cannot see their turnover. Whatever is the turnover, it's not relevant because they are outside India. Then it is taxable under FCM. Obviously, you can take the benefit of export of services. Supplier in India, recipient outside India, place of services outside India, get convertible foreign currency. You can obviously qualify for export, but the point is it is under FCM. Now you decide to pay output IGST and get the refund of entire output IGST, or go under bond utility, not to pay output IGST, get the refund of unutilized ITC. That is your decision. That is your decision. Are you guys clear with this understanding? Are you guys clear with this understanding? So that is all about your arbitrator, that is arbitral tribunal and advocate. But when you talk about your advocate, there's one more point that is left out. This is all advocate to clients. Advocate to clients. Arbitral tribunal to clients. What if it is advocate to advocate? What if it is advocate to advocate? One advocate to another advocate. One advocate to another advocate. What if it is advocate to advocate? Now, if it is advocate to advocate, obviously who in turn will give services to a client, correct? The next advocate will give services to a client, but we are not talking about the second part. Second part we have already discussed what will happen. We are focusing on advocate to advocate. We are focusing on advocate to advocate. So when you're talking about advocate to advocate, bifurcate that into two. Rather, the first point is not any difference. So first point you're talking about a senior advocate. Rather, first point you're talking about any advocate. Any advocate. You don't bifurcate again senior advocate and junior advocate. Any advocate, but if that is with respect to representation services to a business entity in taxable territory. Representation services to a business entity in taxable territory. Which means representation services to a client. That client happens to be business entity in taxable territory. What kind of services? Not advisory services. It is representation services, which means the advocate will go in front of any authority or appellate tribunal or high court or supreme court and represent the matter, whether in front of officer or in front of appeals. He is going to represent the matter. Now understand that in this case, client becomes deemed recipient, not the another advocate. We can call it as advocate 1 to advocate 2. Client becomes deemed recipient, not advocate 2. Client becomes deemed recipient, not advocate 2. So you are forgetting the main recipient, you are focusing on the client. So two contracts are merged into one. Actually there are two contracts, but they are merged into one. In such cases, you have to ask a basic question. That business entity which is client, whether that business entity is a small business entity or a big business entity in taxable territory. If it is small, no GST. If it is big business entity, GST will be there. I'll write it as special RCM. Why? Who's paying? This is not paid by advocate 2. It is paid by the client. Now you are removing advocate and you are directly seeing the client. Right. So when you talk about what category? You are talking about a category where you are not bifurcating which type of advocate. You are just telling that it is representation services for a business entity in taxable territory. So there are criteria. First of all, it should be representation services, and that too it should be for a business entity, not a non-business entity. Business entity in taxable territory. If that is the scenario, what will happen? They will forget that advocate 2 is the real recipient. They will think as if client is the deemed recipient. And if clients is a small person, exempt. If the client is a big person, taxable under special RCM. Special RCM means finally for both the contracts put together, you will not treat them as two contracts. You will treat them as single consolidated contract. Who will finally pay? Client will pay under special RCM. Let us call it as special. ICA has never touched it, but a very interesting question. Now, what if we are talking about other cases? Now, your other cases, what are the other services, by the way? Your other services can be representation services to non-business entity or business entity in non-taxable territory, or it can be advisory services, or it can be advisory services. Now, in this scenario, you need to bifurcate whom are you talking about. Whether you are talking about senior advocate to any advocate, senior advocate to any type of advocate, or you are talking about other than senior advocate to another advocate. Other than senior advocate includes firm LLP of advocates or an advocate who is not a senior advocate. Other than senior advocate, firm LLP of advocates to advocate to. Now you have to bifurcate. Now you are required to bifurcate. That bifurcation was not required when you are talking about representation services for a business entity in taxable territory. But if it is representation services for non-business entity or you're talking about business entity non-taxable territory or advisory services, now you don't see the second contract. You see only the main contract. Now no consolidation, no deemed recipient. You see only the main contract. If it is senior advocate to another advocate, you have to see whether that another advocate is small advocate 2. I am focusing on advocate 2, or whether it is a big advocate 2, big recipient, which means previous year threshold limit, the previous year aggregate turnover was more than the threshold limit. In services, the threshold limit will be 20 lakhs or 10 lakhs as the case may be, because the recipient happens to be another advocate. Now, if he is small, exempt; if he is big, taxable. Under normal RCM, who will pay, by the way? When I tell normal RCM, it will be paid by advocate 2. Client is not coming in picture. And finally, if the service was provided by other than senior advocate or firm or LLP of advocates, you need not worry about anything. Whether it is provided to another advocate, whether it is big or small, it will be exempt. Senior advocate to other advocate, you have to see that other advocate is small, exempt; big, RCM. Other than senior advocate, firm or LLP of advocates to any other advocate, don't say anything. Whether the recipient advocate, that is advocate 2, is small or big, forget about it. It is exempt. This is the category. What we did, we made our life simple. First, we understood advocate to clients, arbitral tribunal to clients. Because whatever provision is applicable for advocate to client, it's same applicable for arbitral tribunal to client. Same thing. Now, this advocate to advocate will only peculiar for advocate. It will never come for arbitral tribunal. So, what we did next, we took advocate to advocate. In advocate to advocate, we bifurcated the type of services. If it is representation services, business entity, taxable territory, 2 contracts become 1. Client becomes the deemed recipient. If the client is small, exempt; if the client is big, RCM, special RCM. If it is other services and services provided by other than senior advocate, firm or LLP of advocates, always exempt. If it is provided by senior advocate, if the other advocate is small, exempt; if the other advocate, recipient advocate, is big, under normal RCM, taxable under normal RCM. So that is all about your advocate and your arbitral tribunal. Now next, you are talking about the fourth service, sponsorship services. So when you talk about sponsorship services, only one sponsorship service is exempt. One particular type of sponsorship services exempt. That too, it has got 2 criteria. That sponsorship service should be of a sports event. That too organized by notified bodies. Now, who are all notified bodies? National Sports Federation or its affiliated federation, where the participating team or individual represents district, state, zone or country. Or you're talking about Association of Indian Universities. You be familiar, don't try to buy at it. Inter-University Sports Board or School Games Federation of India or All India Sports Council for Deaf, Paralympic Committee of India, or Special Olympics Bharat. Or you're talking about the organizing notified bodies, Central Civil Services, Cultural and Sports Board. Or it is organized by as a part of National Games by Indian Olympics Association. Finally, promotion of sports in village. You're talking about the organizing committees working under Panchayat Yuva Krida or Khel Abhiyan. If at all, these are all the notified bodies. Try to be familiar with the names. Please don't try to by heart them. Don't try to do this by hearting with the exemption. By heart RCMs. You have to know when RCM is there. Who should be the supplier? Who should be the recipient? You have to be very clear. Very, very clear. Different places, different criterias. At times, recipient should be partnership firm. At times, recipient should be a body corporate. At times, supply should be other than body corporate. Recipient should be a body corporate. At times, supply should be other than body corporate. Recipient should be a registered person. Whether body corporate or not. And you have to by heart. But not this exemption. You be familiar. Be familiar with the names. See multiple times and be familiar with the names. Alright, the moment you see, because these things will be given in the question. All you have to do is recollect and think that okay, whether it was covered in the notification or not. Whereas unlike RCM, you have to be very clear. Okay, this situation, whether it will come in RCM or not. Right. These are all notified bodies. What are the two criteria for sponsorship services to be exempt? One, it is only for sponsorship of a sports event. There can be n number of types of events, but the exemption is only given for not even cultural event. So if you see Central Civil Services, Cultural and Sports Board, there can be a cultural event also being organized, but it should be only a sports event. Second, by notified bodies, the list of 5 notified bodies, then it is exempt. If it is not covered here, then it is taxable, which means what are the two things which will be taxable? Sponsorship of a sports event other than by a notified body, or sponsorship of any other event by any body. Two will be taxable. Sponsorship of sports event not organized by a notified body, or sponsorship of any other event, cultural event, entertainment event, business event, any other event by anybody, when it is under RCM. Understand here, supplier, whosoever it is, not relevant. Who should be the recipient? Recipient should be a partnership firm, LLP or body corporate in taxable territory. See, in all the RCM case, one point will always come. Recipient should be in. You are asking recipient to pay, make sure that recipient is in. Don't try to buy at that point. Obviously, when it is RCM, recipient should be in taxable territory. Recipient should be in taxable territory. What is the criteria? Who should be the recipient? Body corporate, firm or LLP in taxable territory. Then it is RCM. But if recipient is not a body corporate, not a partnership firm, not an LLP, then it is FCM. Other cases. Please understand that supplier may be body corporate, may not be body corporate, not relevant. It can be a case where supplier is body corporate, recipient is not body corporate, partnership firm, LLP. What is the answer? FCM. Supplier is a body corporate, recipient is also a body corporate or a firm or LLP. RCM. Supplier is not a body corporate, but recipient is a partnership firm. Supplier is a body corporate, recipient is a partnership firm. Got that? Supplier, who is he, is not relevant. You focus on recipient. You focus on recipient. Recipient should be either body corporate, partnership firm, LLP. And in sponsorship service, be very clear who's the supplier, who's the recipient. Always remember this thumb rule example. Tata IPL. Who's the supplier, who's the recipient? Tata company or organizers of IPL. Who's the supplier? Organizers of IPL are the supplier. Tata Limited is the recipient. If you go wrong there, then the conditions are all ulta. Your answer is all ulta. Right? Tata Limited is the recipient getting the services of sponsorship. Its name, it's there everywhere in the event. Supplier is organizers of IPL. Who is going to make the payment, by the way? So the person who's making the payment should be. The person who's making the payment should be. Don't forget that. Don't forget this particular point. This is very confusing when it's specifically talking about your sponsorship service. So that is all about your concept of sponsorship service. The lengthiest and the most important of RCM service. What is that? Services by government, not government authority, not government company, by government. By government. Central government, state government, union territory or local authority. Three tier sector. Central government, state government, local authority. By government. By, if services is by government, always remember the simple chart. Services should be by government. By government. Remember the simple thing. You're talking about panchayat related services, Article 243. Article 243 G. Municipality related functions. One, you're talking about panchayat related functions. Panchayat related functions. Municipality related functions. Liquor license fees. Liquor license fees. Panchayat related functions, Article 243 G. Municipality related functions, Article 243 W. Liquor license fees only by state government. Only by state government. Who's the supplier, by the way? Government. Who's the supplier, by the way? If government is supplying these services, PML. If government is supplying these services called as PML, what will happen? No GST. No, not at all supply. Forget about exemption at all. Not at all supply. It does not even fits into the ambit of supply. Levy itself is defeated. Levy itself is defeated. Not at all supply. Second category. PPT. Post. Post. Port, airport related. Transport related. PPT. PPT. Second is PPT. Post, port, transport. PPT. PML, PPT. In PPT. In PPT. You will have different categories. If you're talking about post, the exemption for post is now different. It talks about transport of your postcard, inland letter, PBO, book post and ordinary post up to 10 grams. Sorry, less than 10 grams, or you can write it as up to 9 grams. Less than 10 grams. You're talking about postcard, inland letter, book post and ordinary post. Less than 10 grams. So you're talking about one category being exempt. What is that category being exempt? Less than 10 grams. Transport, you will have exempted category as well as taxable category. If for transport it is exempted for private sector, it is exempted for government. If it is taxable for private sector, it is taxable for government. That you have to see transportation sector. If it is exempt for a private sector, it is exempt even for government. If it is taxable for a private sector, it is taxable even for government. Right. Port, airport related services inside or near the precincts of port or airport. Near the precincts of port or airport. Now understand that PBO, maybe when you talk about PBO less than 10 grams, or when you talk about exempt category of transportation services, these two are not attracting GST. These two are not attracting GST. But when you talk about others, what is others? Postal services not covering PBO less than 10 grams. Transport services, which is taxable category. Port, airport related services given by government inside the precincts of the port or airport or near the precincts of the port or airport. All of them are taxable. And wait, it is FCM. It is FCM. No RCM. It is FCM. Post, PBO, less than 10 grams, exempt. Transport, exempted category, exempt. Other than that, In PPT, everything else is taxable under FCM. When you talk about port, airport related services, there is no exemption. Port, airport related services, there is no exemption. Now, government, first category PML, second category PPT, the final category will be others. The final category will be others. PML, PPT, other services. PML, PPT, other services. PML done, PPT done, other services. When you talk about other services by the government, other services given by the government. Other services given by the government. If other services is given by the government, government to government, government to other than government. If it is government to government, exempt. Government to government, exempt. Government to other than government, no. You have to wait. Then you ask another question, whether it is non-business entity or business entity. If it is non-business entity, exempt. If it is business entity, again you have to wait. You have to ask whether it is small business entity or big business entity, which means previous year aggregate turnover is within the threshold limit or more than the registration is not the criteria. You may be registered, may not be, that's not the criteria. Previous year aggregate turnover. If it is small, exempt. If it is big, again you have to wait. Whether the value is less than, equal to 5,000 or more than 5,000. If it is less than or equal to 5,000, exempt. If it is more than 5,000, no, you have to still wait. Is it covered by specified list? There is a list of 10 items where it may be still covered in exemption. Is it covered by a specified list? If it is covered by, if, or is it not covered by specified list? If it is covered by specified list, exempt. If not, for the first time now it is taxable. For the first time now it is taxable. So government to government, exempt. Government to non-business entity, government to government, exempt. Government to non-business entity, exempt. To small business entity, exempt. Smaller value, less than or equal to 5,000, exempt. Listed items, exempt. If it is not covered anywhere, finally it is taxable. But wait, the answer is not yet over. You have to answer whether it is FCM or RCM. So you have to split that. Whether it is renting of immovable property services or whether it is other than renting of immovable property services. If it is renting of immovable property services, now it is taxable. It is only about FCM, RCM. If it is renting of immovable property services and if it is to registered person, unregistered person. Registered person, unregistered person. If it is other services, the recipient is in taxable territory, non-taxable territory. The recipient is in taxable territory, non-taxable territory. Now, if it is renting of immovable property services and the recipient is registered, RCM. If it is not registered, FCM. If the recipient is registered, then it is RCM. Not registered, FCM. For other services, if the recipient is in taxable territory, now for other services you don't ask whether he is registered or not. You just check whether he is in taxable territory. He may be registered, he may not be registered. It is, if he is not registered, get compulsory registration. Get compulsory registration because of section 24. If it is a non-taxable territory, FCM. It is FCM. So you talk about other services of the government. First understand that in the first two categories, either there is no tax or if at all there is a tax, there is FCM. RCM does not comes in the first category. PML, no tax. PPT, may be exempted if tax, FCM. Others, lot of exemptions are there, and if you cross all the exemptions, you might end up in taxable. But when you are ending up in taxability, ask one more question: is it renting of immutable property? To registered person, RCM. Unregistered person, FCM. If it is other services, recipient in taxable territory, whether registered or unregistered, RCM. If it is not registered, compulsory registration. And if you are talking about recipient in non-taxable territory, FCM. Now, two special changes that you have to make here. The first special change that you are required to make here is, when you talk about this 5,000 rupees, normally it is 5,000 rupees per contract, but it is 5,000 rupees per financial year if it is a case of continuous supply of services. Normally it is 5,000 rupees per transaction, but if it is continuous supply of services, then it is 5,000 per financial year. Now, second, when you talk about small business entity exemption, the small business entity exemption, you are not going to see for renting of immutable property. Which means for renting of immutable property, whether you are a small person or big person, you will not check. Even if you are a small person, it will be taxable. So this exemption is not applicable for renting of immutable. For renting of immutable property, you will not go through this step. You will go through all the other steps. Directly from business entity, you will go to 5,000. You will not ask whether it is small or big. Whether it is small or big, taxability will be that. Beautiful questions can be asked, and I say ask beautiful questions a lot of times. Forget about final. Even at inter level, they have asked this question a lot of times just to check how far you have understood this government services with respect to exemption and with respect to RCM. And if I don't tell this particular sequence, your mind will search for different points in different places. You will not be having a clear-cut idea of how to see, in which sequence to see. And if you know the sequence, it is very simple. You know the sequence, it is actually very, very simple. Again, I repeat, two small points. 5,000 is actually for per transaction, but if it is continuous supply of services, it is per financial year. You have to see entire financial year, is it up to 5,000? Second, for renting of immutable property, you will see all the other exemption, but not whether it is small or big. You will not see the previous year aggregate turnover, whether it is within the threshold limit or whether it is more than that you will not see. Whether you are small or big, there is no difference. For renting of immutable, all other services, that is important, but not for renting of immutable property services. That's all about your lengthy government services. Obviously, the special list items, whatever is there for you to be familiar, you go through once or twice, even including all the other exemptions. You just go through, give a glance. Don't try to buy at them. There's a special list containing 10 points. Go through it. Just give a glance. Keep viewing it. Do not try to buy at it. Just highlight the keywords and be familiar with the exemption. So this particular point I'm not touching. Other than that, we are done with your lengthy government and government services. Lengthy government services. Now, next category, we are talking about real estate sector. Rather, this needs to be clubbed with section 9 for exemption, but nevertheless, we'll only see this particular area where you are talking about exemption with respect to real estate sector under section 9.3 and section 9.3 RCM. Section 9.3 RCM. Now, what is the services that they are trying to cover? They are trying to cover two types of services. TDR, transfer of development rights or flow space index services. Also long-term lease, more than 30 years or 30 years. Long-term lease should be more than equal to 30 years. The payment can be upfront payment or it can be at the time of installment. And this exemption and RCM is with respect to a residential apartment. Whatever exemption we are discussing or whatever RCM we are discussing is with respect to residential apartment where the GST rate happens to be 1% or 5%, affordable housing, non-affordable housing, etc. Rates are not relevant to you. Now, what are they trying to tell? They are trying to give an exemption, and if not, they are trying to give an RCM. So, it is exemption come RCM. What are the services that they are trying to cover? TDR FSI, that is transfer of development rights or flow space index services, or long term lease more than 30 years where there is an upfront payment Not necessarily full lump sum payment is in beginning. It might be made in installment. Circular has clarified that. With respect to residential apartments. With respect to residential apartments. Now please understand this simple concept. If at all there is a residential apartment, there is a builder, there is the owner or the landlord who is giving his place to the builder and he is going to construct a building, and finally you have two buyers. Say let us take Amitabh Bachchan and say let us take superstar Rajnikant. There are two buyers for this particular property, and this happens to be a residential apartment. This happens to be a residential apartment. Because whatever you are discussing in terms of exemption and RCM is only with respect to residential apartment. Now what is happening? In case of, there are basically two contracts. TDR or long-term lease by landlord to builder. Then the construction services by builder to the buyers. That is Amitabh Bachchan and superstar Rajnikant. Now when you talk about the two contracts, first let us name the contracts. The contracts are transfer of development rights or floor space index or long-term lease more than 30 years. Here it may be construction or it may be sale. Now let us assume that Amitabh Bachchan has given advance, partial advance. Superstar Rajnikant did not give any advance. Did not give any advance. No advance. No advance. Now, with respect to, first let us understand the second part of the transaction. First part will be very simple. See the second part of the transaction. This we have already covered when we have seen the levy chapter, basics of GST. Now what will happen? Builder to Amitabh Bachchan, what it is? Builder to Amitabh Bachchan, what it is? It is construction service, which is supply of service, construction of works contract service, supply of service, subject to GST under forward charge mechanism. Builder will collect from Amitabh Bachchan because the moment you pay in advance, builder is working for you. What about superstar Rajnikant? It is sale of land and sale of building. No good. Sale of land and sale of buildings, which is immovable property, which means schedule 3 will be attracted. It is neither supply of goods nor supply of services. Builder to this extent will not pay any GST. Builder to the extent of the flat sold to. Now it is not construction. The flat sold to superstar Rajnikant will not pay any GST. That is the second part of the transaction. The moment you know the first part of the transaction and second part of the transaction, pro rata basis, taxability of the first part of the transaction depends on second part of the transaction. Now you may ask, how to find out when? Time of supply will be later. Time of supply for the first part of the transaction will come later. Taxability of the first part of the transaction is decided by second part of the transaction. In the first part of the transaction, with respect to Amitabh Bachchan, finally builder pays GST. Finally builder pays GST. Finally government will get the revenue. So to that extent, whether TDR or FSI or long-term lease services by landlord to builder will attract GST? No, exempt. Because finally government will get the revenue. To that extent, pro rata basis, you have to do the pro rata calculation. What happens with respect to one more part of the transaction, first transaction? To the extent of the transaction which pertains to superstar Rajnikant, whether builder will pay any GST? No, because it is sale of land and building, immovable property, no GST. Now government tells that, okay, we are not going to collect any GST on the second part of the transaction. Let us collect GST on the first part of the transaction and let it be under RCM. When I tell RCM, who will pay? Builder will pay. Who will pay? Builder will pay. A very simple understanding. Understand the second part of the transaction, first part of the transaction automatically. Oh, just focus on the second part of the transaction. Now you may wonder, how will A landlord know in the beginning? Landlord is not required to know in the beginning. It is a builder who has to pay GST under RCM. If at all it has to pay. So landlord is not at all into picture. Who will take that headache? Builder. Now builder knows what portion is construction. To that extent, no GST on the first part. Builder knows what extent is sale of land and building. When the building is ready, he knows what are the flats which are yet to be sold. Supposing this is 100 flats, 80 flats are sold by getting advance payments. So builder will not pay any GST on TDR, FSI, LTL services to the extent of 80 flats, 20 flats. Building is ready, but 20 flats are yet to be sold. Now builder knows these 20 flats will be sale of land and building, immovable property. I'm not going to pay GST. To that extent, builder would have paid some long-term lease or TDR or FSI services to the promoter. Supposing he has paid 1 crore. Supposing he has paid, we will take that 1 crore multiplied by 20 flats divided by 100. So we will now pay GST on his inward supply only on 20 lakhs. How much he has made the payment to the landlord? 1 crore. He will now make the payment only of 20 lakhs, not on his outward supply, but on his inward supply. That's all about this special RCM and exemption with respect to what? This is only with respect to residential apartments. Residential, this point even gives the rates. See, finally, when builder pays on construction services to Amitabh Bachchan, he is asked to pay 1%, 5%. The same 1%, 5% will be applicable even on RCM. For Amitabh Bachchan, builder is paying under FCM for his outward supply. For superstar Rajnikant, builder is not paying anything under FCM, but builder is paying on under RCM for his inward supply. So if you see the taxability, it goes this way. This is RCM and one is RCM and one is FCM. Now, next simple service. We are done with all the lengthy services. Now, all the services are very simple services. Directorial services. We already covered this. Directorial services. If it is managing director, whole-time director, where there is employer-employee relationship, where the TDS will be under section 192. It is not at all supply. If it is other than managing director, whole-time director, where the TDS will be under 194, J, professional fees, then it will be taxable. It is supply, it will be taxable, but it will be under RCM. Managing director, whole-time director, TDS under 192, not at all supply. Other than managing director, whole-time director, TDS under 194J, professional fees, it is supply. By whom? Director to company. Who will pay GST? Company will pay GST under RCM. Insurance agent having insurance license under section 42 of Insurance Act. Insurance agent. Who is the supplier? Insurance agent. Who is the recipient? Insurance company. Who is the recipient? Insurance company. Who will pay GST? There are thousands of insurance agents. For government, what is easier to catch? Insurance agents or the insurance company? Insurance company. See, the entire objective of section 93 RCM, section 94 RCM and section 95 EQ is to ensure that the liability is shifted from unorganized sector to organized sector. So government will catch hold of insurance company. But it is applicable only if you are having insurance agent license under section 42 of Insurance Act. Big Bazaar, not Big Bazaar, I'm talking about policybazaar.com. If it is having insurance agent license under section 42, then insurance company will pay under RCM. But if policybazaar.com is not having insurance agent license under section 42, technically it is not insurance agent, it has to pay GST under FCM. Next services. In total, we have seen 10 services. Now, next 11th and 12th services. Transfer of copyrights. We are not talking about any intellectual property right. We are only talking about transfer of copyrights. Temporary transfer or permitting the use or enjoyment of copyrights. if transfer of copyrights is with respect to original, dramatical work, musical work, artistic work. Original. That original is very important. Then who will pay GST? Recipient. Who's the supplier, by the way? Music composer, photographer, or the artist. Who's the recipient, by the way? Producer. Music company or the producer located in taxable territory. Who will pay GST under RCM? The music company or the producer in taxable territory. The music producer or the music company or the producer in taxable territory. But that is applicable only for what? Original music. A.R. Rahman to Sony Music. Who will pay GST? Sony Music. Sony Music to Spotify or JioSaavn. Sony Music is giving further copyrights to all your apps that you have, isn't it? How come they play the songs? Further copyright is given by whom? Sony Music to Spotify or Sony Music to JioSaavn. What it is? FCM. It is not about original musical work. It is not about original musical work. Next, we are talking about original literary work, literature works. Who is the supplier? Supplier is the author. Recipient is the publisher in taxable territory. All RCM, 1 point will be common. Recipient should be in taxable territory. Who will pay GST? Publisher. Basically, by default, it is RCM. By default, it is RCM. But if author tells that no, I want to go under FCM. See, that option is not there for original musical work, dramatical work, artistic work. This option is only there for literature work, literary works. So if author wants, he can go under FCM. What he has to do? The conditions, he has to get registration and tell the jurisdictional commissioner that I want to go under FCM. I want to go under, first get registration, go to the jurisdictional commissioner, tell him that I want to go under FCM. I want to go under, this is the condition. Now when he goes under FCM, he has to ensure that he is not leaving FCM for the next 1 year. He should work under FCM for the next 1 year. On all his invoices, he should declare that he has opted under FCM. See, conditions are basically only two. Get GST registration, inform the jurisdictional commissioner that you are willing to go under FCM. That's it. When you go for FCM, you have to take care of certain things. What? Be under FCM for minimum of next 1 year. Second, on all your invoices clearly mention that you have gone under FCM. You have gone under, so that publisher again does not base RCM. Publisher is also aware that this author has opted for, it is just like GTA. Exactly like GTA. By default, it is RCM. If GTA wants, it can go for FCM. If author wants, it can go for FCM. That's it. But here there are extra conditions. Right. So that is all about your temporary transfer of permitting the use or enjoyment of copyrights. Now next few RCM and exemption are with respect to banking sector. Are all with respect to banking sector. So when you talk about your banking sector, if services are supplied by recovery agent to banking sector, banking company, financial institution, non-banking financial company in taxable territory, it is bank who have to pay. Recovery agent to banking sector, RCM. Recovery agent to other companies. The same services of recovery agent services is given to Reliance Limited, or given to Tata Limited, or given to Adani Limited. Then it is under FCM. Then corresponding to recovery agent, you can remember someone called as direct selling agents. The calls that you get every time. Direct selling agents. Now look at the conditions. Here conditions are different. Direct selling agents to banks and NBFC in taxable territory. Financial institutions will not have direct selling agents, therefore FI is not mentioned. So banks and non-banking financial company in taxable territory. But wait, they put an extra condition. This direct selling agent should be individual. If he is individual, then RCM. Banking sector will be under RCM. If direct selling agent itself is a partnership firm or LLP or a body corporate, then FCM. Then this point is not attached to recovery. Recovery agent can be individual or body corporate or partnership firm, anyone. Giving to bank, bank will pay. But direct selling agent, if it is individual, only then it is RCM. If it is not individual, then it is FCM. Then it is FCM. Clear cut difference. I said some time back that you need to buy out, remember exactly when RCM, when FCM. The condition keeps differing. The condition keeps differing. Then you're talking about your members of overseeing committee, a special committee of RBI to RBI. Members of overseeing committee, a special committee of RBI to RBI. RBI will pay under RCM. If it is members of any other committee of RBI, FCM. If it is members of any other committee of RBI, FCM. Members will pay GST on their professional fees. But if it is members of overseeing committee to RBI, it is RCM. It is RCM. Then you have something to do with business facilitator, business correspondent. Here you have got exemption as well as RCM. First, let us understand the exemption. Please remember that business correspondent and business facilitator in a very simple way. Business correspondent is very similar to your banking sector, bank or insurance company. It will just represent the banks and insurance companies. Technically, they are not employees of banks and insurance. They have more responsibilities. They will talk to you as if they are employees of banks and insurance companies. Business facilitator correspondingly will have lesser functions. Lesser functions. Now, if at all you are talking about business correspondent or business facilitator, if they are providing services to a banking company in rural area, or if they are providing services to insurance company in rural area, which means rural branch of the bank or rural branch of the insurance company, then their services is exempt. Their services is exempt. No GST. Not only that, if they are taking the help of agents in that rural area to provide their services, if it is with respect to banking company in rural area, which means agent, if at all I am the business correspondent, I go to village, I know that I cannot talk to village people directly, they will not entertain me. So I appoint some agents in villages. I go to the panchayat and I tell that, see, I want to inform about the benefits of these banking schemes and insurance schemes. If I go directly, they may not entertain me. And I may not be able to communicate with them properly. The language issue might also be there. So I'll be having some agents within the villages to whom I tell them, you do this work for me, I'll pay you. Right. So agents to business correspondent, business facilitator. If it is in relation to banking company in rural area, it is exempt. But if it is in relation to insurance company in rural area, unfortunately it is not exempt. Logically speaking, this should also have been exempt, but unfortunately this is not covered by exemption. If you look at it, BCBF to bank in rural area exempt, agent to BCBF in relation to bank in rural area exempt. Both main contract as well as subcontract is exempt. But for insurance company in rural area, main contract is exempt, subcontract is not exempt. Not logical, but this is how it is. This is how it is. Might be I'm expecting an amendment to come, but I was expecting long time back. Till now I have not seen any amendment. So when they amend it, might be they'll realize that okay, this is not logical when you compare to banks and insurance. And this illogical point does not come only in exemption. We'll find that in even RCM. This is all about exemption. Now we have to yet to see when it is FCM, when it is RCM. If it is exempted, we will not be discussing about FCM, RCM. Clear? We are discussing FCM, RCM only when it is taxable. So you're talking about a business correspondent to a bank, agent to business correspondent, agent to business correspondent, insurance, agent to business facilitator to bank, agent to business facilitator, insurance company. These are all permutation combinations which are possible. Correct? These are all the permutation combinations which are possible. When it is business correspondent, I said you remember one thing, they have got a bigger role. If it is business facilitator, always remember that they have got a smaller role comparatively. So this will help you to remember FCM and RCM. If it is agent to business correspondent will pay under RCM because it is a big person, it will take the headache. And business corresponding to banking sector, FCM. The same thing is true with agent to business correspondent with respect to insurance company. Business correspondent will be under RCM. Business correspondent to insurance company, it will be under FCM. If you look at this, business correspondent is taking the entire, neither the agent is disturbed nor the banks or insurance company is disturbed. Obviously, it will collect the GST from banks and insurance company, needless to say that. But liability or responsibilities of that of business correspondent. But, when it comes to business facilitator, if it is agent to business facilitator, whether business facilitator will take the headache of agent? No. It will tell that I am myself a small person, you take care of yourself. FCM. Agent to, business facilitator to bank. Business facilitator will tell that, see, I am a small person, please help me out. So bank will come. Business facilitator is not at all disturbed. For its inward supply, agent will collect GST and pay if at all agent is registered. Understand that agent might also take the benefit of registration limit of 20 lakhs, 10 lakhs. Don't forget that. Agent can also always go for registration limit of 20 lakhs and 10 lakhs. So we are not discussing the registration limit, by the way. Taxability is that, and it is under FCM. And same way, if it is agent to business facilitator with respect to insurance company, it is under FCM. Don't you think that even for business facilitator, insurance company should have helped just like banks? But here, this time, there is no help. There is no help. Business facilitator has to get registered and pay GST under FCM. Right? I see I have tested this, whether it is FCM and RCM. So when you talk about business correspondent, there is no change, whether it is with respect to banks or insurance. Agent to business correspondent, RCM. Business correspondent to banks or insurance, FCM. But when it is with respect to business facilitator, agent to business facilitator, FCM. Business facilitator to bank, RCM. Agent to business facilitator, FCM, but business facilitator to insurance company, logically it should have been under RCM, but it is under FCM. It comes under your FCM. So that is all with respect to your services under banking sector. RCM as well as one exemption which was there with respect to BC and BF, that also we have covered. Security services. Understand that security services, there is no exemption. Now, do one thing, have a comparative analysis of security services and renting of motor vehicle services designed to carry passengers, where obviously cost of the fuel will be included. Normally, when you go for renting of motor vehicle designed to carry passengers, it will include even the cost of the fuel. That's a normal understanding. Now, what happens in case of security services? Security services, it is under RCM if supplier is other than body corporate, recipient is not body corporate. Recipient may be body corporate, may not be body corporate, but recipient should be registered. It doesn't stop here. He should be registered, but he should not be a composition scheme taxable person. He should not be pure TDS deductor. So if you have seen this pure TDS deductor elsewhere, GTA, but wait, that was with respect to exemption. This is not with respect to exemption. This is telling that RCM will not apply, FCM will apply. RCM will not apply, FCM will apply. This has got nothing to do with your exemption. It has got to do with your FCM. HCM. So what is the criteria? Criteria should be, supply should be other than body corporate. Recipient, if at all your recipient is registered but under composition scheme, or registered but pure TDS deductors, only and only TDS number, government having only TDS number, or if at all you are talking about unregistered person, or registered having normal GST number, registered having, even government can have normal GST number, government can have TDS number as well as normal GST number. What will be the answer? In the first case, FCM, second case, FCM, third case, FCM. Only and only in the last case it is. By the way, we are talking about what type of services? What if I tell supplier is a body corporate and the same customers are there? Supplier is a body corporate. What if I tell supplier is a body corporate? What will happen? The moment supplier is a body corporate, all the cases will go under same. All the cases will go under your FCM. All the cases. Now compare this with your renting of motor vehicle designed to carry passengers. Designed to carry passengers. You're renting a motor vehicle designed to carry passengers. There, they make your life very simple. They just tell that supplier, they put extra conditions by the way, supplier should not be a body corporate. That is true. And should not charge 12%. Should not be a body corporate, should not charge 12%. Wait, recipient should be a body corporate in taxability. Recipient should be a, now recipient may be registered, may not be registered. Recipient may be registered, may not be registered. May be registered, may not be registered. But it should be a body corporate. It should be a body corporate. Now when you compare that, supplier 1 is not a body corporate. Supplier 2 is a body corporate. Well, let us bring supplier 3, not a body corporate. Supplier 3 also. Supplier 3 not a body corporate. Supplier 1 is charging GST at 12%. Supplier 2 is not charging GST at 12%. Now what are the types of recipient they have? What are the types of recipients they have? What are the types of recipients they have? No registered at all. Nothing to do with registration now. You categorize them into recipient being body corporate, not body corporate. They may be registered, they may not be registered. Not relevant. Obviously, when I am talking about recipient, they should be in taxability. That is needless to say. Now, tell me, out of this 6 cases, what is under FCM and what is under RCM? Supplier, if it is a body corporate, a supplier, if it is not a body corporate, but charging GST at 12%, what will happen? What will happen? When I am writing FCM, I will always write near supplier. RCM is always written near recipient. If supplier is a body corporate, what will happen? FCM. The supplier is a body corporate, FCM. Supplier is not a body corporate but charging 12%, FCM. Supplier is not a body corporate, not charging 12%, giving to other than body corporate. Giving to other than body corporate. Recipient is also not a body corporate. Supplier is a partnership firm, recipient is a partnership firm. Recipient is also not a body corporate. FCM. Supplier is not a body corporate. Recipient, supplier is not charging 12%. Recipient is a body corporate. Only this will have RCM. Only this will have RCM. Supplier 1 always will have FCM. Supplier 1 always will have FCM. Supplier 2 will have always have FCM. Whereas supplier 3, for few transactions it will have FCM because recipient is also, for few transactions it will have FCM because recipient is also not a body corporate. For few transactions it will have RCM. So you can have a lot of such cases. Rather, even if you take previous example, security services, supplier was not a body corporate. For few transactions, supplier 1 had FCM. For few transactions it had RCM. Supplier 2 always had FCM because supplier 2 was a body corporate. Now, you will clearly understand that you are required to remember when RCM, when FCM, who's the supplier, who's the recipient. Gone are the days when you just see some YouTube lecture and try to buy out the names. Renting of immovable property. Renting of immovable property will also come, by the way. They're talking about renting of motor vehicle, security services, advocate services. Utter waste of time. No use in remembering all these terms because the moment I change the question, the answer differs. Rather, in these two examples, in the first example, there are totally 8 cases, out of which only 1 case was RCM. In the second case, scenario, there were totally 6 examples, out of which only 1 was under, rest all was under FCM. Don't try to buy out the name and tell that, okay, I know RCM service. These are all the lists. No, that's no use. Yes, in this list, remember who should be the supplier and who should be the recipient. Are we clear with this understanding? Now, if you remember, while discussing something else, we have discussed about your security lending scheme. I said that I am the lender of security and Praveen serves as borrower of the security. So, when you talk about security lending scheme, what will happen? Lender and borrower may not know each other. What is security lending scheme? I have shares in my hand and I am not interested in selling in the near future. There is a person who is interested in doing short-term trading. I am a long-term investor and he is doing short-term trading. So I tell that, okay, take my shares, give me some lending amount. You do short-term trading. Supposing it is for 3 months. After 3 months, I will get back my shares and that will be taken care by the stock exchange. I will never ever know who is the borrower. Never. I will never ever know who's the borrower. Right. And that is the reason it is covered under RCM. Why? If I don't know my recipient, how can I give an invoice to my recipient? So what they do? Better put it under RCM. Borrower will pay. Borrower knows what amount he is paying. Because borrower will make the payment to stock exchange and stock exchange will finally give me my payment. Correct? So, I am not at all worried. Lender will not pay, borrower will pay because both of them are not aware of each other. Both of them may meet each other daily but they are not aware of each other, that who's the lender and who's the borrower. RCM. And one other special point that we have already discussed. This will always be IGST transaction. Though the lender and borrower may be in the same state, same city, same building, but always it will be IGST. Always it will be IGST. And the next category of services, you are renting of residential dwelling. Renting of residential dwelling. So when you talk about your renting of residential dwelling, if renting of residential dwelling is there and if it is for residential use, now they are categorizing them into 2. You have to categorize them into 2. Whether this renting of residential dwelling is taken by a registered person or unregistered person. Registered person, unregistered person. Or it can be even other category. Let us make it more clear. Renting of residential dwelling used as residence, not used as residence. If it is renting of residential dwelling, not used as residence, it is always taxable, that too under FCM, need not see anything else. Classic example, CA offices, lot of CA offices you will find that it is a house, renting of residential dwelling but not used for residence, clearly taxable under FCM. What if it is renting of residential dwelling and used for residence? Used for residence. Then you have to categorize that into two parts. Ask yourself whether the recipient is a registered person or whether the recipient is unregistered person. Whether the recipient is registered person, whether the recipient is unregistered person. If the recipient is registered person, it is taxable and it is taxable under RCM. If it is by unregistered person, exempt. So when your renting of residential dwelling is exempt, renting of residential dwelling is exempt subject to two criteria: used as residence and by unregistered person. Can you tell me what would be the scenario where renting of residential dwelling is there used for residence by a registered person? Guest houses, staff quarters, employees. By company there is a guest house, staff quarters. These are all examples which will be covered here. A company is taking a residence on rent used for residence by its customers or suppliers or for employees in terms of staff quarters. This will be covered here. It is taxable under RCM. Taxable under RCM. At the same point of time, they clarify. They clearly give clarification because it will be very much relevant and it is very logical clarification. If at all it is a sole proprietorship concern. If at all it is a sole proprietorship concern, if it is registered. Actually, we are done with this exemption in RCM. We are talking about a clarification. If at all it is a sole proprietorship concern which is registered, that sole proprietor has taken two places on rent. One, his house on rent. One, guest house on rent, which is for business purposes. House on rent is for his family, personal use. They clarify and they tell, okay, this house on rent will not be taxed. We will not treat you as registered person for this purposes because it is for personal use. And this guest house on rent or staff quarters on rent, which is for business purposes, which you are claiming it as business expenses even in your income tax. This will be taxable under RCM. Why this clarification is given? Because sole proprietor will have GST number based on his PAN. He will not have two PANs and all. That's the same PAN. That's the same PAN. Now when he has taken two houses on rent, one is house for his family, one for staff or guests of business, which means business purposes. You have to bifurcate. That house which you have taken for your family, it is personal use, got nothing to do with your registration status. We'll still treat it as exempt. We'll still treat it as exempt, no GST. But that guest house which is for business purposes or staff quarters which is for business purposes, if you compare, the house rent will not come under expenses in your profit and loss account. It will go to drawings. The staff quarters rent and the guest house rent which is for business purposes will go to your expenses in your profit and loss account. That is for business purposes. That will attract RCM. That will attract RCM. So that they have clarified. So this is all about your RCM with exemption. The last and the final part being your importation of services. Last and the final part being your importation of services. In importation of services, you need to correct this point. Services provided by RBI from outside India in relation to management of foreign exchange reserves, it was exempted earlier. It was exempted earlier Now you don't have that particular exemption. Now that particular exemption is not that. It was exempted earlier. Now it is taxable. So remove this particular point. Now how to make your importation of services simple? How to make your importation of services simple? Strictly speaking, importation of services needs to be divided into 3 categories. But we will divide that only into 2 categories for a very simple reason that third category deals with transportation of goods by vessel at the time of importation of goods, which is overruled by a Supreme Court judgment in case of Mohit Mineral. So we are not going to discuss that third category because now it is being overruled. So now we are not going to discuss that third category. We will divide this into 2 simple category. One normal, one OIDARS. Online information and database access and retrieval services. Online information and database access and retrieval services. One normal and one special. In normal, there is a particular list. And then you have balance category. Then you have balance category. There's a particular list which is always exempt. What is that list? See, importation of services, make one thing very clear. There are 3 conditions which are satisfied. Location of supplier outside India. Location of recipient in India. Place of supply in India. So that is satisfied. That you have to be very, very clear. That is the definition of importation of services. Supplier outside India, recipient in India, place of supply in India. Now, that particular list contains, if at all importation of services is by section 12A, AA or AB entity for charitable purposes, it is exempt. It is exempt. If importation of services is of online journals and periodicals by colleges, category B educational institutions. There are 3 categories of educational institution. Category A, category B, category C. We are only talking about category B. We are only talking about category B. First category is preschool education or education up to higher secondary school or equivalent. Second is education for obtaining a qualification recognized by law for the time being in force. Third is skill development courses. So you're talking about second category. Category B. Category B. Third, royalty or license fees which is already subject to customs duty. If it is already subject to customs duty, again GST will not come, which is already subject to customs duty. Fourth, you are talking about your import by United Nations or international organizations. Import by United Nations or international organizations for official use. Fifth, import by foreign diplomatic mission or consular officers or their diplomats or their officers for official use as well as personal use. Either by the embassy or their employees. Either by the embassies or their employees. Official use or personal use. This list will not attract GST. Import by 12AA or 12AB for charitable purposes. Online journals and periodicals by category B educational institutions. That is, I have written it as colleges. Category B educational institutions. Colleges or your universities or even your professional courses. So better I'll write category B educational institutions. Category B educational institutions. Royalty license fees if it is already subject to customs duty. United Nations international bodies for official use. Import by foreign diplomatic mission, carrier consular officers, that is embassies and their employees, diplomats and the officers for official use or for personal use. It is exempt. Balance category. Balance category. If it is not covered anywhere here. If it is not covered anywhere here. Now why I am writing this as balance category? Because OIDRS categorization is just like this. Directly balance category. Now in balance category, You have to ask yourself a question whether it is for non-business entities or business entities. In OIDRS language, this non-business entity is called as non-taxable online recipient. Roughly, it is nothing but non-business entity which is not registered. Same thing, it's non-business entity. You see the meaning of non-taxable online recipient, it means you're not talking about a business entity. You're not talking about a business entity. Same thing, same thing. Technical word is non-taxable online recipient for OIDRS. It is a recipient which is non-taxable. Why it is non-taxable? Because it is not doing any business activity. Non-business entity. And you are talking about business entity. To be very specific, this non-business entity as well as non-taxable online recipient is defined to include government or individuals. It covers both government as well as individuals which are getting these services not for business, not for profession, not for commerce, not for industry. It does not only covers individuals, it also covers government. Government or individuals, and exactly you will find the same in both the places. Non-business entity is not defined, but the conditions are defined. Whereas non-taxable online recipient is defined. And how it is defined? Government, individual. Not using for business, profession, commerce or industry. Finally, net effect, you understand that they are talking about the same thing. They are talking about the same thing. Now, what is the difference? If it is normal import of services, if it is normal import of services, OIDRS import of services is different. Normal import of services imported by a non-business entity, exempt. But if it is normal import of services imported by business entity, it is taxable under RCM. Normal import of services by non-business entity, exempt. By business entity, taxable under RCM. If it is not registered, compulsory registration under section 24. Now, for OIDRS services from a person outside India. How I have decided that this OIDRS supplies outside India? Why not in India? If it is in India, it is not importation of services. If it is in India, technically it is not importation of. So it is only a question of FCM. If I tell it is importation of services, it is clearly implied that supplier is outside India. Recipient is in India. Place of supply is in India. If it is supplied to non-taxable online recipient, classic example, all the apps that you are using. At times there will be paid apps. We may not download it, but there are paid apps which will pay. Supplier is outside India. Supposing the app creator is outside India, you are the recipient. Will GST be there? Yes. No exemption. No exemption for OIDRS category. But GST will be there and GST will be paid by whom? Supplier of OIDRS who's sitting outside India. You're asking someone who's sitting outside India to pay GST. For that reason, the registration process for OIDRS is simple. Normal you can take one state, one registration, but for OIDRS is full India, one registration. They are not required to file normal returns. They are required to file a simplified automated return, GSTR 5A. Everything is simple for them because they are persons who are actually outside India. What if it is OIDRS services, importation of services by a business entity? By a business entity, it is the same. Taxable under. Don't you think that few apps will be downloaded or paid by architects, interior decorators, engineers, which is for business purposes? Why go to them? Even by professionals like us. Correct. When we are entering into the world of artificial intelligence, don't you think that there will be a lot of paid apps helping us out to do it? Why not take any other example? I'll take our examples. For our academy, we have taken 3-4 apps. They're all paid apps. For storage purposes, we have Backblaze. Right. For PDF alignment purposes, we have I Love PDF. These are all paid apps. All of them are paid apps. When we record these expenses, what we have to do? This is all RCM. This is all RCM. That's a Bunny CDN app. So even within our academy, we have 3-4 apps which are all paid apps, which are all outside here. This recording which is happening are all paid apps. When you're all talking about paid apps, what will happen? The creator may be outside India. This is all OIDR services outside India. Imported by whom? Business entity. Business entity. Therefore, it will be under RCM. It will be all under RCM. Clear? Are we guys clear with this understanding? There is no difference to the extent of import of normal services by business entity, OIDR services by business entity, because both are covered under RCM. The difference lies where? If import is of normal services by non-business entity, it is exempt. But if import is of OIDR services, online information database access and retrieval services, by a non-business entity, technically called as non-taxable online recipient. It's nothing but non-business entity, then it is not exempt. It is taxable. That too, it is taxable under FCM. Who will pay? A person who's sitting outside India is required to pay to Indian government. Is required to pay to Indian government. So that is everything about your importation of services. Make your life simple. Split it. Normal OIDRS. Is there any third category of importation of services? Yes. There's a third category. Even in your text, you can remove that particular third category. That third category as of now is not relevant. Why? This third category as of now is not relevant. The third category is given separately on the next page. On the next page, you will find a note. Supreme Court in case of Mohit Minerals have said that this entry is not valid, therefore no GST. You'll find that in the next page. There's a third category of special importation of services. So there's one normal, two special. Normal we have discussed, one special we have discussed OIDRS, there's another special. Importation of transportation services when transportation is by way of vessel at the time of goods being imported in India. But that has been overruled by Supreme Court. It has been said that this entry is ultra virus. The act, it is ultra virus. You cannot ask a third person. It's neither the supplier nor the recipient. So you are not required to see this particular entry. Now, if you see the total number of entries that we have seen, 23 in effect. 21 were already covered, which were applicable both for CGST, SGST and IGST. Importation of services only with respect to IGST. In importation of services, two categories, normal and OIDS. Now, if you see all these 23 entries, what we have done, we have made sure that we have linked your corresponding exemption and RCM, which also makes your exemption division very simple. Now you know that exemption need not be by-hearted, RCM needs to be by-hearted. You have to be very clear. Balance exemption which is not covered, just give a glance, don't try to by-heart it. Give a glance and understand the logic and close it. The moment you start by-hearting the exemption entries, life will be very, very difficult. You will find the exemption huge. But if you are giving a glance, unlike your RCM, you are not required to remember exemption entries. You are just required to see whether this entry was there in the exemption or not. If this, it is exempted. If no, it is not exempted. RCM, it will specifically remember when RCM and when FCM. So that is all about your RCM read along with your exemption. First, we'll start with the section 9.5 where you're talking about supply through electronic commerce operator of notified services where neither supplier will pay tax nor the recipient will pay tax. It will be paid by the electronic commerce operator. What is electronic commerce? Electronic commerce means supply of goods or services including digital products over your digital or electronic network. Supply of any goods or services including your electronic digital products which is over your electronic or digital platform or network. Now, what is electronic commerce operator? You're talking about the websites or platforms. Any person who owns, operates or manages digital or electronic facility or platform for doing electronic commerce. In simple language, websites and apps through which business is being done. It is not necessary that Business is done for other persons. You can do your own business. A company can have its own website and do it. But in that case, supply is not through eco, supply is directly by eco. What is covered in section 9.5? So when you talk about section 9.5, read along with notification 17/2017 city rate and 14/2017 IT rate. Section 9.5 talks about supply through eco of notified services. Supply through eco of notified services. What are the notified services? Earlier 3 were there, now there are 4. First, passenger transportation service, accommodation service, housekeeping service, and restaurant service. These are all the notified service where if the supply is made through eco. We are not talking about by eco. Where the supply is made through eco, neither the supply will pay tax nor the recipient will pay tax. Tax will be paid by the electronic commerce operator. It will take the responsibility of paying the tax and it has to fulfill all the compliances, be it registration, payment, return filing, documentation, etc. etc. Now, when you talk about passenger transportation service, we are talking about passenger transportation service by way of radio taxi, where you have two-way radio communication with a centrally controlled office, either through GPS or GPRS, or you're talking about motor cab, where you're talking about passenger capacity up to 6 or 1 to 6, excluding the driver. You're not counting the driver. 1 to 6 other than the driver. Or you're talking about maxi cab, which is the next version where you're talking about excluding the driver, you're talking about 7 to 12. 7 to more than 6, but up to 12. 7 to 12 excluding the driver. Or you're talking about your motor cycle, which means your two-wheeler. So your Rapido and all will come here. Your two-wheeler, where it is a two-wheeled motor vehicle, including any detachable sidecar, which nowadays you don't find, but if at all it is having, including that as well having an extra wheel. Then they go to the extent of even covering your omnibus and any other motor vehicle. Again, if you see omnibus, they're talking about more than 6, excluding the, which means now there's no limit. It is an extended version. It is not only maxi. Maxi cab is 7 to 12. Here they are telling that 7 to any number, omnibus. And if not, that was not sufficient, they go to the extent of telling any motor vehicle. What will happen in motor vehicle? It will not include a special type vehicle which is used within the closed premises, or vehicle whose engine capacity is up to 25 cc. Other than that, every type of motor vehicle is covered with an engine. Put in a simple words. Be it booking a bus through Red Bus, booking a cab through Ola or Uber, booking a two-wheeler by Rapido or any other such app, everything is covered. Everything is covered. So if the supply is through Red Bus or Ola, Uber or Rapido, neither the supplier will pay GST. Supplier is someone else. Supplier is the owner of the bus. Supplier is the owner of the car. Supplier is the owner of the two-wheeler. Neither the supplier will pay GST nor the recipient. It will be paid by electronic commerce operator. This has been extended. Initially only 4 things are there. Now this has been extended. They have not stopped at your motorcycle. They don't go to the extent of omnibus, even your any other motorcycle. So that is the first part, which basically means if at all you are booking passenger transportation services through any apps, that passenger transportation services can be that of bus through Red Bus, car through Ola, Uber, or a two-wheeler through Rapido. Don't worry. Neither the supplier is going to pay GST nor the recipient. It will be the third party, that is electronic commerce operator. Electronic, and the supplier need not worry to get registration. Why? Supplier will always have the same type of services of transportation through Ola, though his turnover may cross, because it is service 20 lakhs, 10 lakhs, he need not worry about registration, because the responsibility of taking registration, payment, return filing, documentation is taken by care by the electronic commerce operator. Now you're talking about accommodation service and your housekeeping services. We'll read this together because the language of both of them are same. Now when you talk about accommodation services, accommodation where? Accommodation in hotels, inns or any other commercial place meant for residential or lodging purposes. Housekeeping services such as plumbing, carpenting, etc. which is done through ego. Say for example, classic example is Urban Club. Accommodation services, classic example is say Make My Trip or Trivago or any such app. You're using the app. Now what are they trying to tell you? If at all you are booking accommodation services through an electronic commerce operator, or if you are booking housekeeping services through electronic commerce operator. But wait, there's a catch here. Subject to that category, where you're telling that these people, the person who's supplying that service, that is hotel is not liable for registration. If hotel is liable for registration, hotel will pay GST. The carpenter or plumber should not be liable for registration. If carpenter or plumber is liable for registration, which means if their turnover itself exceeds 20 lakhs, 10 lakhs, as the case may be, we are not touching 40 lakhs because it is for goods. 20 lakhs, 10 lakhs, as the case may be, then they will pay GST. In simple language, there are two criteria here. Supplies of accommodation services through eco, supplies of housekeeping services through eco, and the supplier is not liable for registration under section 22. Supplier is not liable for registration under section 22. In that scenario, what will happen? Who will pay GST? Who will pay GST? It will be eco. What if you're talking about a hotel who's liable for registration under section 22? You're talking about a carpenter plumber who's liable for registration under section 22. Section 95 will not apply. Eco will not pay GST. It is the supplier who has to collect and pay GST forward charge mechanism. Forward charge mechanism, not 95. It will go under the default mechanism, forward charge mechanism. And finally, you're talking about your restaurant services. The last addition which was there in the list of 95, supply of restaurant services, but here also there's an exception. Other than supply of services supplied by restaurant located at specified premises. Now, what is that specified premises? That specified premises is premises where they are having restaurant cum accommodation, and the declared tariff value of even a single room, even a single unit of accommodation means single room exceeds 7,500 per day per room. What are we trying to see? We are trying totally three categories. Pure restaurant, restaurant with accommodation, where all the rooms prices are less than or equal to 7,500. Restaurant with accommodation where at least there are few rooms where the declared tariff value, not the actual charges, declared tariff value is more than 7,500 per room per day. In the first two cases, it will be covered in eco category. In the first two cases, it will be covered in eco category. Supply will not pay. Electronic commerce operator will pay. So if the hotel is if the restaurant is a pure restaurant, supplying through Swiggy or Zomato, who will pay GST? Swiggy or Zomato. If there is restaurant and accommodation, there is a hotel plus restaurant. Lot of hotels will have restaurants. Hotel plus restaurant. What will happen then? You have to check whether there is any room whose declared tariff value is more than 7,500 rupees per day per room. If there are no such rooms, then supply of food through the restaurant within the hotel where none of the room has got any tariff value which is more than 7,500 per room per day, no need to worry. Again, Swiggy Zomato will pay. But if there is a restaurant within a hotel where there are at least few rooms, at least a single room whose declared tariff value is more than 7,500 rupees per room per day, finished. And there is no eco, who will pay GST? That restaurant cum hotel will pay GST. See, if you talk about the second category of hotel cum restaurant, where none of the rooms are having declared tariff value more than 7,500 per room per day, for restaurant supply through themselves, they will pay GST. For accommodations, they might have to pay GST. And for supply to Swiggy Zomato will pay GST. Very interesting things will come. There can be 4 supplies for that hotel cum restaurant. Assume for the time being, just to make sure that you are seeing the extreme case, hotel cum restaurant where they They are not liable for registration. Their turnover is less than 20 lakhs, 10 lakhs. Therefore, they are not liable for registration. Let us take an extreme case. And if it is more than 20 lakhs, maybe some changes in answer will be coming. Right. Now, they can have multiple services. By the way, they are not liable for registration. They have not used whether you are registered or not. They are not liable for registration. We are assuming that it is not registered. Right. If the supply is of hotel rooms, of restaurants. Right. Hotel rooms on their own. Hotel rooms through electronic commerce operator, say Trivago. Restaurant, direct supply from the restaurant, and restaurant through, say, Swiggy, Zomato. That is, you're talking about through electronic commerce operator, Swiggy, Zomato. Now, in this case, what will happen? On their own portion, they are not going to pay GST. Why? They are not liable for registration, and we are assuming that they are not registered. We are assuming. What about hotel rooms? Who will pay? Eco will pay. Section 9.5. Trivago will pay. What about restaurant? Through Swiggy, Zomato? Who will pay? Swiggy, Zomato will pay. Section 9.5. Section 9.5. If I change this entire thing and I tell that there is a hotel cum restaurant. In the first two cases, we are talking about rooms, and here you are talking about food. I change this a bit and I tell that its turnover is more than 20 lakhs or 10 lakhs as the case may be, and it is liable for registration. We are assuming that it is registered. As it is liable for registration under section 22, we are assuming that it is registered. Now, again there is rooms and again there is food. What about the rooms? And what about the food? Rooms on their own through Eco, say Trivago. Food, directly people are coming and having the restaurant in their premises, or through Eco, Swiggy, Zomato. Rooms on their own, they have to pay GST. Even if it is through Eco, they have to pay GST. FCM. In both the cases, it is FCM. But when you talk about food on their own, they have to pay GST under FCM. But if it is through Eco, that is, you're talking about Swiggy, Zomato, in that scenario, it is section 9.5. Eco will pay, Swiggy, Zomato will pay. Swiggy, Zomato will pay. Right, so, and by the way, in both the cases, we have assumed that rooms, not even a single room, not even a single room declared tariff value is more than 7,500 per room per day. There is no such rooms. There is no such. Now you can take it to the next level and keep changing and get new answers. Right. So that is all and all about your section 9.5 electronic commerce operator. Yes, when you talk about your time of supply, the only job of this chapter, time of supply, is to find out when to make the payment, liability. This will decide your due date of payment and due date of return filing. If time of supply happens to be, say, 10th of April for a particular transaction, it means that it has to be reported in the month of April, and the due date of that is normally 20th of May. So time of supply will freeze your liability. Without knowing your time of supply, you will never have your due date of payment and due date of return filing. So it will freeze your liability. The objective of time of supply is to freeze your liability. For a transaction, there can be multiple dates, but you have to select one date or at times even multiple dates for different small amounts and freeze your liability. For goods, time of supply is discussed in section 12, and for services, time of supply is discussed in section 13. And when you talk about a special scenario where there's a change in rate of tax, time of supply for both goods and services is discussed in section 14. Now first we'll go with your section 12. We'll see section 12 and 13 together for goods and services by way of a comparative analysis, so that easy revising is clearly possible. So when you talk about your goods or services, time of supply, be it section 12 or be it section 13, you have to divide that into 5 categories. Time of supply in case of FCM, in case of RCM, in case of voucher supply, in residual cases, and time of supply for interest on delayed payment of consideration. When you talk about time of supply in case of FCM and RCM, the answer is different for goods, the answer is different for services. But when you talk about your time of supply in case of voucher supply or residual cases or interest on delayed payment of consideration, the answer is same both for goods as well as service. There's no difference. So first we'll go with time of supply in case of forward charge mechanism. In case of forward charge mechanism, it is the only case where you have to work out 2 steps to find out the time of supply. Step number 1 is your due date of payment. The due date of invoice, which is based on your section 31. It is not taken from your section 12 or section 13. Due date of invoice, which is having its roots in section 31. And step number 2 is finding out time of supply either based on section 12, which is for goods, or based on section 13, which is for services. So in forward charge mechanism, unlike all the other cases, you will be having to, you have should work out 2 steps. One, where you're talking about your due date of invoice, that should be the first step. Whether the question is asking or not, that should be the first step. What is the due date of invoice? Second, your time of supply. Second, your time of supply. Right. So due date of invoice is taken from your document chapter section 31. What is the due date of invoice? And that is also different for goods and services. What is the due date of invoice for goods? So first we are focusing on your first step. First we are focusing on your, we are not saying time of supply. What we are saying is due date of invoice. What is the due date of invoice for goods? Normal scenario. There is supply of goods. There is supply of goods which involves movement of goods. Supply of goods which involves normal scenario. You go to any shop, there is supply and there is removal of goods. Then what is the last date for raising the invoice? No breathing time for goods. Immediately. On or before removal. On or before removal. At times there is supply but there is no movement. At times there is supply but there is no movement. The goods are there itself but there is a supply. In that case, the due date of invoice is on or before constructive delivery. On or before constructive, when the ownership has been handed over to the recipient, that is constructive delivery. Normally 99.99% it will be supply along with movement. What is the last day to raise the invoice? Immediately, on or before removal. At times there will be supply of goods but there is no movement. Already the goods will be in the same place or already the goods are with the recipient. Either the goods will remain in the same place or goods are actually with the recipient. Then on or before delivery, which means when the ownership actually is transferred immediately. Again, no breathing time. But there is a special case where the goods are removed on sale of approval on sale on approval basis. Then there is a special time. They give you 6 months time. Invoice has to be raised within 6 months from the date of removal or actual supply, whichever is earlier. Please understand there is a hidden deemed supply. If there is no acceptance or rejection within 6 months, it is deemed to be supply. It is deemed to be supply. So invoice have to be given within 6 months from the date of removal or actual supply, whichever is. If it is accepted within 6 months, no issues. Invoice will be given. If it is rejected within 6 months, no issues. Invoice will never be given. The issue is if the acceptance or rejection happens after 6 months, immediately on 6 months you have to give invoice, deemed supply. Deemed supply. And finally, if it is rejected, again give credit note. You have raised the invoice, now give credit note. But finally, if it is accepted, no worry, you have already raised the invoice.
If it is accepted after 9 months, you have already raised the invoice at the end of 6 months itself. So you need to understand as a concept of hidden deemed supply. If there is no acceptance or rejection within 6 months, it is deemed to be supply. I'll repeat all the 4 possible scenarios. Accepted within 6 months, no worries. Whenever it is accepted, give the invoice. Rejected within 6 months, no worries, no invoice. No invoice. Accepted after 6 months, no worries. Immediately on 6 months, give the invoice. Supposing it is accepted on 9 months, after 9 months. After 9 months, nothing will happen because you have already raised the invoice at the end of 6 months. It is rejected after 9 months. Then at the end of after 6 months, give invoice because it is hidden deemed supply. Then when it is rejected after 9 months, to cancel that effect of invoice, raise credit note. Either supplier will raise credit note or again recipient can give corresponding tax invoice. Either seller to cancel that effect of tax invoice will give credit note, or the customer will become the supplier and he will give the tax invoice. Either or. It is nothing but sale return. In sale return, there are always 2 possibilities. Either the supplier himself will give credit note, or the recipient will become the supplier and he'll give the tax invoice. Now, in case of services, what is the due date of invoice for your services? We are not discussing time of supply. We are just discussing your due date of invoice. Due date of invoice for goods, 3 situations. We are done. Due date of invoice for services. Now we are trying to see. Normal scenario, service has got breathing time. Normal scenario, invoice has to be raised within 30 months after the completion of service. Within 30 days. Within 30 days after the completion of services. Supply date means after the completion of 30 days. For banking sector and insurance sector. For your banking sector and insurance sector, that 30 days converts to, they have to give invoice within 45 days. Within 45 days after the completion of service. Banking sector and insurance sector. When you talk about special scenario, if at all supply ceases before completion, that is a termination of contract of supply before it actually completes. In between the contract is terminated. In between the contract is normally for services you have breathing time. For goods no breathing time. For services there is a breathing time. But in exception cases for services there is no breathing time. Which means now when the service contract terminates in between, you don't have any breathing time of 30 days, 45 days. Raise the invoice immediately. Raise the invoice immediately. When the moment the supply ceases, raise the invoice immediately. But not for the entire value. Only for the proportionate value. Only for the proportionate value. If the agreed contract value was 10 lakhs and the supply is terminated, say in between, say 20% of the work is over. Now, immediately when the supply is terminated, raise the invoice for the 20% work. If you will not raise the invoice for the entire 10 lakhs, you will raise the invoice for 2 lakhs. Immediately, no breathing time. No breathing time. And when you talk about, again, special persons, be it insurance sector, banking sector, now even telecom sector. Now a special sector has come, telecommunication sector. If the transaction is between their distinct persons, which means same bank, multiple GST number, same insurance company, multiple GST number, or same telecommunication company, multiple GST number. In that case, they can raise the invoice at the time of recording the same in their books of accounts, or maximum time they are given at the end of the quarter in which supply was made. If the supply is made in April, on or before 30th June. In May, on or before 30th June. In June, on or before 30th June. End of the quarter. Whether the supply is made in the month of April, May or June, on or before 30th of June. Whether the supply is made in July, August or September, on or before 30th September. Whether the supply is made in October, November or December, on or before 31st of December. So likewise, it is to be done. Now, understand that banks have come twice. So you can now segregate it. Banking sector, insurance sector, telecommunication sector, others. We are only talking about your service providers. We are only talking about your service providers. Right. So when you're talking about banking sector, insurance sector, now to their branch offices. To their
branch offices, which means distinct persons, or to their customers, to their branch offices, to their customers. If banks and insurance sector is giving the services to their branch offices, invoice has to be given when? At the time of recording in books or end of quarter. If banks or insurance company are giving the services to the customers within 45 days from the date of completion of service or provision of service. If telecommunication sector is giving the services to their own branch offices having multiple GST number, then at the time of recording in their books or end of quarter. If telecommunication sector is giving services to their customers like us, then it is 30 days from the date of provision of service or completion of service. If you are talking about other sector, whether they are giving the supply to their own distinct persons, that is to their own branches or to their customers, it is within 30 days of date of provision of service. Within 30 days of date of provision of service. For them, there is no change. For them, there is no. In this way, we are able to see three concepts of due date of invoice or services: 30 days, 45 days, and end of the quarter. All the three, except for cessation, everything else is covered. Except for termination of contract, everything else is covered in this particular chart. Right. So that is the due date of invoice for goods and due date of invoice for services. Now there's something called as continuous supply of goods and continuous supply of services. A continuous supply of goods is defined to be a supply on a continuous basis or on recurrent basis. Either the supply itself is a very lengthy supply or it is supplied again and again in repeated cycles, for which invoice is raised periodically. For which invoice is raised periodically, which means there is a periodical agreement that I will be raising the invoice and you will be making the payment. Whereas the continuous supply of service is in a very similar term. Supply is on a continuous basis or on a recurrent basis, and where the payment obligation is periodical. That exactly is the same. If I raise the invoice periodically, you are going to make the payment periodically. Only if I raise the invoice periodically, the payment will be made periodically. So no change. It means a lengthy supply, whether the supply itself is very lengthy or it is supplied again and again. The work gets over, again it is supplied. The work gets over, again it is supplied. The work gets over, again it is supplied. But the difference here is for continuous supply of services, they have an extra condition that the period of the continuous supply of services should be more than 3 months. Should be more than 3 months. It is nothing but a lengthy supply of goods or a lengthy supply of services. In case of a lengthy supply of goods, which is continuous supply of goods, or lengthy supply of services, which is a continuous supply of services, there will be periodical invoice raising obligation or payment obligation. For services specifically, they have defined one more extra condition that it should be more than 3 months. The third condition is an extra condition that it should be more than 3 months. Now understand that you cannot give the invoice for every transaction. It's not possible to raise the invoice for every movement, right? So here they have said that for continuous supply of goods, your due date of invoice is issuance of successive statement or receipt of successive payment, which was earlier. So supposing I am supplying cables to Jio company for laying the cables for your telecommunication services. I am supplying cables. Contract is given to me by Jio company that I have to supply underground cables, right? High-tech cables to make sure that telecommunication services is pakka. I am going to supply cables to Jio company for the entire city of Coimbatore. Now what will happen? Will I raise the invoice for every meter of cable or every supply of cable? Today I have supplied 1000 meters of cable. Tomorrow I will supply 2000 meters of cable. Day after tomorrow I will supply 10,000 meters of cable. No. So as per the contract, I may agree that every month I will be giving a statement and I will be telling that day 1 how much meters was supplied at which area. Day 2 how much meters was supplied at which area. Along with that statement, I have to give my invoice. At times what will happen? Though I have agreed with Jio company that I'll be giving monthly statement, which means I'll be giving invoice along with that statement normally. But I may be in financial crunch. So I contact the Jio manager and tell that this month, though the month is to get over after say 15-20 days, I want some payment. I want some payment. So I am getting that payment. I have not issued a statement, but I am getting that advance payment. I have to give the invoice for that advance payment. Supposing statement finally comes to 10 lakhs and that advance payment is received in between 3 lakhs. For 3 lakhs, I would have already raised the invoice. For balance 7 lakhs, I'll give invoice at the time of statement. At the time of giving the statement. Now, what is the due date of invoice? Mind you, we are not discussing time of supply. We are discussing due date of invoice. Normally, for goods, payment is not relevant at the time of supply. But here, payment becomes relevant not for time of supply, but for due date of invoice. But for due date of invoice. A very tricky question. Understand that this answer is not for your time of supply. This answer is for your step number 1, due date of invoice. What about due date of invoice for continuous supply of services? Now, here there are 3 different situations. There are 3 different situations. If due date of payment is ascertainable from the contract, the contract clearly tells that after every month is over, within 7 days, you will be getting the payment. When I have to raise the invoice? For April month, on or before 7th May. For May month, on or before 7th June. For June month, on or before 7th July. Because the due date of payment is very clearly given in the contract. Very clearly given in the contract. It can be not necessarily monthly, it can be even quarterly. Every quarter is over within 20 days, the payment will be received. So I have to give the invoice for April to June quarter on or before 20th July. For July to September quarter on or before 20th October. The contract can also tell that the payment will be made every half year. After every half year is over, within the next month end, you will be getting the payment. So for April to September, 31st of October. For October to March, 30th of April, I have to give the invoice. Whether or not I get the payment, I have to give the invoice. Because the contract tells that payment will be made on so and so date. Second scenario, the contract tells that payment will be made on completion of a particular event. If when you complete the 20% of work, first payment will be released. When you complete next 20% of the work, next payment will be released. When you complete the next 20% of the work, another payment will be released. It need not be 20, 20, 20. It can be 20, 30, 40, 10. So first complete 20% of the work, you will be getting first payment. Then 30% of the work, you will be getting the next payment. Then 40% of the work, you will be getting the next payment. Finally, complete the last 10% of the work, you will be getting the next payment. So, once I complete the first 20% of the work, I will be raising the invoice for that 20%. Whether I get the payment or not, I have to raise the invoice for that 20%. Once I complete the next 30%, I have to give the invoice for the next 30%. Once I complete the next 40%, I have to give the invoice for that next 40%. Once I complete the last 10%, I have to give the invoice for that 10%. Your payment is not based on time, the payment is based on event. If payment is based on time, the moment that time comes, give the invoice. If payment is based on event, the moment that event gets completed, give the invoice. As simple as that. There can be a special scenario where nothing is mentioned in the contract. Payment is not at all discussed in the contract. Then actual date of payment. If payment is linked to time, give invoice when that time comes. If payment is linked to event, give invoice when that event completes. If payment is not at all addressed in the contract, give invoice when you get the payment. When you get the payment. Link to time when the time comes. Link to event when the event completes. Nothing mentioned when you actually receive the payment. That is due date of invoice for continuous supply of services. But what is the due date of invoice for continuous supply of goods? See, for continuous supply of services, there are 3 different situations. They are not which was earlier. There are 3 different situations. This is case 1. This is case 2. And this is case 3 if nothing is mentioned. 3 different cases. Whereas for continuous supply of goods, there is only one case. There is only
one case. There are no multiple cases. Either at the time of successive statement or at the time of successive receipt of payment, whichever is earlier. There are no multiple cases. There is only a single scenario for which you are going to go with whichever is earlier. But there are three different cases and three different answers. Right. So this completes your first step when you talk about your due date of invoice. Once you are done with your first step, only then you will move to your second step. What is your second step? What is your second step? Time of supply. Now you are talking about your time of supply. Time of supply for goods. If invoice is given in time, actual date of invoice. If invoice is not given in time, due date of invoice. Time of supply for goods. If invoice is given in time, actual date of invoice. If invoice is not given in time, due date of invoice. That's it. Payment is not relevant. Payment is not relevant. Advance payments will not be considered. Don't see the payment. How to find out invoice is given in time or not? By seeing the actual date of invoice comparing with due date of invoice. If your actual date of invoice is before due date of invoice, invoice is given in time. If your actual date of invoice is after due date of invoice, invoice is not given on time. That is how you have to compare and find it out. So what you have to do? You have to see your due date of invoice. So that is the reason first step is finding out due date of invoice. If invoice is given in time, actual date of invoice. If invoice is not given in time, due date of invoice. Payment here is not relevant. Payment here is not relevant. Therefore, advances will not be considered. Advance payment will not be considered. But for goods, when you talk about your composition scheme, for goods, when you talk about your, this was all about your regular scheme. For goods, when you talk about your composition scheme, if invoice is given in time, if invoice is given in time, it is the actual date of invoice or receipt of payment, whichever is earlier. Whichever is earlier. If invoice is not given in time, due date of invoice or receipt of payment, whichever is earlier, which means now payment is relevant. Normally for goods, payment is not relevant. But if you are working under composition scheme, payment is relevant. Payment is relevant. Are you guys clear with this understanding? For goods sector, not working under composition scheme, invoice given in time, actual date of invoice. Not given in time, due date of invoice. Payment, therefore, advance payment will not be considered. If at all you are working under composition scheme for goods, invoice given in time, actual date of invoice or payment, the receipt of payment, whichever is earlier. Invoice not given in time, due date of invoice or date of receipt of payment, whichever is. And whenever we talk about payment, payment is earlier, a payment in books or payment in bank, whichever is. That's always reality. If at all you get multiple dates of payments, one in books and one in bank, you'll go with whichever is earlier. You'll go with whichever is earlier. Now what for service? For services, whether you talk about a regular taxable person or whether you talk about a composition taxable person, the answer remains the same. The answer remains the same. Same answer. No difference. No difference. Unlike goods, there's no difference. If invoice is given on time, it is actual date of invoice or date of receipt of payment, whichever is earlier. Whether it is regular taxable person or composition taxable person. If invoice is not given on time, if invoice is not given on time, it is not due date of invoice. It is date of provision of service or date of receipt of payment, whichever is. Please be very careful that in this case, if invoice is not given on time for services, you don't go with due date of invoice. Though you will find out that in the first step. You'll go with what? Date of provision of service or date of receipt of payment, which was earlier. So for services, there's only one answer. Whether you are under regular scheme or composition scheme. Invoice on time, actual date of invoice or date of receipt of payment, which was earlier. Payment is always relevant. Advance payment will always be considered. Invoice not given on time. It is not due date of invoice. You will have that in the first step, but it is not that. You'll find out that in the first step, but the answer is not that. It is date of completion of service or date of provision of service or date of supply. By what name you call? Date of completion of service or date of provision of service or date of supply. Or date of receipt of payment, whichever is earlier. So completion of service can be called as provision of service, or at times the question will give you date of supply. So it is date of completion of service or date of receipt of payment, whichever is earlier. So specifically be very clear that it is not due date of invoice. Though you will find out that in the first step. Are you guys clear with this understanding? One very important point both for FCM and RCM. If you get the payment in installments, which means total payment is 5 lakhs, you get 1 lakh, then 4 lakh. Or you get 1 lakh, 2 lakh, then balance 2 lakhs. If you get the payment in installment, whether 2 installment or 3 installment, it is equally applicable for FCM as well as for RCM. You have to work out that question as different questions. For 1 lakh payment, work it out separately. For the balance 4 lakhs payment, work it out separately. It is not like payment in books or payment in bank, which was earlier. So when you talk about payment in books and payment in bank, it is the same payment, but different dates. In recorded in books and different date recorded in bank. But when I am telling you get the payment in installment, you are in fact getting one payment in a separate month, another payment in a separate month. So when the moment you are talking about payment in installment, 1 lakh payment is happening in the month of April. Maybe in books you have recorded in 12th April, in bank it is reflected in 15th April. So there it is which was earlier. But the second payment, 4 lakhs, is coming somewhere in December month. So that 4 lakhs has to be worked out as a separate question. If you get the payment in installment, if you get 2 installments, work it out as 2 questions. If you get 4 installments, work it out as 4 questions. If you get 5 installments, work it out as 5 questions. This is not only true for FCM, but also true for RCM. Payment in installments. One contract, payment in installments. Treat it as separate questions and work it out separately. Right. So this is all about your FCM. One small point is left out. This is basically for service provider. If at all you're talking about advance payment. So basically the focus is on advance payment up to 1000 rupees. Petty advances. Advance payment up to 1000 rupees along with previous invoice. This is not normal advance. Advance along with previous invoice, which means you are going to make the payment for an invoice. Supposing the invoice value is 1800, you paid 2000 rupees. Therefore, 200 rupees became advance. That situation we are talking about. So just because it is an advance up to 1000 rupees, you are not covered here. There are 2 criteria. One, advance is up to 1000 rupees. Second, it is along with the previous invoice. In that case, you can ignore the date of receipt of payment. You can focus on the next invoice date. Which means, forget about date of receipt of payment. When the next invoice is raised, time of supply will be together. For that small advances, don't stick to date of receipt of payment. Ignore it. The time of supply will be the next invoice date. For that small advances. What are the 2 criteria where you ignore date of receipt of payment? Advances up to 1000 rupees plus along with the previous invoice. It is not merely advance up to 1000 rupees, along with the previous invoice. Then you can ignore the date of receipt of payment for that small advances. Time of supply will be the next invoice date altogether. So that is a point which was left out. That's all about your time of supply for your forward charge mechanism. Be very clear. In FCM, there are 2 steps. First is due date of invoice, which we have discussed for goods, 3 scenarios. For services, 4 scenarios. Then continuous supply of goods, 1 scenario. Continuous supply of goods, services, another scenario. In total, 3 plus 4 plus 1 plus 1. So in totality, you have 9 situations for due date of invoice. Once you find out that, then go to time of supply. For goods, there are 2 answers. Regular scheme, invoice on time, actual date of invoice not on time, due date of invoice. Composition scheme for goods, invoice on time, actual date of invoice or date of receipt of payment, which was earlier. Invoice not on time, due date of invoice or
Date of receipt of payment which was earlier. Right. For goods you have two answers, but for services only one answer. Whether regular scheme or compensation scheme. Invoice on time, actual date of invoice or receipt of payment which was earlier. Not on time. It is not due date of invoice. It is date of completion of service or receipt of payment which was earlier. And one very important note. When you get the payment in installments, treat them as a separate question. Not only for FCM but also for RCM. In RCM, for goods there is only one scenario. RCM means recipient is going to make the payment. So you are looking from the angle of recipient. And now the answer is same whether it is regular scheme or composition scheme. Now for goods sector, what is the answer? From the angle of recipient, it is date of receipt of goods or date of making the payment. Recipient will not receive the payment, recipient will make the payment, or 31st day from the date of invoice of the supplier, whichever is earlier. 3 events. When you receive the goods or when you make the payment or 31 days from the date of invoice of the supplier, whatever invoice, whether it is tax invoice or normal invoice, date of invoice of the supplier, whichever is earlier. For services, normal scenarios. For services there are 2 scenarios. Normal scenario is very similar to goods but make few changes. In services you cannot have date of receipt of services, so that is removed. Date of making of payment or the 31 days is replaced to 61 days. So 2 changes are done. You cannot have receipt of services, that is removed. 31 days becomes 61 days. So it is date of making of payment or 61 days from the date of invoice of the supplier, whichever is earlier in normal case. This normal case will include all RCM including import of services from unrelated person. If it is import of services from unrelated person, that is also covered in normal category. Special category talks about a situation where there is import of services because supplier is outside India and recipient is in India, and that is from associated enterprises as per your Income Tax Act. So here you are talking about importation of services from associated enterprises. All the RCM including importation of services will always come in normal case. If it is importation of service from unrelated person, only one case will come in special scenario. What is that special scenario? Importation of service from associated enterprises, roughly you can call it as related person. In that case, your time of supply is date of making the payment, which is the same, just like the normal case. Rather than focusing on 61 days from the date of invoice of the supplier, here you focus on date of entry in the books of accounts of the recipient, whichever is earlier. So it is date of making the payment or date of passing the journal entry for the expenses in the books of accounts. Date of making the payment or date of passing the expenses entry in the books of accounts. Because payment is always earlier of payment in books or payment in bank. So look at this way. There are 3 dates. Payment in books, payment entry in books of accounts, payment in bank statement or expenses entry in books of accounts, whichever is earlier. Payment entry in books of accounts, payment in bank statement or expenses entry in books of accounts, whichever is earlier. So what is the change that you find here? The change that you find here is, here the focus is not on 61 days from the date of invoice of the supplier, it shifts to expenses entry in the books of accounts of the recipient. Expenses entry in the books of accounts of the recipient. Right. So for services there are 2 answers, normal answer, special answer. Normal answer is making the payment 61 days from the invoice of the supplier, which was earlier. Special answer, which is only for importation of services from associated enterprises. All the other RCM cases, including importation of services. Importation of services is not the only case. All the other RCM cases, including importation of services from unrelated person, will go in normal category. Only one case will go in special category, that is importation of service from associated enterprises, where the time of supply is making the payment or expenses entry in books of accounts of the recipient, whichever is earlier. When you talk about payment, it is always payment in books, payment in bank, expenses entry in books, whichever is earlier is a summary of the special case. Whichever is earlier is a summary of the special case. In case you are not able to find out the time of supply under any of such cases, which means you are not able to find out any of the dates, then time of supply will be the date of entry in books of accounts of the recipient, which means you are not able to see anything, both for goods and both for goods and services. Then resort to date of entry in the books of accounts of the recipient. Date of expenses entry in the books of accounts of the recipient. That is the last resort, both for goods and services. Now please understand that unlike time of supply for FCM, which has to be worked out in 2 steps, in RCM and in all the other cases, time of supply will be worked out straightly in 1 step. So first difference, in FCM 2 steps, in all the other 4 cases 1 step. Second difference, both in FCM and RCM, the time of supply is separately for goods and separately for services. Whereas in the other 3 cases, time of supply is the same for goods and services. And the third difference, in FCM and RCM, when you talk about your FCM and RCM, when you get the payment in installment, you have to work out multiple answers. This is not required in the other 3 cases. Now when you talk about voucher supply, Now understand this example that Tata Limited is giving vouchers to its employees. Obviously, it would have purchased vouchers from someone. It would have gone to Big Bazaar and purchased those vouchers, making the payment to Big Bazaar. It would have gone to Pizza Hut and purchased the vouchers, making the payment to Pizza Hut. More importantly, we are talking about the time of supply for Big Bazaar and Pizza Hut. So who's the supplier? Big Bazaar or Pizza Hut. Who's the recipient? Tata Limited. Who's the recipient? Tata Limited. So we are thinking from the angle of Big Bazaar and Pizza Hut. Obviously, Tata Limited to employees, that is a separate contract. That is another contract. Right? If the gift value is up to 50,000 per financial year per employee, it is not taxable. If it is more than that, it is taxable. Even for that, the same time of supply will be applicable, what we are discussing. Now, when you talk about your voucher supply, differentiate Big Bazaar case and Pizza Hut case. Understand that Tata Limited is giving vouchers to the employees. It would have purchased those vouchers from Big Bazaar and purchased those vouchers from Pizza Hut. That's the difference when you talk about Big Bazaar case and Pizza Hut case. In Big Bazaar case, supply is not identifiable. Supply is not identifiable at the time of issuance of voucher. Your supply is not identifiable at the time of issuance of voucher. Why? The employees of Tata Limited can go to Big Bazaar and purchase multiple items having multiple rates, and Big Bazaar cannot predict which employee is going to purchase which product. So supply is not identifiable at the time of issuance of voucher. In Pizza Hut case, your supply is identifiable at the time of issuance of voucher. Pizza Hut clearly knows that the employees of Tata Limited will come and have food, which is having the same rate, whether they are having pizza or garlic bread or something else. It is having the same rate. So supply is clearly identifiable at the time of issuance of voucher. So for whom the answer will be very simple? For Pizza Hut, the answer will be very simple. Why? For Pizza Hut, supply is identifiable at the time of issuance of voucher. When Pizza Hut is giving the vouchers to Tata Limited, Pizza Hut knows that the employees of Tata Limited can only have and come here food, which is having only one rate. Then what is the time of supply for Pizza Hut? Time of supply for Pizza Hut is date of issuance of voucher. When the vouchers are given by Pizza Hut to Tata Limited, there will be only one answer normally. Normal cases, there will be only one answer. Whether the employees are redeeming the voucher, supposing the vouchers are issued by Pizza Hut to Tata Limited in the month of April, whether one set of employees comes in the month of April, redeem the voucher, second set of employees come in June, third set of employees come in September, fourth set of employees comes in October, fifth set of employees comes in December, the answer is the same. For Pizza Hut, there will be only one answer, date of issuance of voucher. Date of issuance of voucher. But for Big Bazaar, the answer will be different. One set of employees who are coming in the month of April, for them time of supply will be April. Second set of employees when they are coming in the month of June, for them answer will be June. Third set of employees coming in the month of September, for them the answer will be September. Fourth set of employees coming in October, for them the answer will be October. The last set of employees coming in the month of December, for them the answer will be. So it is date of redemption of voucher. Big Bazaar will be having multiple answers. Big Bazaar will be having multiple answers because Big Bazaar will come to know about the exact item that the employees are purchasing only in the month of say April or June or September or October or December as the case may be. So it is date of redemption of voucher. Date of redemption of voucher. If supply is identifiable at the time of issuance of voucher, one answer, it is date of issuance of voucher. The answer is closed. If supply is not identifiable at the time of issuance of voucher, then you have to wait. The answer is date of redemption of voucher. And the answer will not be one, it will be multiple answers normally. It will be multiple answers normally. And by the way, what is voucher? Voucher is nothing but money equivalent. Tata Limited has already paid the amount to Big Bazaar and Pizza Hut. In return, it has given the vouchers. And vouchers were then distributed to the employees. When employees are going there and redeeming the vouchers, it is acting like money. It is acting like if the voucher is worth 60,000 and employees are purchasing for 70,000, 10,000 will be paid by cash. 60,000 by voucher, 10,000 will be paid by cash. So what is voucher? Voucher is nothing but an instrument where there is an obligation on whom? Obligation on Big Bazaar and obligation on Pizza Hut to accept it as a consideration or part consideration for supply. And voucher will clearly mention either the goods or services that will be supplied, or it will mention what are the potential suppliers. A single voucher can be given that you can go and use this voucher in Big Bazaar, also Pizza Hut. Right. So goods and services to be supplied will be mentioned there. Potential suppliers will be mentioned there on the instrument or the related documents. And voucher will always have the terms and conditions. What is the last date of using the voucher? For what all items you cannot use the voucher, etc. etc. In Big Bazaar, you can use this voucher for all items except item 1, 2, 3. Except item 1, say 2 and 3. They'll give the terms and conditions. Terms and in simple language, voucher is nothing but money equivalent. Money equivalent. Because Tata Limited has already paid that money well in advance to both Pizza Hut and Big Bazaar. So that is all about voucher supply. Voucher supply. So time of supply under FCM, 2 steps done. Time of supply under RCM, 1 step done. Time of supply, voucher supply, 1 step done. Time of supply in case of residual cases. Time of supply when you are talking about residual cases. Residual cases means basically fraud cases where you don't have records. Where you don't have records. So in the first scenario where periodical return is to be filed, you can write that you don't have records but you are registered. You don't have records but you are registered. In the second case where periodical return is not required to be filed, which means any other case, you don't have records, also you're not, no records, registration, first case, periodical returns are to be filed. No records, no registration, second scenario. Where there is no records but you are registered, your time of supply will be due date of filing of return. Now how they will find out due date of filing of return? Best judgment. Again they will find out by way of best judgment that this transaction pertains to so and so month. This transaction pertains to so and so month. Supposing they tell that this transaction pertains to April month, then the time of supply will be 20th of May. Time of supply will be 20th of May. Again they have to resort to best judgment because you don't have any records. Please understand that when you don't have any records, you have to resort, officer will resort to best judgment. But what is the difference? Suppose in both the cases you don't have records. In both the cases you don't have records. But in one case, officer is able to find that this transaction pertains to April 2023. What will be the time of supply? 20th May 2023. What will be the due date of payment? 20th June 2023. Interest will start from 21st June. Interest will start from 21st June. When officer by the way of best judgment has found that the transaction pertains to April 2023. April 2023. By best judgment he has found. Your time of supply is due date of filing of return, which is 20th May. Your due date of payment will be, assume that you are under regular scheme, 20th of the next month. So time of supply is 20th May, which means due date of payment will be 20th June. Interest will start from 21st June. If at all you are in a scenario where you don't have records and you are not registered, officer through best judgment has found out that the transaction pertains to April. That the transaction pertains to April, but the assessee is not registered. And assessee finally makes the payment. Somewhere in the month of, say, December 2026. December 2026. What will be the time of supply? Time of supply will be December 2026. Time of supply will be December 2026. In both the cases, officer did his work and said that this transaction pertains to the month of April 2023. But now, as you are not registered, your time of supply is actual date of payment. When you are making the payment? December 2026. So, what is your due date of payment? 20th Jan 2027. By the way, you have made the payment before the due date of payment because your time of supply itself is actual date of payment. There won't be any interest. Here there will be interest starting from 21st of June 2023 till the actual date of payment, because time of supply is your due date of return filing. You understand the difference? In both the cases, officer has done best judgment and found out that transaction pertains to the month of April. But in one case, you are registered. If you are registered, officer will tell that your time of supply is due date of return filing, which is 20th May. Therefore, your due date of payment is 20th June. Therefore, interest will start from 21st June. In the second case, though officer has found the transaction pertains to April 2023, but as you are not registered, your time of supply is actual date of payment. The payment which is made in the month of December 2026. And as the payment is made and that becomes the time of supply, what would be your due date of payment, by the way? Next month, 20th Jan. But you have made the payment before the due date of payment. There will be never any interest. There will be never any interest because you have made the payment before the due date of payment. There will be never any interest. Time of supply itself is actual date of payment. Though it is an extreme fraud case, but there is no interest. Why? Something is better than nothing. They want to collect the tax. Don't worry. Penalty will be there. Penalty will be there. Are we clearly differentiating these two examples? No records in both the cases. In one case registered, in one case not registered. If you are registered, time of supply is due date of return filing. If you are not registered, time of supply is actual date of payment. And finally, when you are talking about the last scenario, interest on late payment of consideration, whether by you call it as interest or late fees or penalty for delayed payment of consideration, is time of supply will be the actual date when you receive the interest. The actual date when you receive the interest. Actual date of receipt of interest. Supposing you have supplied in the month of April 1 lakh plus GST. 1 lakh plus GST. This happened in the month of April 2023. It was promised that the payment will be made within 3 months. But the payment was made after, say, 9 months. So you demanded interest of 15,000. This was your price. Now you're demanding interest of 15,000 in the month of December 2023, but you're finally getting interest only of 10,000 in the month of June 2024. This is again nothing but your interest, but what is the actual receipt? This is the interest that you have demanded. Interest that you have demanded. This is the interest that you have actually received. What is the time of supply? Time of supply for selling price will be April 2023. It is based on FCM. This is based on FCM. We are assuming that supply happened in April and invoice was also raised in April. So it is April 2023. Time of supply for the selling price will be under FCM. Will be under FCM. So this time of supply that you have found out is time of supply under FCM. What about time of supply for interest on delayed payment of consideration? This will be there for your interest payment when? June 2024. June 2024. And which means here time of supply was for entire 1 lakh. Here it will be for only for 10,000. So interest 15,000 will not be considered, only 10,000 will be considered. That too, come tax calculation. Multiplied by 100 divided by 100 plus rate of tax. Now we are clubbing all the provisions. This is coming from your valuation. This is coming from your valuation. So time of supply for 1 lakh will be under forward charge mechanism, which will be when the supply was made and the invoice was raised. We are assuming that both happened in the month of April. Whereas time of supply for interest on delayed payment of consideration is when interest is actually received. When interest is actually, you demanded interest of 15,000, but what you actually received? So it will be only on 10,000. That too, the valuation part of it will be 10,000 multiplied by 100 divided by 100 plus, because IC's understanding is interest valuation is always based on come tax calculation. I did not do this for 1 lakh. I am doing this only for interest portion. So that's all about your time of supply when you talk about your interest on delay payments. So when you talk about your time of supply for all the 5 cases, be it FCM, RCM, voucher, residual and interest on delayed payment, we have seen. Now there is a special provision which talks about time of supply for change in rate of tax. Time of supply for change in rate of tax, which means the rate of tax earlier was 5%, now it has converted to 18, or earlier it was 18, now it has converted to 12. That's change in rate of tax. That's change in rate of tax. And because of the change in rate of tax, you have to decide what is the final rate of tax. Here, time of supply will help you to find 2 things: rate and time of supply. Rate of tax and time of supply. Both. Right. When you talk about change in rate of tax, please understand this concept is applicable for goods under composition scheme and services whether under regular scheme or composition scheme. What about goods under regular scheme? You will be going with section 12. So you have to bifurcate this into 2. There is change in rate of tax. If at all you are talking about goods under regular scheme, goods under composition scheme, service under regular scheme, service under composition scheme. The answer is 1 for the last 3 cases. The answer is 1 for the first case. For goods under regular scheme, section 12 will be applicable. It is either actual date of invoice, or if invoice is raised in time, actual date of invoice. If invoice is not raised in time, due date of invoice. So if invoice is raised in time, actual date of invoice. If invoice is not raised in time, due date of invoice. Due date of invoice. For all the other cases, the answer will be something different. This all the other cases, you are going to apply section 14. Section 14. Now, what is the answer according to your section 14? Section 14 tells that you go with whichever is having more weightage. If at all, I keep supply on one side and invoice on one side and receipt of payment on other side. Supply on one side, receipt on one side, invoice on other side. Supply on one side, invoice and receipt of payment on the other side. Which is heavier? This is one scenario. The other scenario is invoice is on one side, supply and receipt was on other side. Receipt was on one side, supply and invoice is on one side. Receipt and invoice is on one side, supply is on other side. Which is having heavier weight? Answer will be what is having the heavier weight. What is having the, which side is having more weightage? Which side is having more events? Which side is having more events? So answer will always be which side is having more events. Which side is having more events? So in the first, these are all 6 different cases. These are all 6 different cases. In the first case, which is having heavier weight? Supply and invoice is on heavier side. See, all these things you need to understand that this is before change, this is after change. This is before change, this is after change. Something is before change, something is after change. In the first case, what will be the answer? Invoice. In the second case, receipt. And also remember one thing. 2 points you have to remember. Answer is on that side which is having more weightage. Second, answer is either invoice or receipt. It is never supply. It is never. So here, when supply and invoice are on one side, answer is invoice. When supply is and receipt are on one side, answer is receipt of payment. When invoice and receipt are on one side, then you have to go with whichever is earlier. When supply and receipt are on one side, answer is receipt. When supply and invoice is on one side, answer is invoice. When receipt and invoice is on one side, it is whichever is earlier. Whichever is earlier. So 2 things you have to remember. Time of supply is on that side which is having more weightage. Which is having more weightage. Second thing, answer will be either invoice or receipt or whichever is earlier if both are on one side, but it will never be date of supply. It will never be date of supply. If you know these 2 points, you get the answer. If you know these 2 points, you get the answer. And based on the answer, supposing the rate of tax before change. The rate of tax before change was 5% and after change is 12. What will the rate of tax in the first scenario? Second scenario? Third scenario? Fourth scenario? Fifth scenario? Sixth scenario? Get to know the answer in a very simple manner. Right. So how you have to bifurcate? 1. This provision is not applicable for goods in under regular scheme. For them, the answer is just like section 12. It's actually covered by section 12. If invoice is given in time, actual date of invoice, not given in time, due date of invoice. See at that point of time whatever was the rate, go with that rate. Go with that rate. Go with that rate. You don't come in section 14. Section 14 is applicable for goods under composition scheme, service sector, whether under regular scheme or composition scheme. There you'll have certain events before change, certain events after change. Remember 2 points. Answer will be on that side which is having more weightage. Remember second point. Answer either will be invoice, date of invoice or date of receipt of payment. But it will never be date of supply. So if you remove these 2 points, you'll get to know the answer. You'll get to know the answer. Once you know the answer, you'll know the rate. So this time of supply is used for 2 purposes. To find out the rate and to find out the due date of payment. First to find out the rate, then to find out the due date of payment. Due date of payment is the main objective of time of supply. Here it is also to find out the rate of tax. Rate of tax. So that is all about your section 14. Section 14. In section 14, There's one catch that you need to remember. We are done with the answer part. We are done with the time of supply part. For receipt of payment, whenever you're seeing this receipt of payment, you need to remember one thing. When you talk about receipt, your receipt, it is always earlier of payment in books or payment in bank, whichever is earlier. This we have been seeing right from section 12-13. Always payment in books or payment in bank, whichever is. But in one case, you will go only with payment in bank. Why? Your book entry was a bogus entry. How did you find out your book entry was a bogus entry? First, there was a book entry, payment in books. This is the first event. Followed by, there was a change in rate of tax. Followed by, there was payment in bank, which was more than 4 days later, after change in rate of tax, which means clearly the book entry was a bogus entry. You purposefully have put book entry earlier. Why? Supposing your change is on 1st of October. Your book entry you have put on 25th of September. The payment happened on 13th October. Now, clearly the events should be in a particular sequence, and this is a sequence. Only then you call it as bogus entry. Otherwise, payment means payment in books or payment in bank, whichever is always. Now, here clearly it shows you have put a book entry which is on 25th of September. Bogus entry. Knowingly, you were trying to make your time of supply. You are making an attempt to make your time of supply before change so that you might get a lesser rate. You are manipulating the dates. Why? Even after that book entry, even after waiting for 4 days, after change in rate of taxes, 4 days is not calculated from your book entry. They are giving you more time. Okay, forget about your book entry. Let that change happen. Let us wait for another 4 days, but the payment has not hit the bank account. You said you have received the check on 25th of September. The change happened on 1st of October. At least you could have deposited the check on 1st of October. So that payment would have been cleared within 4 days. Even that did not happen. Payment finally happened, cleared in bank on 13th October. It clearly shows that you never received any check on 25th of September. It was a bogus book entry. So what you will focus now? You will focus only on credit and bank account. Please understand that this is only for section 14, so that because the rates are changing. And in section 14, don't apply this always. Even in section 14, the normal answer is payment in books or payment in bank, whichever is. So normally it is the same thing. Payment in books or payment in bank, whichever is. Only if at all you fit in a particular situation where the book payment entry is before change, then there is change. Then you wait for 4 days after change. Even then the bank entry comes after 4 days after change, which clearly means the book entry was a bogus entry. So date of receipt of payment will be treated as credit in bank account, not your entry in books of accounts. Because it clearly indicates that the entry in books of accounts was a bogus book entry. Specific events. If these these events are not coming in the sequence that we have discussed, then go with the normal thing. What if the payment was crediting within 4 days of change in rate of tax? Go with the normal thing. Payment in books or payment in bank, whichever is. What if the credit in bank account happened on 3rd of October? You would have gone with 25th of September. Because payment in books is 25th of September, payment in bank is 3rd of October, whichever is You would have gone with 25th of September. When these events are happening in this, with all these conditions being satisfied, then forget your bogus book entry, focus on your bank entry. Focus on your bank entry. This is only and only for section 14 and only in specific scenario, not in all the cases. Not in all the cases. So that is all about your time of supply, be it section 12 or be it section 13 or be it section 14.
Now, another very important chapter, which is composition scheme. A short question which is going to be there in your exam paper is your composition scheme. Yes. When you talk about your composition scheme, the provisions are discussed in section 10. Read along with your rule 3, 4, 5, 6, 7. So, basic provision is section 10. Then there's the entry point in rule 3, 4 and 5. Rule 3 talks about your intimation, 4 effective date, and 5 the conditions and the restrictions. Then there is an exit point, which is rule 6 validity. And finally, if at all you are under composition scheme, you have to pay a composition tax, which is rule 7. So basically remove section 10. Section 10 read along with rule 3 to rule 7. Now when you talk about composition scheme dealer, certain important points. It is a scheme for small dealers. It is a scheme for small dealers who cannot comply with the draconian provisions of GST law, who want certain relaxation. The scheme is basically for them. Basically, what are the reasons why assessee will go for composition scheme? 1. These are all the advantages basically. Stock details is not required to be maintained. ITC details need not be maintained because they are not eligible for ITC. They cannot even take ITC. They cannot take ITC. 3. They have to make quarterly payment and yearly return. Don't call it as annual return. That is a separate concept per se. Quarterly payment and yearly return. A simple tax, a simple and lesser tax. Normally the tax rate is 1%. For restaurant outdoor catering, 5%. For special composition scheme, 6%. These are all advantages because of which an assessee will opt for your composition scheme. He will opt for composition scheme. 1. No stock details. 2nd is not an advantage. ITC is not that, therefore no ITC. 3rd is an advantage. Quarterly payment, yearly return. CMP 08 quarterly payment, GSTR 4 yearly return. And 5th is obviously another advantage. Very simple tax calculation, lesser tax rate. 1, 5 and 6. Obviously when you talk about this, even compensation cess is not that. He may be dealing with certain items which is attracting compensation cess. But if he is under composition scheme, he will pay only 1, 5 or 6. What are the disadvantages? These are all the advantages. What are the disadvantages? He cannot avail ITC on his purchases. He cannot collect tax on his sales. A composition scheme dealer cannot avail ITC on their purchases. Therefore, it will be added to the cost. Obviously, it will be added to the selling price. They cannot collect tax from customer. They have to pay 1%, 5%, 6%, but they cannot collect it from the customers. They have to pay from their pocket. These are all the disadvantages, major disadvantages when you talk about your composition scheme. So, advantages, this is disadvantages of your composition scheme. A composition scheme dealer is not going to give tax invoice, is going to give bill of supply because it cannot collect tax. Now we have discussed the disadvantage. It cannot collect tax and it has to clearly mention on that invoice, that is bill of supply, composition scheme dealer not eligible to collect tax on supplies. So it has to inform the customers that I cannot collect tax from your pocket. I have to pay tax from my own pocket. It is against the basic principle of indirect taxes. Normally you collect and pay tax. In this case, you cannot collect tax, but you have to pay tax. Secondly, at all their places of business, whether it is principal place of business or additional place of business, on the notice board, sign board, the shop name, they have to mention specifically that they are composition taxable person. So the customers are aware that they are going to a shop who's working under composition scheme. Right. So customer is also aware that when they go there, the shop owner will not collect GST. But also understand that when it cannot collect GST, the customer cannot take input tax credit. That's cascading effect. First of all, if I go and purchase from a composition scheme dealer, it is disadvantageous. It is disadvantageous to me. If at all I am a registered dealer. Why? I know that shop owner who is under composition scheme cannot take the credit. Therefore, his cost increases. Selling price increases. I know that he cannot collect tax from me. So, he will try to include it within his selling price. It is not an ideal situation for a registered dealer to purchase from composition scheme dealer. That being the case, composition scheme dealer will be opted only by those people who don't have B2B customers, who have only B2C, final retailers. Composition scheme is attractive only for retailers, retail shops, because they don't have their customer base as B2B. They have their customer base as B2C. Now, under composition scheme, basically there are two types: normal composition scheme and special composition scheme. Normal and special. Now, what is meant by normal composition scheme and what is meant by special composition scheme? Who all can go for normal composition scheme and who all can go for special composition scheme? Normal composition scheme is basically for goods sector plus restaurant, outdoor catering sector. Special composition scheme is for others. When you talk about normal composition scheme, where you're talking about your goods sector and restaurant and outdoor catering sector, two service sector are covered here, restaurant and outdoor catering sector. You have to remember the states because states will have different limits. Now you have to remember this small story. Apni politics. Our politics can be summarized into three. What is that? Louder. Money, land, and mainly Ram. Money, land, and Ram. Money, land, and you are not a very small person. For very small person, there will be one more thing extra, which is time pass. But now you have grown up a bit. You are not grown up to a very larger extent. You have grown up a bit. Very small person means registration limit 40 lakhs, 20 lakhs, 10 lakhs. Now you are not talking about a very small person. You are talking about a small person. So now politics is no more a time pass for you. So you are removing the time pass. Why you have to remember this? Because for 40 lakhs, 20 lakhs, 10 lakhs, TP will come. Telangana, Puducherry will come. For composition scheme, TP will not come. How to remember it? When you are very small, politics is not relevant. Time pass. When you become a bit bigger, not very big, politics is no more a time pass. Now, for all these states and other states and union territories, for all these special states, the limit for composition scheme is 75 lakhs. For other states, it is 150 lakhs. 150 lakhs. This is when you are talking about normal composition scheme. For special composition scheme, all the states, all the union territories, forget about specific categories, it is 50 lakhs. It is 50 lakhs. Either you are under normal composition scheme or you are under special composition scheme. It cannot be both. Either or. First you try for normal composition scheme. If not possible, then you try for special composition scheme. It cannot be both. So either your limit is 150 lakhs, 75 lakhs, or your limit is 50 lakhs. Right. Now, in 150 lakhs, 75 lakhs, what if you are working in Tamil Nadu and Tripura? And by the way, what these short form represents? What is AP? Arunachal Pradesh. S, Sikkim. U, M, Meghalaya. Tripura, Manipur, Nagaland, Mizoram. Right. Now, when you talk about all these states, the limit is 75 lakhs. So if you're working in Tripura, normal composition scheme, 75 lakhs. If you're working in Tamil Nadu, normal composition scheme, 150 lakhs. If you're working in Tamil Nadu and Tripura, whenever there's a fight between elder brother and younger brother, who will win? Younger will win. Right. So 75 lakhs will be the limit. For both states put together, the limit will be 75 lakhs. So whenever the fight is between elder and younger siblings, who will win? The younger one is going to win 75 lakhs. There's no going back and all. That is, if the fight is between 150 and 75 lakhs, you have to resort to 75 lakhs. Can there be a fight between 150 and 50? No. 75 and 50? No. Why? Either it is normal or it is, if it is special composition scheme, if you're working in Tripura, 50 lakhs. Tamil Nadu and Tripura, both together, you have to go with the limit of 50 lakhs. So there is no change when you talk about your special composition scheme. Now, certain special aspects. In a normal composition scheme, as of now, you understand that it is only goods sector and two service sector, which is restaurant and outdoor catering. Now, please understand that they allow a small service portion. Along with this, there can be a small service portion. It cannot be purely service. Along with this, there can be a small service portion. What is the limit of the small service? 10% of previous year state turnover or 5 lakhs, whichever is not lower, whichever is higher. Whichever is. So in every state, you can have the small service limit. The small service element will be different from state to state. Will be different from, we call it as inner limit. We call it as, this is technically called as inner limit. This is technically called as outer limit. Outer limit is for all the states put together. Inner limit will be separately for state 1, state 2. And you have to take care that you are not crossing outer limit, all the states put together, as well as inner limit for each of the states separately. Outer limit is pan-India. Outer limit is to be seen pan-India, all the states put together. Whereas this inner limit is to be seen state-wise. Inner limit is to be seen state-wise. And everything should be simultaneously satisfied. If you are crossing the outer limit for all the states put together, go outside composition scheme. If you are within the outer limit, Tamil Nadu and Tripura together, you are within 75 lakhs. But in Tamil Nadu, the service portion has crossed this limit. Though your outer limit is within the limit, but the inner limit in Tamil Nadu has crossed outside composition scheme. In Tamil Nadu, your service is within the inner limit. But in Tripura, your service has crossed the inner limit. The inner limit for Tamil Nadu service limit, the inner limit for Tripura service limit will be different. Because the formula is what? 10% of previous year state turnover. It's not aggregate turnover. This 150 lakhs, 75 lakhs and 50 lakhs is all aggregate turnover. Whereas this inner limit is all state turnover. Are you guys clear with this understanding? They allow a small portion of service. So then as a goods sector with a small service, I can be under normal composition scheme. Then for whom it is special composition scheme? It is for pure service sector or service sector with goods where service is more than the inner limit of normal composition scheme. It is therefore two categories. For whom? Either pure service sector or service sector plus goods where service is more than the inner limit of normal composition scheme. You are very well aware that your service is more than the inner limit which is allowed under normal composition scheme. Clear? In generality, you can tell this: goods sector, normal; service sector, special composition scheme. When you're talking about restaurant, outdoor catering sector, normal composition scheme. If it is goods plus service, If service is within the inner limit, normal. If it is goods plus service, service is more than the inner limit, try for special. First try for normal, then try for, but when you're trying for special, you have to be very careful because the limit now decreases. The outer limit now decreases to 50 lakhs. That also you have to be very cautious. Right, now just to make you understand this outer limit and inner limit for normal composition scheme, if you are working in Tamil Nadu and if you are working in Tripura, your previous year turnover is 40 lakhs and 20 lakhs. Your current year turnover is 45 lakhs and 25 lakhs. Can you enter inside composition scheme? First, it is the entry point. It is the entry point. Can you enter inside composition scheme? Can you enter inside composition scheme? Yes, you can enter inside composition scheme. Why? Because your aggregate turnover in previous year is less than or equal to 75 lakhs. It is 60 lakhs. This is entry point. Now, let us talk about your exit point. Your exit point will be there. You are going to go outside your composition scheme in a case where your aggregate turnover of current year crosses 75 lakhs or your inner limit of services in Tamil Nadu crosses how much? What is 10% of 40 lakhs? 10% of 40 lakhs is 4 lakhs or 5 lakhs, whichever is higher, it is 5 lakhs. Or your inner limit of service in Tripura crosses 10% of 20 lakhs or 5 lakhs, whichever is higher. Again, so your total turnover, your total aggregate turnover of Tamil Nadu and Tripura, either it should cross 75 lakhs or your service turnover in Tamil Nadu should cross 5 lakhs or your service turnover in Tripura should cross. If you touch any of these, whichever is earlier, you are thrown outside composition scheme. You are thrown outside composition scheme. You have to be very, very, very clear as to what are they trying to tell. They are telling that entry point is all based on previous year aggregate turnover. Entry point is all based on previous year aggregate turnover. If you see your entry point, it was based on previous year aggregate turnover. Entry point was all based on previous year aggregate turnover. Your exit point is based on current year aggregate turnover. Main criteria. This we call it as outer limit. And these two we call it as inner limit. Either your total turnover of Tamil Nadu and Tripura together crosses 75 lakhs together, or in Tamil Nadu your service portion exceeds 5 lakhs, or in Tripura your service portion exceeds, whichever comes earlier, you are going to exit. You are going to exit the composition scheme. That is how you are going to see your outer limit and your inner limit. Now moving forward, this was all about your entry point and exit point. Now understand that the limit of 150 lakhs, 75 lakhs and 50 lakhs has to be checked for previous year entry point first. If at all satisfied, then you have to even check your current year 150 lakhs, 75 lakhs, 50 lakhs for your exit point. For your exit. When you are seeing your exit point, when you are under normal composition scheme, exit point is not 1. Exit point is outer limit as well as inner limit. If you are working in 2 states, exit point is 3. Overall exit point crossing 150 lakhs, 75 lakhs, or inner limit of each state crossing the maximum allowed service, which is 10% of previous year state turnover of 5 lakhs, whichever is higher. That is for normal composition scheme. For special composition scheme, exit point is only 1. 50 lakhs. Exit point is only, the concept of inner limit is only peculiar to normal composition scheme. Now, this is all about your eligibility. Now, let us talk about certain other conditions and restrictions. First, let us be very clear about the conditions. Let us be very clear about the conditions. If at all you are under composition scheme, the condition that you check basically of previous year is the turnover, outer limit 150 lakhs, 75 lakhs and 50 lakhs. In addition to it, now whatever we are discussing is true for both normal and special. Whatever conditions and restrictions that we are discussing is true for both your normal and special. If at all you are talking about manufacture of notified goods in previous year as well as manufacture of notified goods in current year. There are no notified services, so I am not going to discuss my discussion on notified services because there are no notified services. Manufacture of notified goods, either in previous year or in current year, you cannot go for composition scheme. Now, what are notified goods? The notified goods happens to be your pan masala, tobacco, ice cream, and your building materials. These items are there even in your registration limit of 40 lakhs, 20 lakhs and 10 lakhs. Pan masala, tobacco, ice cream and building materials. Now, what is extra here is aerated water. Now, what is special here is the restriction is there only for a manufacturer, not for a trader, not for a trader. And what is another special point here is it is applicable both when you're there in previous year as well as you're there in current year. Which means I should check I did not manufacture these items in previous year as well as I'm not going to manufacture in. If I manufactured in previous year, I'm stopping it in current year, still I'm not eligible. If I did not manufacture in previous year, but I'm manufacturing in current year, not eligible. Then what should I check? I should check I did not touch these items, manufacture these items, either in previous year, also in current year. Then I am eligible. Manufacture of notified goods. Pan masala, tobacco, ice cream, building materials and aerated water. Now you have to differentiate this with your 40 lakhs, 20 lakhs and 10 lakhs. So if you're talking about your items being pan masala, tobacco, ice cream, building materials. And if you're talking about your aerated water. If you're talking about from the angle of manufacturer, if you're talking from the angle of trader. If you are a manufacturer of pan masala, tobacco, ice cream and building material, can you go for 40 lakhs? Can you go for special limit of 40 lakhs? No. You cannot go for special limit of 40 lakhs, which means you can go for 20 lakhs, 10 lakhs, not 40 lakhs. Can you go for composition scheme? No. If you're manufacturing aerated water, can you go for 40 lakhs? Yes. But can you go for composition scheme? If you are a trader of pan masala, tobacco, ice cream, building materials, can you go for 40 lakhs? No. For 40 lakhs, whether you are a trader or a manufacturer, not allowed. But can you go for composition scheme? Yes. Because the restriction here is only for a manufacturer. Aerated water. If you are a trader, can you go for 40 lakhs? Yes. Can you go for composition scheme? Right. Things are very different for all these items. And what if I tell other items, other goods? Other goods. Other goods is very normal. I can think of 40 lakhs. I can think of composition scheme. Whether I am a manufacturer or I am a. So things will differ based on what you are and what concept you are looking for. If it is registration limit, when you can go for 40 lakhs, when you cannot go for 40 lakhs is different. If it is composition scheme, when you can go for composition scheme, when you cannot go for composition scheme is different. So things will differ based on what are you doing on these special items. Now coming back here, the criteria that is there in previous year for composition scheme is only two. Your turnover should not be more than 150 lakhs, 75 lakhs, 50 lakhs in previous year. And you should not be manufacturing notified goods in previous year. All the other points that we are going to discuss is for current year. All the other points that we are going to discuss is for current year. Do not forget this point. It is only and only for current year. Now, what are the other points which are only applicable for current year? You should not be a CTP NRTP. You should not be a special person, casual taxable person, non-resident taxable person, temporary registration. The moment you are taking CTP NRTP registration in current year, get outside composition scheme. Get outside composition scheme. Second, you should not be dealing with non-taxable supply of goods or services. Basically, alcoholic liquor for human consumption and fine notified petroleum products. Can I deal with them in previous year? Yes. Will it be included in my aggregate turnover of 150 lakhs, 75 lakhs, 50 lakhs in the previous year? Yes. I can deal with them in previous year. I cannot deal with them in a common mistake that is done by most of the students in a question given by ICI. They are giving you details of your previous year aggregate turnover, including alcoholic liquor, including interstate supply. And you come to a conclusion that in current year you cannot go for composition scheme. Why? That is all in previous year. In previous year I can have interstate supply. In previous year I can have alcoholic liquor. In current year I should not deal with non-taxable supply. In current year I should not have interstate supply. That we are going to discuss. The next point. You should not have interstate outward supply in current year. Interstate outward supply in current year. Can I have interstate inward supply? Being in Tamil Nadu, can I purchase from Karnataka? Being in Tamil Nadu, can I purchase from Maharashtra? Being in Tamil Nadu, can I import from USA? Yes. Being in Tamil Nadu, can I sell to Karnataka? Being in Tamil Nadu, can I sell to Maharashtra? Being in Tamil Nadu, can I export to USA? Being in Tamil Nadu, can I sell to SEZ within Tamil Nadu? Being in Tamil Nadu, can I sell to SEZ within Tamil Nadu? No, it is interstate outward supply. Being in Tamil Nadu, can I purchase from SEZ in Tamil Nadu? Yes. I cannot have interstate outward supply in current year. In previous year, can I have it? Yes. I have to just check my aggregate turnover and notified items manufactured. Other things I will be checking only for the current year. Now, in current year, I should not make a supply of goods or services through ECO, which attracts GST, TCS, which attracts GST, TCS. I should not go for that. I should not go for that. If at all I am supplying through Flipkart or Amazon, where GST, TCS is applicable, I cannot be under composition scheme. I cannot be under. These are all the additional criteria. What was the main criteria? Main criteria was my turnover limit. My main criteria was my turnover limit, and other criteria was manufacture of notified goods. That is there both for previous year as well as current year. Both turnover and notified goods manufacturing is there both in previous year for entry point, current year for exit point. They are both 150 lakhs, 75 lakhs, 50 lakhs. I have to check both for previous year for my entry, current year for my exit. Manufacture of pan masala tobacco, I have to check for my previous year for entry point, current year. If at all I start manufacturing in current year, I have to exit. I have to check for both. These 2 points are there for my previous year as well as current year. A and B. 1, 2, 3, 4. Whatever we have discussed, they are there only for your current year. So then what are the leftover points? Leftover points are not the conditions. Conditions we are done with. They are the restrictions. What will happen or what you will lose if you are under composition scheme? If you are under composition scheme, you cannot take credit, you cannot collect tax. Disadvantages of composition scheme. If you are under composition scheme, the moment you cross the limit of 150 lakhs, you have to go outside. Exit point, main exit point. This condition A and B we have discussed. This is condition, main condition. If you cross your outer limit of 150 lakhs, 75 lakhs, 50 lakhs, you have to exit. So that is the condition that we have already completed. Now what is the first restriction? You cannot take credit on your purchases. You cannot collect output tax on your sales. What is the second restriction? I have to think pan wise, which means if I am violating condition in one state, I have to go outside composition scheme in all the states. I cannot be in composition scheme in one state and regular scheme in other state. That is a restriction. Supposing I am working in two states, Tamil Nadu and Tripura. If I violate a condition in Tamil Nadu, I'll be thrown outside composition scheme not only from Tamil Nadu but also from all the states. My exit will happen in all the states simultaneously. I cannot tell no, my outer limit is within 150 lakhs, 75 lakhs, 50 lakhs. Only my inner limit I have violated in Tamil Nadu. So I'll go outside Tamil Nadu. I'll opt under regular scheme. In Tripura, I'll be under composition scheme. Not possible. Either both the states regular scheme or both the states composition scheme. A combination of regular scheme in one state and composition scheme in other state is not. Even a combination of normal composition scheme in one state and special composition scheme in other state is not possible, though not specifically mentioned. It's not possible. You have to opt the same scheme in all the states wherever you are working. If you are having multiple GST number. And even though you are under composition scheme, you have to pay RCM. There's no relaxation. Just because you are under composition scheme, you cannot take the liberty that, okay, I'll not pay RCM. Even though you are under composition scheme, you have to pay RCM under section 93, section 94. Now, what is the special point? Normally, you pay RCM and take credit. Here, you will pay RCM, but you will not be able to take RCM credit. You will not be able to take RCM credit, it will be added to the cost. Normally, under composition scheme, people think that you are going to pay only 1%, 5%, 6%. But RCM has to be paid at regular tax. 5, 12, 18, 28 as the case will be. Clear? Though you are under composition scheme where you are going to pay 1%, 5% or 6%, but for your inward supply, it is not your outward supply. For your inward supply which attracts RCM, you are going to pay regular tax. When I tell regular tax, it is not 1, 5, 6. It is 5 regular tax or 12 or 18 or 28, whatever it is. But under composition scheme, you have to pay RCM at regular tax, but you cannot take the credit. It will be added to your cost. It will be added to your cost. These are all restrictions. So whatever I have highlighted in your green color finally, right, this small a, small b and your small c, they are all restrictions or disadvantages. Even though you are under composition, if you are under composition scheme, no credit on your purchases, no collection of tax on your sales. And you have to opt uniformly under composition scheme in all the states. It cannot be regular scheme in one state, composition scheme in other state. And you have to pay RCM even though you are under composition scheme. But the disadvantage is you will pay RCM not at 156, you will pay RCM at regular tax, but you cannot take the credit. You cannot take the credit. So that is all to do with your composition scheme, entry point condition and exit point conditions, current year. All these conditions that you have discussed are of current year. What are the only two conditions for your entry point? All the points that you have discussed are all about exit point. What are the only 2 points for entry? Previous year aggregate turnover should be up to 150 lakhs, 75 lakhs, 50 lakhs. Previous year you should not be manufacturing. These are only the entry checks. Rest all or exit. Current year, no CTP, no NRDP, exit. If you are CTP, NRDP, get out. Not be dealing with non-taxable supply. If you're dealing, get out. Not be having interstate outward supply. If you are having, get out. Not be having supplying through eco which attracts CCS. If you're having that, get out. Not be dealing with notified manufactured, not be manufacturing notified goods. Though you did not do in previous year, you don't do it even in current year. If you're starting doing it, get out. 5 exit points. Main exit point. If you're crossing 150 lakhs, 75 lakhs, 50 lakhs in current year, get out. So entry points 2. Exit point 6. Exit point. Other points that we have discussed, they are neither entry points nor exit points. They are restrictions. They are all restrictions. Now, when you talk about your composition scheme, as discussed, you have to pay certain percentage. What is the percentage that you have to pay, by the way? 1%, 5%, 6%. If you are under normal composition scheme,
I'll write it as 1%, 2% change to 1%. So normal composition scheme, you're talking about a trader, you're talking about a manufacturer, restaurant, outdoor catering. Special composition scheme. Anyone. Obviously, basically it will be pure service or service plus goods, where service is more than the inner limit allowed under normal composition scheme. If you are under normal composition scheme, trader will pay 1% only on taxable supply, not on, that is an advantage for a trader. He will only pay on the taxable item, not on the exempt item. Only for payment purposes, exempt item will be excluded. For all other purposes, checking the entry limit, exit limit, exempt goods also will be included in the turnover. Only for payment purposes. Only for payment purposes, it will be paid only on 1% of the taxable goods. Supposing I am dealing with two items, item X, item Y. Item X taxable at 18%, item Y taxable at 0%. 40 lakhs, 20 lakhs. 40 lakhs, item X, 20 lakhs, item Y. I will be paying 1% only on 40 lakhs, item X. Not on 20 lakhs, item Y. But what if I am a manufacturer? I will be paying 1%. The highest possible rate is 2%, but as of now, notified rate is 1%. I will be paying 1% on taxable supply as well as exempt supply. So if I am dealing with two items, like I said, item X and item Y, having the normal rates as 18 and 0, the turnover as 20 lakhs and 40 lakhs and 20 lakhs respectively in current year. As a trader, my composition tax will be 40 lakhs multiplied by 1%. As a manufacturer, 60 lakhs multiplied by, obviously this 1% will not be 1%, it will be 0.5% CGST and 0.5% SGST. And always composition scheme dealer will have only C plus S, because he cannot have interstate output supply. He cannot have interstate. So this will be split between CGST and SGST. This will be split between your CGST and SGST. Right. Now coming back to the rates. If you are under normal composition scheme, restaurant, outdoor catering sector, 5% on what? Taxable supply plus exempt supply, everything. If you are under special composition scheme, 6% on what? Taxable supply plus exempt supply. The relaxation of not paying 1% composition tax on exempt supply is only for a trader. It's only and only for a trader. It is not for others. It's only and only peculiar to a trader. The trader, you pay 1% only on the taxable goods, not on the exempt portion. And whenever trader or manufacturer or restaurant, outdoor catering sector, they are paying 1% or 5%, it is not only on the goods or restaurant, outdoor catering, it is also on the small service portion. A trader can have trading of goods with a small, even on the small service portion, it is 1%. Manufacturer can have manufacturing of goods with a small service portion. Even on the small service portion, it will be 1%. A restaurant, outdoor catering can have restaurant and outdoor catering service along with small other service. Even on that small other service, it will be 5%. Because restaurant and outdoor catering 5%. Small other service, it will be 5%. In special composition scheme, you can have service with little goods. You will be paying 6% not only on the service but also on the goods portion. That is how you have to calculate your composition tax. You have to calculate your composition tax. And one very special thing in composition scheme, whether it is your previous year aggregate turnover, you use various turnovers, right? Previous year aggregate turnover for what? Entry. Current year aggregate turnover for what? Exit. You also use current year state turnover for what? Inner limit.
exit inner limit. You also use current year state turnover for what? Payment. You have previous year aggregate turnover for entry, current year aggregate turnover for exit, outer limit. Current year state turnover, that 10% of previous year state turnover. See, it is previous year state turnover, but that service should be in current year. So rather I will write this just because we have understood in that way. The calculation is based on previous year state turnover and the service should be there in the current year. So that we understand. So we will go with the same understanding. Percentages of previous year state turnover and service should be of current year. Current year state limit. Obviously current year you are going to see state by state. This is again exit point. This is again exit point, inner limit. And current year state turnover for, see, if I am working in Tamil Nadu and Tripura, my payment will be separately there in Tamil Nadu, CGST 0.5% and Tamil Nadu SGST 0.5%. If I am a trader. In Tripura, it will be 0.5% CGST and 0.5% Tripura SGST. It will be state to state. My return filing and all will be state to state. It will not be together one. It will be state to state. So that is again current year state turnover. You used 4 things. Previous year aggregate turnover for entry, current year aggregate turnover for exit, previous year state turnover to calculate inner service limit of current year. To calculate inner service limit of current year. Again for exit, and current year state turnover to calculate payment for current year. That is for payment purposes. In all these cases, whether it is previous year aggregate turnover, current year aggregate turnover, previous year state turnover for element, current year state turnover for payment purposes, interest on loans or deposits will not be counted. This is only and only for composition scheme, not for any other place in GST. Interest on loans and deposits will not be counted. It will not be included in the calculation. You are not going to count it. If it is there in the question, treat the question as if remove that amount and calculate the other numbers. If I tell previous year aggregate turnover is 160 lakhs, 145 lakhs normal and 15 lakhs interest on loan. So according to you, what will be a previous year aggregate turnover for composition scheme? 145 lakhs. 145 lakhs. Current year aggregate turnover you have crossed 150 lakhs, out of which 130 lakhs is normal and 20 lakhs is interest. So have you crossed the limit? No, because it is still 130 lakhs. You have to remove interest on loans and deposits. You are going to remove it entirely in all the places throughout composition scheme. Is it done in any other place? No. It is done only in composition scheme. It is excluded, and it is excluded throughout composition scheme for all the places. Number wise, there will be 4 numbers. Previous year aggregate turnover, current year aggregate turnover, previous year state turnover, current year. You remove it in all the places. You remove it in all the places. Are you guys clear with this understanding? Right. So that is all about your interest on loan portion calculation part. Very important point for your working out. You have to exclude it all the places. Throughout your composition scheme, remove it. If it is already removed, don't do anything. But if it is not removed, included, remove it. Remove your interest on loan. Right. Now, what is the leftover area in your composition scheme? We are done with the eligibility part, entry point, exit point, calculation point. Entry, exit, calculation, over. Other procedural points. Other procedural points. When you enter, can you enter composition scheme just like that? No. If you are already registered, if you are going from regular scheme to composition scheme, something special. If you're directly coming inside composition scheme, new registration, that is different. One is regular scheme to composition scheme. The first part is regular scheme to composition scheme. The second part is you're taking new registration, directly you're selecting if it is regular scheme to composition scheme, you have to give an intimation that you want to go for composition scheme before the next financial year starts. Which means if you want to go for composition scheme from 24-25 onwards, financial year 24-25, you have to give this intimation on or before 31st of March 2024. Before the commencement of that financial year. Before the commencement of that. And if you give that intimation before the commencement of that financial year, it will be effective from the beginning of the financial year. You will be working under composition scheme from 1st of April 2024. Can you enter inside composition scheme in between a year? No. If you're already working under regular scheme, you cannot enter inside composition scheme in between of a year. You can start from you can enter composition scheme only from 1st April of next financial year, which means the new financial year. Which means the new, for which you have to make sure that you are giving an intimation on or before the financial year starts. Before the financial year starts, not on or before. Before the financial year starts. You cannot give that intimation on 1st April. You have to give that intimation on or before 31st of March. And if you give that intimation, automatically from 1st of April of next financial year, you will be under composition scheme. Sir, I am already working under composition scheme. Should I give the intimation every year? No. You are already working under composition scheme. Fresh intimation is not required. If I am under composition scheme, next year should I give again intimation? No. By default, I will be continuing to work under. This is required when? Only when you are switching from regular scheme to, not when you are already under composition scheme. Now, when you are going from regular to scheme to composition scheme, one more thing will happen. You have to give another statement for reversing input tax credit on your stock of inputs and capital goods, which you have to do within 60 days from the beginning of the financial year. That discussion is there in your IDC chapter. What amount of reversal? Why? Under regular scheme you enjoyed input tax credit, under composition scheme you cannot enjoy input tax credit. There is some stock which is going to be sold in composition scheme, but already you have taken the credit. So you have to reverse that credit on your inputs and capital goods. That you have to do within 60 days from the financial year beginning. Right. Now, what if you are going for a new registration and in the beginning itself you want to opt composition scheme? Can you do it? Yes. If you are going for a new registration, when you are making application for registration, there itself select you want to go for composition scheme. In form REG01, which is a registration application, select you are interested in going for composition scheme, which means if it is new registration, can you enter inside composition scheme between of a year? During the year? Yes. But what you have to do? When you are filing registration application, select that you want to go for composition scheme. And when you do that, your effective date will be your effective date of registration. Your effective date of registration. That is all about your entry point. Now what about your exit point? Either you go out yourself or you are thrown outside by the officer. If you are going out yourself, there are two possible scenarios. One, you are not satisfying the condition. Therefore, within 7 days, you have to give an intimation that you are not satisfying the condition and switch over to from composition scheme to regular scheme. Understand that even if you don't give that intimation within 7 days, you are thrown out. Now the 7 days is not so crucial. Whether or not you give that information within 7 days, from that date you are thrown out. You are outside composition scheme. 7 days is the time for within which you have to give it. Even if you don't give it, from the date you violated the condition, you are thrown outside composition scheme. And when you are under regular scheme, you can take the credit, you will be giving tax invoice, etc., etc. That all points will come. Now, there is a second possibility. What is the second possibility? You are eligible for composition scheme, but you don't like composition scheme. First is, you want to go under composition scheme, but you are not fulfilling the criteria. Second is, you are fulfilling all the criteria, but you are not interested in composition scheme. Give an intimation, go out. The moment you give an intimation, from that time you are going out. Now that 7 days will not come because you have not violated any condition. You don't like it. You want to take ITC. Therefore, you tell that from today onwards, I don't want this composition scheme. One very crucial important point. Composition scheme to regular scheme can be between of a year. It can be in course of during the year. It can be during the year, in between of a year. That is possible. Composition scheme to regular scheme. Whether you have violated the condition or you don't like it, in both the cases, rather even if proper office is throwing out, in all the cases, you can go outside composition scheme to regular scheme in between of a year. That's possible. Now, what is the other criteria? You are not going outside. Proper officer is throwing you outside. So, obviously, he should give you show cause notice. Principle of natural justice. He will be giving you show cause notice. And you are required to reply within that show cause notice. What will the show cause notice will tell? Show cause notice will tell that proper officer is having reasons to believe that either you are not at all eligible for composition scheme or you are eligible, you have violated the conditions in between. Either right from the beginning you are not eligible or in between you violated the conditions. After you get the show cause notice, you have to reply within 15 days. After you reply or after 15 days, in case you don't reply from the end of 15 days, officer has to give an order within 30 days, either accepting the reply. Okay, I thought you are not eligible, I thought you violated the condition, but now after you reply, I am convinced that you are eligible, you did not violate the condition. Nothing will happen. Nothing will happen. But if proper officer is not satisfied with the reply, he will deny the option to pay under composition scheme. He will throw you outside composition scheme from composition scheme to regular scheme from a date from which you contravene the provision. So you have to understand that proper officer will throw you out from composition scheme retrospectively. He'll throw you out today, but from an older date. But a circular is there clarifying that older date cannot be any fancy date. It should be a date from which the conditions were violated. The conditions were violated. From that date, you are thrown outside. And by the way, when you are thrown outside composition scheme, you are thrown outside composition scheme not only from that state but also from all the states. So if you see this particular point, when you're going outside composition scheme, you're going outside composition scheme in all the states. And when you're going outside composition scheme, you can now take the credit. You can now take the credit within 30 days. You can tell that now on the stock of inputs and capital goods which I have, from the date I am shifting from composition scheme to regular, I will avail the credit. Again, this also is discussed in your ITC chapter. Regular to composition scheme, on the stock you have to reverse the credit. Composition scheme to regular scheme, on the stock you are allowed to avail the credit. On the stock you are allowed to avail the credit. So that is all about the procedural part which was left out in your composition scheme. Now one special point which is there given in the end is, what if you decide to take the benefit of both registration and composition scheme? What will happen? If you want to enjoy both registration limit of 40 lakhs, 20 lakhs, 10 lakhs, then enjoy composition scheme. They are clarifying that, assuming that you are in the state of Tamil Nadu, you are dealing only with goods. So your registration limit is 40 lakhs. So they are telling that till 40 lakhs, you are not going to get registered. Right? Assume that your turnover is crossing for Tamil Nadu for goods. Again, composition scheme limit is 150 lakhs. Finally, when you are ending your turnover, total it is 170 lakhs. It is your first year of business. Therefore, previous year aggregate turnover is satisfied. When you talk about 40 lakhs registration limit, you don't see previous year and all. You directly only see current year limit. You are going to get registered only when you are crossing 40 lakhs. From the time you are registered till 150 lakhs, you will be under composition scheme. After you are crossing 40 lakhs, you will be under. Please understand that here you are not registered. Then you are registered. The moment you are registered only under composition scheme directly. New registration, you can enter inside composition scheme in between. Then finally under regular scheme. What are they trying to tell here is, what are they trying to clarify rather? For the portion of 0 to 40 lakhs, your tax will be 0. Now for calculating 150 lakhs, you will not start from 40 lakhs. You will start from 0. It is not 40 to 150. It is not 40 to 190. It is not 40 to, it is again 0 to, see this is 0 to 40, this is 0 to 150, this is 0 to 170. So now for composition scheme, the earlier 40 lakhs will also be counted. But when you are making the payment, they give a logical clarification that composition tax will be only on 110 lakhs multiplied by, say if you are a trader, 1%. They tell that no need to pay on that 40 lakhs because you are already enjoying registration limit. See, at one point they tell that the earlier 40 lakhs will be counted for exit limit. Second point, they tell that for payment purposes, we will not touch it. For exit limit, we will count 40 lakhs. But for payment purposes, we will not touch. Otherwise, there is no benefit of enjoying the limit of registration. And for last 20 lakhs, you are going to pay regular tax, which is say 20 lakhs multiplied by, assume that regular tax is 18%. If you assume that regular tax is 18%, you will pay. So that part is clarified. That portion is clarified. I repeat, all these turnovers, be it 40 or be it 150 or be it 170, the starting point is 0. 0 to 40, 0 to 150, not 40 to 150, 0 to 150 and 0 to 170. The earlier 40 lakhs will be calculated for composition scheme with respect to exit. When you are seeing exit, you will even include the earlier 40 lakhs. But when it comes to payment, you will not include the earlier 40 lakhs because you did not get registered. You are enjoying the benefit of registration limit. So for exit purposes, that 40 lakhs was counted, but for payment purposes, that 40 lakhs was not counted. For exit purposes, when you are going to exit your composition scheme, the earlier 40 lakhs was counted, but for payment purposes, when you are making the payment, that earlier 40 lakhs was not counted. Earlier 40 lakhs means that limit till which you got the registration. Assuming you got the registration of 37 lakhs, so it will be 37 lakhs. You did not wait for 40 lakhs. You got registration right at 37 lakhs. Then you will not pay on 37 lakhs. On 130 lakhs, you will make the payment. You did not wait it for 40 lakhs. You got registration at 25 lakhs. Then on 25 lakhs, you will not make the payment. But on balance, 25 lakhs, you are not going to make the payment. Till the time you are required to get registered and you actually got registered, that amount will not be again included in payment. So for that exit purposes of composition scheme, 40 lakhs is counted. For payment purposes of composition scheme, you don't count that 40 lakhs. So that is the last small portion. Again, important portion. 2-3 times questions have been asked. Small but portion, but an important portion connecting 2 chapters: registration limit and composition scheme. You have to understand this in this particular manner. So that's everything about your composition scheme. A very, very important chapter. When you talk about your section 18, it talks about ITC in special circumstances. To be very specific, it talks about what scenarios? First, you're talking about a person who has gone from composition scheme to regular scheme, or a person whose supply initially was exempt supply, now it has become taxable supply, or you're talking about taking new registration. 3 scenarios: composition scheme to regular scheme, exempt supply to
taxable supply, taking new registration. When you're taking new registration, you have to take care. If you're liable for registration, you have to apply for registration within 30 days from the date you are liable for registration. If it is voluntary registration, no worry. If at all you are liable for registration, make sure that you applied for registration within 30 days. Application should be made within 30 days from the date when you are liable. This 30 days is very crucial, discussed in multiple chapters. So if at all you want to take the benefit of other points, including ITC, you have to make application within 30 days from the date you are liable for registration. When you're talking about these three cases here talks about your availment of credit. What are the three cases? Composition scheme to regular scheme. Your exempt supply has become taxable supply. You are not registered, now you are going for new registration. If you are liable for registration, you have to apply within 30 days from the date you are liable for registration. If you are taking voluntary registration, obviously there is no issue, there is no concept of 30 days. You are taking voluntary registration. This is all about your availment. When you talk about reversal, it is exactly ulta. You are going to composition scheme from regular scheme. So regular scheme to composition scheme. Then earlier your outward supply was taxable, now it becomes exempt supply. Or earlier you are registered, now you are cancelling your registration. Cancellation of registration. In the first three cases, it is all about availment of credit. Composition scheme to regular scheme, exempt supply to taxable supply, new registration. In the next three cases, ulta cases, regular scheme to composition scheme, taxable supply to exempt supply, cancellation of registration. Obviously, if you are under composition scheme or if your supply is exempt supply, if you are not registered, you cannot take ITC. So here the concept is all about reversal of ITC. Now why this availment and reversal is, by the way, coming? This is coming because when you are doing that conversion, on that particular date you will have some stock of inputs and capital goods, correct? On the date of conversion you will have some stock of inputs and capital goods. In the first scenario, on that stock of inputs and capital goods, you do not have taken the credit because you are under composition scheme, or you are having exempt supply, or you are not registered, or you are not registered. Now you are under regular scheme having taxable supply and registered. So what you will do on that stock, you will try to avail the credit. On that stock on which you have not taken the credit, now you will try to avail the credit, but because you are covered by regular scheme, your supply is taxable supply or you are registered. What happens in reverse scenario? Earlier you are under regular scheme taking the credit, having taxable supply taking the credit, registered taking the credit. Now you are under composition scheme, credit is not allowed, your supply has become exempt supply, credit is not allowed, you are cancelled your registration, credit is not allowed. So on that date, you have a stock on which you have already taken the credit. Now you have to reverse the credit. You have to reverse the credit. Now government shows its true color when it is all about your availment and reversal. When it talks about availment, it tells certain important aspects. If it is availment, you can avail the credit of inputs and capital goods. Inputs and capital goods. Inputs means inputs as such or lying as work in progress or in form of finished goods. You have to convert that work in progress and finished goods and bring it back to the number of units of inputs. You can take the credit on inputs and capital goods if it is availment. But if it is availment, you can take the credit of inputs and capital goods when you are talking about composition scheme to regular scheme, exempt supply to taxable supply. But when it is about new registration, you can take the credit only and only of inputs. Only and only of inputs. You cannot take the credit of capital goods. So when you're talking about composition scheme to regular scheme, exempt supply to taxable supply, you can take the credit that of inputs as well as that of capital goods. You can take the credit of inputs as well as capital goods. Inputs as well as capital goods. But when it is new registration, you can take the credit only of inputs, not of capital goods. But the same logic is not applicable for reversal. If it is reversal, whether it is regular scheme to composition scheme, taxable supply to exempt supply, you have to reverse the credit on inputs and capital goods. Reversal will be there on inputs and capital goods. Even if it is cancellation of registration, even there, reversal is on inputs and capital goods. So you can clearly find the difference. When it is availment, only focus on registration part. When it is availment, taking new registration, you cannot take the credit on stock of capital goods. You can take the credit only on stock of inputs. But if it is cancellation of registration, you have to reverse credit on the stock of inputs as well as capital goods. So it is not fair. It is not on equal balance. There is no balance here. When it is availment for new registration, only on inputs, not on capital goods. When it is reversal for cancellation of registration, reverse both on inputs as well as capital goods. It doesn't stop here. When it is availment, you cannot avail the credit of stock, be it inputs or be it capital goods, if it is older than 1 year. If it is older than 1 year from the date of conversion, when the conversion date is happening, go back and see 1 year. Only that last 1 year stock, be it inputs or capital goods, you can take the credit. So stock should not be more than 1 year old. Stock of inputs as well as stock of capital goods should not be more than 1 year old. So credit is not allowed if the stock is older than 1 year. But for reversal, you don't find a corresponding point, which means whether the stock is within 1 year old or more than 1 year old, you have to reverse on everything. For availment, stock should be within last 1 year. Supposing you have stock of inputs 10 lakhs, out of which 8 lakhs is last 1 year, 2 lakhs is older than 1 year. You can avail the credit on stock only of 8 lakh units. But if it is reversal, you have to reverse on entire 10 lakh units. That doesn't stop here. If you have to avail the credit, you have to make application in ITC 01, a special form, within 30 days plus extension. Within 30 days plus, if you don't apply on time, forget about the credit. If at all you are going to reverse the credit, you have to file a form, either it is GSTR 10 for cancellation of registration or ITC 03 for your taxable supply to exempt supply or your regular scheme to composition scheme. But whether you apply on time or you don't apply on time, that will be reversal. If you want the credit, you make application within 30 days plus extension. But if you have to reverse the credit, whether you make that application, there are two forms for cancellation GSTR 10 and for other conversion ITC 03. Whether you apply on time or after time, you have to do reversal. If we are doing late, you have to do reversal with interest. And for availment, when you are availing it, the amount is more than 2 lakhs. It has to be certified by a CA or a CMA. It has to be certified by CA or CMA. But here, there is no such point. There is no need of certification by CA or CMA. At times, you require certification by CA or CMA if at all you are not able to find the market value. Not for 2 lakhs. If the reversal amount is 2 lakhs, 20 lakhs, 2 crores, no certification. So then why the certification is required? This certification is required because when you are trying to find out the value of the stock, you know that is 10 lakh units. But you are not able to find out one-to-one linkage, this 10 lakh units are purchased one. You are trying to find out the market value. For that market value, CACW certificate. Not for the value, not for the amount of reversal of credit. So normally CACW certificate, CMA certificate will not come. The CMA certificate will come if at all you have difficulty in finding out the value of the stock. Otherwise, it will not come. But here for availment, even if you are able to find out the value of the stock, come with CMA certificate if the ITC availment is more than 2 lakhs. And ITC that is availed will come and sit in your credit ledger. And ITC that you are going to reverse, you have to either reverse from your
credit ledger if you have the amount in credit ledger, or if you don't have, you have to pay by cash. The irony is, after supposing you have to reverse 10 lakhs, in your credit ledger you have 8 lakhs, you have to pay 2 lakhs by cash. Supposing you have to pay reverse 10 lakhs, in your credit ledger you have 15 lakhs. So you will not pay anything by cash. That extra 5 lakhs that you have will lapse. That extra 5 lakhs that you have will lapse. There is no logic, no rational. It's only government's point of view that they are trying to do this. You can see clear-cut differences between your availment and reversal. Not only for registration and cancellation, that was one special point, but all the other points, whatever other points that we have discussed, it is true for all scenarios. All scenarios, composition scheme to regular scheme, exempt supply to taxable supply, taking new registration. Regular scheme to composition scheme, your taxable supply becomes exempt supply, cancellation of registration. It's true in all the scenarios. That only one point was that specifically for registration and cancellation of registration. All the other points that we have discussed, your age, 1 year, certificate, CA, CMA certificate, 2 lakhs, right, application within 30 days. All of them are applicable for all the cases, not only for your registration and cancellation of registration. Now, there's one more difference when you talk about availment. For capital goods, you have a separate method to calculate how to get the credit of capital goods, separate method for reversal. Now, let us take one example to understand both. Supposing on 10th of April 2023, you have purchased a capital goods on which ITC happens to be, say, 1 lakh. ITC happens to be, say, 1 lakh. This conversion is happening. Supposing the conversion from composition scheme to regular scheme happens on 1st of December 2023, or conversion is there from taxable supply becoming exempt supply. This is happening on 1st of December 2023. I'll change the date and I'll make it as 10th of June. 10th of June. I'll change it to 10th of June. Right. Now, please understand how things will work out. And this date, this conversion date, I'll make it as 1st of November. 1st of November. Now, here is a scenario where you are talking about availment of credit. Correct? Composition scheme to regular scheme. Here is a scenario where you are talking about reversal of credit. Specifically for availment of credit, I have not taken the case of new registration, because in new registration, you can avail the credit only on stock of inputs, not of capital goods. So I have taken care of that. And in case of reversal, in any case, reversal will be there. Even in case of cancellation of registration, reversal will be there on capital goods. How to calculate it? How to calculate the numbers? For availment of credit, it is subtraction method that we have already discussed. Subtraction method. Availment of ITC. It is the credit amount 1 lakh rupees minus 1 lakh multiplied by 5% per quarter or part thereof. So the quarter will start from 10th June to 1st number. How many quarters? Quarters always represents calendar quarters. So how many calendar quarters? 3 calendar quarters. 1st June to 30th June, 1. 1st July to 30th September, 2nd. 1st October to 1st November, 3rd. 1st October to 1st November, 3rd. How many calendar quarters are there? 3. But if you normally do quarter calculation, how many quarters would have been there? July, August, September, October, November. It would have been 2. But calendar quarters are? So calendar quarters are 3 calendar quarters. So how many quarters will subtract? 3. So what will be the answer? 85,000 rupees. 85,000 rupees is the availment. For availment, what method you go? You go with subtraction method. For reversal, you will go with multiplication method. Now, how many quarters are over? How many months are over? Multiplication method focuses on months. From 10th June to 1st November, how many months are over? How many months are over? Now months, it is not calendar months, it is normal months. No, normal months. 10th June to 10th July, 1 month. So 10th July, August, 10th September, 10th October. So how many months? 4 months. 4 months. You'll find 4 months. And you'll have 21 days. 4 months, 21 days. Now this 4 months, 21 days will be treated as, whether it is 4 months, 2 days or 4 months, 21 days, it will be treated as 5 months. Don't think that it is going by round off. Whether it is 4 months, 2 days or 4 months, 20 days or 4 months, 29 days, it will be treated as 5 months. Now what are the balance months? In GST, capital goods life is taken as 5 years. And that is the reason you subtract 5% per quarter of part thereof. So if for 1 quarter you are subtracting 5%, for 1 year it will be 20. For 5 years it will be 100. So 5 years. Even here, months basis. So 5 years will have how many months? 60 months. So what will be the reversal? 1 lakh multiplied by balance months. What is the balance months? 60 minus 5. What is the total number of months? 60. So what will be the answer? 91, rounding up to nearest rupee 1. So for capital goods, availment you have subtraction method, where you go with calendar quarters. For reversal you have multiplication method, where you go with normal months. And multiplication is 1 lakh multiplied by balance months. Balance months ignoring part of, which means if it is 4 months, 2 days, completed period, you have to take it as 5 months. So balance months will be 55 months divided by 60 months. That is how you are going to do the calculation. Are you guys clear with this understanding? For availment, it is a different calculation for capital goods. For reversal, it is a different calculation for capital goods. And the last point, when you talk about registration, there was one special point for registration, if you recollect, which was not applicable for your composition scheme to regular scheme or your exempt supply to taxable supply. When it is all about registration, you can take credit only of inputs, not of capital goods. But if it is cancellation of registration, you have to reverse both on inputs and capital goods. For cancellation of registration, there is one more special point, which is not there for the other two cases: regular to composition scheme, taxable supply to exempt supply. When you're taking new registration, there is one special point: you cannot take the credit of stock of capital goods. When it is cancellation of registration, you have to reverse on stock both of inputs and capital goods. That's a normal point for other two cases also. One special point here: when you're doing that reversal, you have to do that reversal based on the calculation that we have discussed. For inputs, it is very normal calculation. See the number of units of inputs and do the workings. For capital goods, multiplication method. For capital goods, multiplication method. Compare it with output tax payable. You have to calculate output tax on the stock of inputs and capital goods, whichever is higher. Simple reason: it is deemed supply. It is deemed supply. If you recall, when we have discussed your levy chapter, VJ registered is different from VJ unregistered. When I am cancelling my registration, it is as good as I am supplying goods to myself. VJ registered is supplying goods to VJ unregistered. When it is deemed supply, you have to calculate output tax. So here you will be having one part, your ITC calculation. For inputs, just do 1-to-1 linking and calculate input tax credit on the stock of inputs. For capital goods, multiplication method. Compare that with output tax payable. Surely that answer will be different. Why? Your output tax payable will be based on what? Open market value multiplied by the rate on those items. It has got nothing to do with ITC. Nothing to do with ITC. Whichever is higher because of deemed supply. Because of this will not be there for regular scheme to composition scheme, taxable supply to
exempt supply. It is only there for cancellation of registration. So when you talk about your regular scheme to composition scheme, taxable supply to exempt supply, a very normal working is that, nothing special. Only when you're talking about cancellation of registration, you will find something special. Output tax. This portion is same. You'll find something special. ITC calculation as in section 18, compare with output tax payable, whichever is higher. Whichever is higher. That's all about your section 18. The two parts, one about availment, one about reversal in certain cases of conversions. Now, the other two areas which are left out. The first part of section 18 we are done with. The other two areas which are left out. The main area which ICA focuses a lot of times, which is sale of capital goods. Section 80 read along with rule 40. Sale of capital goods of plant and machinery on which ITC is availed. When you are selling your capital goods, it is nothing but supply, outward supply. So when you are going to calculate the payment, it is tax on transaction value, which is nothing but selling price multiplied by the percentage, or depreciated ITC, which is nothing but ITC minus ITC multiplied by 5% number of quarters. Subtraction method, whichever is higher. You have to go with whichever is higher. On one side, you take the selling price. You have sold the capital goods, it is like normal sale, take your selling price multiplied by the GST rate. On the other side, on those capital goods, you would have availed ITC. Take the ITC, subtracted by ITC, multiplied by 5% per quarter or part thereof. This calculation of per quarter or part thereof will start from where? This calculation of per quarter or part of quarter will start from where? From the date of purchase of capital goods till the date of sale of capital goods. And the focus is on normal quarters or calendar quarters. In GST, always quarter represents, compare whichever is higher, pay that amount. Pay that amount. Clear? That is for your sale of capital goods. A very important and repeatedly asked question. So you'll be having two answers. First part, selling price by multiplied by the rate. Second part, ITC subtracted by 5% for every quarter. But there are special cases where you will not go with depreciated ITC. When? If the capital goods happens to be refractory bricks, molds, dies, jigs and fixtures. These capital goods are normal use in job working sector and you cannot identify after some time. You cannot identify them. Therefore, when identification is difficult, calculation of when it was purchased and when it is sold is not possible. So when you talk about refractory bricks, molds, dies, jigs and fixtures, which are very normal use in job working, when they are sold as scrap, what to do? Special capital goods, when they are sold as scrap, what to do? Forget about depreciated ITC. Very normal calculation. What is a very normal calculation? Tax on transaction value. What is the tax on transaction value? Selling price multiplied by the rate. There is no second calculation. That is directly selling price multiplied by the rate. For which case? Which all cases? Refractory bricks, molds and dies, jigs and fixtures, where identification of that particular item is not possible when they are sold as scrap. When they are sold as scrap, you cannot identify. When they are sold as such, if at all these items are sold as such, I purchased them after 2-3 months, I sold as such, then what calculation will come? Tax on transaction value or depreciated ITC, whichever is higher, because now I can identify them. When they are sold as scrap, I cannot identify them. Therefore, selling price multiplied by percentage, that is nothing but tax on transaction value. That's all. That is the calculation as per section 18 read along with rule 40 when there is sale of capital goods. And finally, you're talking about your transfer of ITC. Transfer of ITC. In total 4 cases. How to understand these? 4 cases. When there is sale of business, sale or transfer of business. Second, there is amalgamation or merger. Third, there is demerger. Then there's one more case that will happen. If at all you're talking about sale of business, VJ Limited is selling the business to PJ Limited. If at all there is any credit that is there lying in the electronic credit ledger of VJ Limited, supposing the credit lying is 10 lakhs, can VJ Limited take the credit, refund of credit? No. Refund of credit is not possible except in two cases: zero rated supply and inverted duty structure. What is the only possibility? Transfer that credit to PJ Limited. You can transfer that amount of credit to PJ Limited, the transferee. But there is a condition. What is the condition? Condition is PJ Limited should be taking all the liabilities of VJ Limited. Transfer of liabilities. What if there is amalgamation? The same concept. PJ Limited and PJ Limited, assuming it gets amalgamated into VP Limited. Now, in case of amalgamation and merger, what will happen? Assume that the amount of credit in electronic credit ledger of VJ Limited is 1 lakh and in electronic credit of ledger of PJ Limited is 5 lakhs. What will happen? This 1 lakh as well as 5 lakhs can go to VP Limited and it can get the credit ledger as 6 lakhs. Normal addition. But the condition remains the same. Both VJ Limited and PJ Limited should transfer the liability to VP Limited. Now, what happens in case of demerger? Something different when you talk about your demerger. What is that something different when you talk about your demerger? Calculation part. Supposing VP Limited demerges or splits into VJ Limited and PJ Limited. And if there is a credit ledger balance in VP Limited, say 20 lakhs, can it be given to VJ Limited and PJ Limited? Yes. It can be given to VJ Limited and PJ Limited. The condition remains the same. Condition is VP Limited should transfer the liability both to VJ Limited and PJ Limited jointly and severally. Transfer of liability. But now, how will the calculation will be done? The calculation will be done on the basis of some ratio. What is that ratio? 20 lakhs multiplied by something divided by something. 20 lakhs multiplied by something divided by something. That ratio is that of value of assets. If the value of assets of VP Limited is 10 crores and the assets are given in the ratio of 6 crores and 4 crores, VJ Limited will get 6 by 10, PJ Limited 4 by 10. So 12 lakhs and 8 lakhs. The calculation is based on what? The calculation is based on value of assets. And there is a clarification given. When you talk about value of assets, it is not only those assets on which ITC is taken. Value of assets means all the assets, whether or not ITC has been availed. So question may try to confuse you. Out of 10 crores, only on 8 crores ITC is availed, and those 8 crores has been split into VJ Limited and PJ Limited equally into 4 crores and 4 crores. Whether you will go with 6:4 ratio or 4:4, you will still go with 6:4. Value of assets means all assets. Don't see the assets on which ITC was availed. Don't specifically see the assets on which ITC was availed. Are you guys clear with this understanding? Right. Now, when you talk about the last case is similar to demerger. You are going for multiple registration, which is an option to you. It is similar to demerger.
Now what is happening? There's only one company, say VJ Limited. Initially it was having only one GST number. It decided to go for multiple GST number. GST number 1, GST number 2, GST number 3. So from one GST number, it is deciding to go for multiple GST number. One is same, other two GST number. The first GST number remains the same. It has taken other two GST number. That's an option for you to take multiple GST number if you're having multiple places of business within the same state. This is happening in the same state. If you're working in different states, obviously you have to go for multiple registration. You're working in same state. Initially you had one registration. Now you're deciding to go for multiple. Don't you think that it is just like demerger? Just like demerger. If the electronic credit ledger balance is 10 lakhs with GST number 1, how can it distribute? Now let us try to understand the difference first. First, there's no such condition of transfer of liabilities because VJ Limited remains VJ Limited. Though it is going for multiple GST number, the person remains same. So obviously liability will be there of VJ Limited. There's no point of discussing that should be transfer of liability. Second difference, in all the other cases, there was a requirement of CA, CWA certificate. In all the other cases, in addition to transfer of liability, there was a requirement of CA, CWA certificate, irrespective of the value. Not 2 lakhs and all. CA, CMA certificate. Right. Cost management accountant or cost works accountant. CA, CMA certificate. Irrespective of the value, there was a requirement of CA, CMA certificate. Here, there's no such requirement. There's no such requirement. You don't have to go for CA, CMA certificate. Sir, whether the CA, CMA certificate is required, only the value is more than 2 lakhs or all cases? All cases. Sale of business, amalgamation, merger, demerger, you have to go with, along with that particular form, you have to go with irrespective of the value. But now there's no requirement of CA, CMA certificate. So you will find two clear-cut differences. One, no condition of transfer of liability. Second, no CA, CWA certificate because it remains the same. It is within the same company's different GST number. Third, now calculation is a bit different. How? You have multiple options. Either to give this entire GST, keep it with registration 1 itself, or give it entirely to 2, or give it entirely to 3, or give it to 1 and 2, or give it to 1 and 3, or give it to 2 and 3, or split between 1, 2 and 3. Either to have itself, or give it to GST number 2, or give it to GST number 3, or give it to GST number 1 and 2, give it to GST number 2 and 3, give it to GST number 1 and 3, or split between 1, 2 and 3. That option is you are having, which was not there in demerger. In demerger, you have to give to all. Here, either have it with yourself or give entirely to second GST number, entirely to third GST number, or give it to 1 and 2, or 1 and 3, or 2 and 3, or 1, 2 and 3. Whenever you are giving to multiple GST number, you have to go with the ratio of value of assets. On not ad hoc basis. At all you are deciding to give to 1 and 2, go with the value of assets split between 1 and 2. 1 and 3, go with the value of assets split between 1 and 3. 2 and 3, go with the value of assets split between 2 and 3. 1, 2 and 3, go with the value of assets split between 1, 2 and 3. So there you have to go with the calculation. So clearly you find 3 differences. Clear cut, you find 3 differences. First, no such condition. Second, no CACW certificate. Third, you are having multiple ways of distributing. Multiple ways of distributing, which was not there in demerger. Which was not there in demerger. Are you guys clear with this understanding? Are you guys clear with this understanding? Right. Also understand that in demerger there's a lengthy circular running to 5-6 pages. The concept is pretty simple. When you talk about the ratio,
When you talk about the ratio is based on the demerger date. When you talk about the ratio, we are talking about your demerger. When you talk about the ratio of value of assets is based on the date of demerger. But what amount of ITC is distributed is based on date of transfer of ITC. Demerger may have happened on 1st of April, but you are transferring the credit on 1st of December. So the ratio is based on the date when demerger happened. You see the value of assets. But ITC, which is going to be distributed, you will be taking what? You will be taking the ITC that is available when it is transferred. See, as on date of transfer, if there is no ITC, there is no question of any distribution. It cannot be ITC which was available at the time of demerger. It is ITC which is available when you are actually transferring it. Why? What is the formula that you require? ITC multiplied by the ratio. So ITC is as on the date of transfer and ratio is as on the date of demerger and earlier date. And when you go with this demerger, the third special point, when you go with this demerger, when you split the ratio, you split the ratio in totality. You don't split it CGST, SGST, IGST wise. In total, I have to give VJ Limited, say in our example, 6 lakhs and no, I'll take that example itself. 12 lakhs and 12 lakhs and 8 lakhs. I have to give 12 lakhs to VJ Limited, 8 lakhs to PJ Limited. But my ITC will be IGST, ITC, CGST, IGST and SGST, ITC. Out of that total ITC, if I add all the three, it was 20 lakhs, which I have decided to give 12 lakhs to VJ Limited and 8 lakhs to PJ Limited. Assume that ITC in total, ICNS was, total amount was 20 lakhs. So we'll take 10 lakhs, 5 lakhs and 5 lakhs. This was available with VP Limited. Now how much I have to give to VJ Limited? How much I have to give to PJ Limited? Right. What was the ITC available? I have to give PJ Limited 12 lakhs. I have to give PJ Limited. I need not give the same ratio all. In totality, I have to give 12 lakhs to VJ Limited. I may decide one option. I mean, if you talk about the total number of permutation combination for this answers, it will run in lakhs. Right? If you understand a bit of permutation combination, you'll have, I mean, answers in lakhs, different types of answers. Why? It is only not between two companies, it is also between CS and I, and numbers will keep on varying. So one such possibility, I split that 10 lakhs, VJ Limited will take 10 lakhs IGST and 2 lakhs CGST, totally 12 lakhs, and PJ Limited will take 3 lakhs CGST and 5 lakhs SGST. That they can decide. Or multiple answers. PJ Limited will tell that no, I want the best ITC is IGST. I want 10 lakhs IGST ITC and I'll take 2 lakhs SGST ITC. Can be so many permutation combinations of answers. In toto, it is 12 and 8. In the heads, they can decide. In the heads, they can decide. You're getting that? In toto, it is 12 and 8. It is not always strictly in the ratio of 6:4. It is not always 6 lakhs, 4 lakhs, 3 lakhs, 2 lakhs, 3 lakhs, 2 lakhs. No. In totality, it is 12 lakhs and 8 lakhs. In the heads, you can decide among yourself. And the last special point of the circular. If at all this demerger is happening in multiple states, all these ratios will be applied state-wise. All these ratios will be applied. All these ratios and ITC will be going state-wise. The circular runs into 5-6 pages, but the summary of the circular is very simple. The demerger is happening. How to see? Our calculation is ITC multiplied by the ratio. ITC is as on the date of transfer of ITC. Ratio is as on the date of demerger. If it is happening in multiple states,
If the company is having presence in multiple states, then automatically demerger happens in multiple states. So the ratio as well as ITC will be seen state-wise, not pan-India wise. If you see pan-India wise, you'll get one answer. And if you see state-wise, you'll get a totally different answer. So you have to go with state-wise. A very simple reason. Registration is state-wise. So this distribution will also be state-wise. Therefore, the calculation should be always obviously state-wise. And finally, when you divide in state-wise based on the ratio on the date of demerger, ITC on the date of transfer, final answer that you get between the demerged companies, that is the final answer in totality. In the heads of IJC, CJC, SJC, they can decide themselves. Both the demerged companies can decide, both the final companies which is coming out of demerger can decide among themselves. They can decide, okay, 12 lakhs and 8 lakhs. We have to take in totality. How to distribute IJC, CJC, SJC, they can decide among themselves. So that is the entire circular which is talking. This question, the 4 special points that I asked, believe me, it is a question worth 8 marks. Again, believe me, IC has never asked it. But if at all it is asking, it is worth 8 marks. And if you have not seen the circular, if you have not seen these 4 special points, you will not be in a position to crack it. But if you have seen once, only once, you will be easily crack it. It is simple mathematical calculation. All are very logical. Demerger is ratios as on the date of demerger. ITCs should be as on the date of transfer, because if I don't have any ITC on that date, it really doesn't make sense. And calculation is state-wise, because registration is also state-wise. But this last question point, only if we specifically address, that will make sense. In totality, it should be split. In the heads, they can decide among themselves. So that is all about your section 18 special cases. So when you talk about the concept of proportionate credit, it is discussed in your section 17 read along with rule 42, 43 in general. For banking sector, there is a special provision, rule 38. So when you talk about proportionate credit, why it comes? It is because you are having certain input services or capital goods which are partly used for business purposes and partly used for non-business purposes, or you have certain input services, capital goods which are partly used for making taxable supplies and partly used for making exempt supplies. Always understand that your zero rated supply will always be coming along with taxable supply. Why? Even if you don't pay output tax on zero rated supply, you can still get input tax credit. So they will be always along with your taxable supply. So that is the reason you have your proportionate credit under rule 42 and 43. First, we'll try to understand your rule 42, which is for your common inputs and common input services. Let us understand here that your total ITC on your inputs and input services. We are not talking about capital goods now. 42 discusses only about inputs and input services. Total input tax credit on your inputs and input services. Let us assume that it is 10 lakhs. Now, out of which there will be part of input and input services which is not eligible, block category, which is not eligible. Say we'll keep this 2 lakhs. Block category includes exclusively used for non-business purposes or exclusively used for exempt supply. Either blocked or used only for non-business purposes or used only for exempt supply. Now, out of that, you have a part of input and input services which is exclusively used for business purposes and exclusively used for taxable supply, including zero rated supply. Let's assume that is amounting to 3 lakhs. What is the balance credit? Balance ITC on your input and input services. Your balance ITC that will be there will be 5 lakhs. Understand what will happen. What is going to happen in your rule 42 specifically. You are talking about input and input services. The entire focus is only on your
Rule 42. Rule 42. Common inputs and input sources. Understand that 2 lakhs is fully blocked or only used for non-business purposes or only used for exempt supply. It will never go and sit in credit ledger, 0. 3 lakhs is fully used for business purposes, fully used for taxable supply, and it is not blocked. It will go and sit in credit ledger fully. You are eligible for full ITC, you are getting full ITC. 2 lakhs, you are not eligible, you are not getting. 3 lakhs, you are fully eligible, you are getting. With respect to 5 lakhs, you are eligible partly because it is partly used for taxable supply and partly for exempt supply, or partly for business and partly for non-business. You are not eligible fully, but you get full 5 lakhs. Initially, you will get full 5 lakhs. So you get how much credit in your credit ledger? You get how much credit in your credit ledger? 8 lakhs. You get credit ledger totally 8 lakhs. 8 lakhs in totality, you get the amount in your credit ledger. You clearly know that you are not eligible fully for 5 lakhs, but you have got full 5 lakhs. Now there will be reversal of ITC. There will be reversal of ITC to the extent of 5 lakhs. So first you will get full 5 lakhs, then you will reverse it. Now that reversal is 5 lakhs multiplied by exempt turnover in that month divided by total turnover in that month. Obviously, you are talking about state turnover. Calculation, state turnover. Calculation, state turnover. Why you are taking numerator as exempt turnover? Because you have to make reversal. That reversal will be to the extent of exempt turnover. Exempt turnover. If exempt turnover is assume that 5 crores and total turnover is and taxable turnover is 10 crores. So multiplied by 5 divided by 15. Multiplied by 5 divided by 15. Exempt turnover 5 crores. Taxable turnover in that month is 10 crores. So total turnover is 15 crores. So 5 lakhs multiplied by 5 crores divided by 15 crores. So this reversal will happen always. This first type of reversal will happen always. Second type of reversal will be there only if question is specifically mentioning it. If question tells that there are few inputs and input sources which are used for business and non-business purposes, then you have to reverse second thing, 5 lakhs multiplied by ad hoc 5%. Ad hoc 5%. Reversal type 1 will always come. This will come only and only if question is specifically asking, giving information that few input sources are used for business as well as non-business. The first type of reversal is because your input and input sources are used for exempt supply as well as taxable supply. The second type of reversal is because it is used for business purposes as well as. Second type of reversal will not come generally. It will come only if the question is specifically giving that information. That's all. That's all. That's the working of your rule 42. Every month on month you have to do it. Every month on month you have to do it. So that is the first part of your rule 42. Monthly you have to do it. Monthly what you will do? There are 3 categories, correct? The first category, blocked, don't take it. Second, fully eligible, take it fully. Third, partly eligible, initially take it fully, then do the reversal. Reversal how many times? 2 times. One, that common ITC, not entire ITC. You did not take 8 lakhs. You took how much lakhs? You took only 5 lakhs. That common credit multiplied by exempt turnover in that month divided by total turnover in that month. Right. Now, second type of reversal will be there if the question tells that the input and input sources are used both for business and non-business. Then take 5 lakhs multiplied by 5%. Otherwise, second type of reversal will not come. This you will do every month. This you will do every month. So, you will have rule 42 reversal, which is done on monthly basis. This is done on monthly basis. Say April month, May month, June, July, August till March month. Assume that total reversal that you have done during the entire year amounts to 10 lakhs. Now, you have to do a cross check, year end cross check. Rule 42 reversal, same formula that you have to do. You are going to do a year end check. In the year end check, there will be only one formula. Same formula. Same formula. That common credit multiplied by exempt turnover month divided by total turnover month will be replaced by year. Will be replaced by. So now in the same formula, month will be replaced by year. You will get only a straightforward single answer, correct? You will get straightforward single answer. That amount, believe me, it will never match this amount. Never. Even by coincidence, it will never ever match this amount because you cannot have the same ratio of exempt turnover, total turnover in all the months. Now that amount may come to 9 lakhs, it may come to 13 lakhs. If it is coming to 9 lakhs, what is the meaning? You already reversed 10 lakhs. Now, finally, when you check, you should have reversed only. What you have to do? Take self ITC of balance 1 lakh within the time period on or before 30th of November of next financial year. Within the time limit. Take self credit. Take self credit. What in the second case? What in the second case? You should have reversed 13 lakhs, but how much reversal you have done? How much reversal you have done? You have to reverse or pay the extra amount, which is 3 lakhs with interest at 18% per annum starting from 1st April of next financial year till the actual date of reversal or payment. They don't tell that you have to reverse right from the date of availment because you are following the formula. So interest will start from where? 1st April of next financial year. They are expecting you to do that reversal sitting at 31st March midnight, which is not possible, which means obviously you will end up paying some interest. So you have to pay with interest. So you have to do a year end check. Question will never ask about year end check, never ever. They'll talk about the monthly calculation, which we have discussed here itself. They'll stop at your monthly calculation. This year end check question, if that has to be drafted, it has to be a very lengthy question, giving the monthly reversal information. Then you have to do a year end check. When you are doing a year end check, you will apply the same two formulas. Reversal type 1 is common credit during the year, not during the month, multiplied by exempt turnover during the year, divided by total turnover during the. Reversal 1 will be the same. Reversal 2 will come only if at all there are some inputs and input services used for business and non-business. There reversal 2 will be common credit during the year multiplied by 5%. See, this was all during the monthly calculation. This was all during the replace month by year. You will get an answer. The answer will never be same when you compare with the total of all the months. If you have to finally reverse 9 lakhs, but you have already reversed 10 lakhs, don't worry. Take the balance self credit of 1 lakh within the due date, that is 30th November of next financial year. If you should have reversed 13 lakhs, but you have only reversed 10 lakhs, then what to do? Pay the extra 3 lakhs with interest at 18% starting from 1st April of next financial year till the date of reversal of actual payment. That will happen. So that is all about your rule 42. Rule 42. So this completes your understanding of your rule 42. The moment you talk about your rule 43, it is somewhat similar. The moment you understand the concept of rule 42, rule 43 becomes very simple. The same logic will apply. Basically, the same logic will apply. There are certain differences as well which we'll try to understand, but basically the same logic will apply. Now, let us focus on your rule 43. Let us focus on your rule 43. Assume that your total ITC on all the capital goods is same 10 lakhs. Out of which capital goods 1 was either blocked or non-business usage or exclusively used for exempt supply. That was capital goods 1. We'll take the same numbers, 2 lakhs. Capital goods 2, it was fully used for business purposes and fully used for taxable supply. Capital goods 2. Let us assume that that is 3 lakhs. Now balance ITC. Balance ITC which is of capital goods 3. What will your balance ITC? 5 lakhs. Balance ITC of capital goods 3 will be 5 lakhs. Same numbers I have taken. I have gone with an understanding that will make the life simple. We'll go with the same figures. We'll go with the same figures. What will happen? 2 lakhs. The breakup of 10 lakhs is 2 lakhs, 3 lakhs and 5 lakhs. 2 lakhs. It is not eligible. It will never hit your credit ledger. 3 lakhs. It is fully eligible and you will get fully in your credit ledger. 5 lakhs. It is partially eligible. Partly used for taxable supply, partly used for exempt supply, partly eligible. But initially you will get fully in your credit ledger. Initially you will get fully in your credit ledger. Later on you are going to reverse ITC, which is technically called as addition to output tax liability. Difference number 1. That we call it as reversal of ITC, which means you will be reversing from your ITC figures. This will be added to your output tax liability. It will make a difference. It will in fact make a difference. It will be added to your output tax liability. Difference number 1. That there were 2 types of reversal, correct? Reversal 1, reversal 2. Here there is only 1 type of reversal. Second type will never come. Second type will never come. Second difference. Third. What was the calculation there? Take your 5 lakhs. Multiplied by exempt turnover divided by exempt turnover in that month divided by total turnover in that month. It seems to be same, but there is one addition. 1 divided by 60. You have to do that reversal for this month and do it continuously for next 59 months. You have to keep a track. Now, out of this figure, this will be a constant figure. This will be a variable. It will keep on changing every month. Because your exempt turnover of every month divided by total turnover of every month will keep changing. Will keep changing. Right. So, what are the differences that you can evidently find? 1. It's not reversal of ITC. It is addition to output tax liability. 2. There is only first type of reversal. You don't have the second type of reversal where it talks about business and not business. Not there. 3. In the calculation part, you have 1 divided by 60, which means you will do that reversal for this month and the reversal amount will be very small compared to that 42. Because you are doing that reversal in this month and you will be continuously doing that reversal for the next 59 months. The figure of 5 lakh multiplied by 1 divided by 60 will be same for this month and next 59 months. What will keep changing? Exempt turnover divided by total turnover of each month will keep changing. Of each month will be keep changing. And the last difference, there is no year-end check. There is no requirement. There is no year-end check. Why? When you are doing that 1 divided by 60, you are doing for this month and the next 59 months, automatically that check will be there. There is no year-end check. There is no year-end check. See, why year-end check is required? To see whether assessee is trying to manipulate the numbers. Willfully postponing exempt turnover when ITC is very high. But this is not the problem in capital goods because assessee cannot manipulate the numbers for next 5 years. He cannot postpone his sales for the next 5 years. Not possible. There is no need of year-end check. No need of year-end check. These are the 4 differences. What are they? What are the differences? Addition to output tax liability. No second type of reversal. 1 divided by 60 in the calculation. Do it for the next 59 months also. And finally, there is no year end check for a very simple reason, because you are going to do this reversal for this month and the next 59 months and the next 59 months. That is all about your calculation in your rule 43. Rule 43. But yes, there is something special in your rule 43 which theoretically I cannot explain. Therefore, we'll take an example and wind this up. It cannot be explained. Till now, we have understood that these three capital goods were used for only exempt supply or only taxable supply or for both. What if initially it is used for only for exempt supply, later on it is used for both? What if initially it is used only for taxable supply, later on it is used for both? Let us try to understand this with the help of this example. In April 2020, we are continuing rule 43. We are still discussing capital goods. In April 20, Tata Limited purchases the following capital goods. Capital goods A, GST 50,000, fully used for exempt supply. Whether 50,000 will hit the credit ledger? No. Capital goods B, GST 1 lakh, fully used for taxable supply. Whether 1 lakh will hit the credit ledger? Yes. Capital goods C, GST 1,50,000 used for both taxable supply and exempt supply. Whether entire 1,50,000 will hit the credit ledger? Yes, but it will hit, but you have to reverse it. But technically it is not called as reversal, it is called as addition to output tax liability. What will be that addition to output tax liability? That addition to output tax liability will be 1,50,000 multiplied by 1 divided by 60 multiplied by exempt turnover divided by total turnover. This is given in two steps. 1,50,000 multiplied by 1 divided by 60 will give you 2,500. That 2,500 multiplied by exempt turnover. What was the question? Exempt turnover is 1 crore. Taxable turnover is 2 crores. So the ratio is 1:3. So 1,50,000 multiplied by 1 divided by 60 multiplied by 1 crore divided by 3 crores. What will be the addition to output tax liability? This will be the addition to output tax liability, 833. And by the way, understand that, don't think that you took the credit of 1,50,000 and you're reversing only. No, because this reversal will be for this month and the next 59 months. Why we took that 1,50,000 multiplied by 1 divided by 60? Because that is a constant number. That 2,500 will be reversed every month, but not fully. 2,500 multiplied by that month's exempt turnover divided by that month's total turnover for this month and the next 59 months. Clear? We'll stick to April calculation. In April, how much credit you got? In total, 2,50,000. How much you added to your output tax liability? 833. 833. This actually we have completed the moment we discuss the basics of rule 43. Now we are trying to understand something special. We'll move to next month. In the next month, May 2020, Tata Limited purchased few extra capital goods. Capital goods D, GST which is having 2 lakhs, it is used only for taxable supply. On capital goods D, will it take full 2 lakhs credit in a credit ledger? Yes. Yes. The fifth capital goods it purchased, capital goods E, GST on which is 2,50,000, which is used for both taxable supply and exempt supply. Common capital goods, will you get entire 2,50,000 credit? Yes, entire amount will hit your credit ledger. Entire amount will hit your, till now it is a normal question. Now comes the interesting part. Suddenly, you see your capital goods B, which was initially used only and only for your taxable supply. Now it is used for both taxable supply and exempt supply. It becomes common. It becomes common. Now, your capital goods B, whether you have already got the amount in your credit ledger? Yes. Will you get it again in your credit ledger? No. This 1 lakh, you will not get again in your credit ledger. You will get only 2 lakh and 2,50,000. This 1 lakh you have already got in the month of, but still you are calculating with that 1 lakh for a particular purpose. Now, What are the common capital goods as of now? What are the common capital goods? Common capital goods are capital goods C right from the beginning, capital goods E, and suddenly capital goods B. What is the credit on capital goods? C, B, and E. C was always used for common. E was always used for common. But B initially was used only for taxable supply. Now it is used for both taxable supply and exempt supply. So your capital goods, C, E, and B, total amount is 1,50,000, 1 lakh, and 2,50,000. It is totally 5 lakh. It is totally 5 lakh. Mind you, what amount you got in your credit ledger in this month? Only 2 lakh and 2,50,000. You did not get that 1 lakh again of capital goods B because you've already got in the month of April. So what amount has hit your credit ledger? 4,50,000. What amount has hit your credit ledger? The amount that has hit your credit ledger is only 4,50,000. Now, there are 3 common capital goods for which you have to do reversal. Now, what is the total of all the 3 capital goods GST amount? 1,50,000 plus 2 lakh plus 50 plus 1 lakh. It gives you 5 lakhs. You take that 5 lakhs. Multiplied by 1 divided by 60. What will be the figure? This is a constant number. Multiplied by exempt turnover divided by total turnover. What is the exempt turnover in the current month? 50 lakhs. What is the total taxable turnover in the current month? 3 crores. So exempt turnover is 50 lakhs divided by 350 lakhs. So what is 5 lakhs multiplied by 1 divided by 60 multiplied by 50 lakhs divided by 3 crores 50 lakhs. It will give you 1,190. This 1,190 you are going to add to output tax liability in May month. But please understand, reversal for capital goods E will be done for this month and the next 59 months. Whereas reversal for capital goods C and B will be done in this month and next 58, because 60 months will be different for each of the capital goods. 60 months will be different for each of the capital goods. Keep that in mind. For your exam purposes, it is not important because you will get a data only for that particular month. Clear? Now let us see the last part. We'll end with a very higher note where we'll make it more interesting, where we'll bring June month Tata Limited purchase the following capital goods. Capital goods F, GST 3 lakhs, used only for taxable supply. On that 3 lakhs, entire amount will go and hit your credit ledger. Another new capital goods G, the GST amount 3,50,000, used only for exempt. No need to worry. This entire 3,50,000 will never go and hit the credit ledger. Now there's a change happening. What is the change? Capital goods A, which was initially used only and only for exempt supply, you never got any credit on that, suddenly is used for both taxable supply and exempt supply. Capital goods A. Now this is different. In the previous month, there was capital goods B, which changed the nature from taxable supply to both taxable and exempt supply. That's the difference. For capital goods B, you already took the credit in the month of April, you did not take it again in the month of May. For capital goods A, you never took the credit in your credit ledger. For capital goods A, now you will take that amount of 50,000 entirely in your credit ledger. But there is some feeling wrong. Why? Because capital goods A for few months was used only for manufacturing exempt supply. You will take entire 50,000. Now, what is the amount which is hitting your credit ledger? 3 lakh and 50,000. 3 lakh, 50,000. That's the difference. For capital goods B, you did not take that in your credit ledger because credit was already taken. Capital goods A in this month, you are taking it now in the credit ledger because it was never taken. But when you take this entire 50,000, something should disturb you. For few months, it was only used for exempt supply. Now you have to make some output tax liability, addition to output tax liability. That 50,000 multiplied by 5% per quarter or part thereof. How many quarters it is used? Only one quarter. So multiplied by one quarter, that 2,500 should be added to your output tax liability. By the way, this is output tax liability is different from the output tax liability that we are going to calculate in the end. So this is your first output tax liability. This we are discussing for the very first time. Why? You got entire 50,000 in your credit ledger, which is not fully satisfactory. Because for some time this capital goods was used only and only for exempt supply. So you have to add that to your output tax liability. What is that? You go with that 5% per quarter. So 50,000 multiplied by 5% per quarter or part thereof. How many quarters this capital goods A was used only for exempt supply? Only one quarter. 2 months will be taken as one quarter. So you are going to add it to your output tax liability. This is the first output tax liability. It has got nothing to do with common credit. Now, how many common capital goods you have in totality in the month of June? You have capital goods C, which was right from the beginning used for taxable supply, exempt supply. Capital goods E, right from the beginning used for taxable supply, exempt supply. Capital goods B, initially used for taxable supply, later on used for taxable supply and exempt supply, it became common. Capital goods A, initially used only for exempt supply, later on used for both taxable supply and exempt supply. So how many common capital goods you have? A, B, C and E. And A, B, C and E is 50,000, 1 lakh, 1,50,000 and 2,50,000. So what is the common credit? Common credit. A, B, C and E, that is 1,50,000, 2,50,000, 1,50,000, that is 5,50,000. Number of common capital goods have increased. Initially it was C, then E, later on B, later on A. 4 common capital goods. 4 common capital goods. What is the total amount now? 5,50,000. So we are going to do a reversal. 5,50,000 multiplied by 1 divided by 60, which is a constant figure, multiplied by exempt turnover of the current month, 50 lakhs, divided by total turnover of the current month, 2.5 crores. 2.5 crores. So what will be the addition to output tax liability? 1,834, which is total common capital goods, which is 5,50,000 multiplied by 1 divided by 60 multiplied by 50 lakhs divided by 2 crore 50 lakhs. 2 crore 250 lakhs multiplied by 50 lakhs divided by 250 lakhs. Now this is the second reversal, which we technically call it as addition to output tax liability, second reversal. This month you have 2 addition to output tax liability. 2, not 1. Every month you will have only 1 addition to output tax liability. This month 2. Why? 1, because capital goods A initially, which was used only for exempt supply, now it is used for taxable and exempt. So you will take full credit. Then for the month, for the time it was used only for exempt supply, 5% per quarter, you will add it to output tax liability. That was only and only dealing with capital goods A. But this reversal deals with capital goods C plus E plus B plus A. So in this month, what is the total amount you got in your credit ledger? 3 lakh plus 50,000. What is the output tax liability that you are going to add? One with respect only to capital goods A, 2,500. One with respect to all the common capital goods, 1,834. 1,834. That is a summary of entire Rule 43. These special capital goods is one of the favorite area of ICI. That being the case, I have made sure that you understand this with numbers. Favorite area of ICI. Whenever they touch common credits, you will see a lot of questions. In exam itself, it has been asked twice or thrice. RTP and MTP, if you take, it has been asked multiple times. One of the favorite area of ICI to check to check your understanding with respect to 43. Right. So that is all about your rule 43. And the last part, which is very simple, which is only open for your banking sector, not even insurance sector. Normally, you'll talk about banks and insurance. This time you're only talking about banking sector. Banks, financial institution, non-banking financial companies. Why? Bank has got the main income, which is interest income, which is exempt. Other incomes, processing fees, documentation charges, etc. is taxable. Surely they'll have common credit. Insurance may or may not have. So this is only applicable for banking sector, not applicable for insurance sector. Normally banks and insurance will always come together, but here it is only for banking sector. Rule 38. Banks have an option to go for the complicated rule 42, 43 that we have discussed. Otherwise, go for a simple rule 38. Simple rule 38. But once they exercise this option of simple rule 38, they cannot withdraw during the balance part of the financial year. Now, how to remember banking sector? You're talking about your banking sector. Banking sector will be split into 3 B's. And by the way, rule itself is rule 38. 3 B's, rule 38. So if you write these 3 B's, you will get rule 38. Rule 38. What are the 3 B's that is relevant for your banking sector? Special case. Normal case is rule 42, 43. We are talking about a special case. Rule 38. 3 B's, you split that into blocked, branch to branch, that is distinct person, branch to branch, that is distinct person, and balance. Block category, branch to branch category, which is nothing but distinct person. A lot of times you will find that Mumbai branch of a bank is giving services to the local branch. So branch to branch, distinct person. Block category, you will not get any credit. No one gets a credit, not even banks in special cases. Branch to branch get 100% credit. Balance get 50% credit. Balance get 50% credit. And this is true not only for inputs and input services. This is true for input services as well as very simple calculation. If it is block, take that separately, no credit. If it is branch to branch, take that separately, full credit. So the sequence would be blocked, branch to branch, then find the balance credit. Take 50% of that. Take 50% of that. So that is a very simple calculation for your banking sector. 3 B's, rule 38, block 0, branch to branch 100, balance 50%. So that completes your entire understanding of your proportionate credit, basically in terms of rule 42, 43 normal scenario. For banking sector, either they can go for 42, 43 or they can go for a simplified rule 38. Now, talking about your ITC in case of job work. This provision is discussed in your section 19 read along with section 143 read along with rule 45 and rule 55. When you talk about your job worker, please understand that there is a principal involved who is giving the goods to job worker who is doing work on his behalf and returning it back. Now, the focus is on your principal who should be a registered person and the job worker who may be registered or who may not be registered. Now, normally what will happen? Principal will send the goods to job worker. Either principal will directly send the goods, that is inputs and capital goods to the job worker, or he will ask his supplier to bill to principal but ship to job worker. Bill to principal, billing to principal, shipping to job worker. So the goods will be received by job worker either directly from the principal or or through the principal supplier. Bill to principal, ship to job worker. Now understand that if it is a case where supplier of the principal has given directly to the job worker, who can take the credit? Principal or job worker? Only principal can avail the credit, not the job worker. Not the job worker. In ITC initial part we have discussed that receipt of goods by third person, which is job worker in this case, is equal to receipt of goods by yourself. So when principal has asked the supplier to give the goods to job worker has received the goods on behalf of the principal. Receipt of goods by job worker is equal to receipt of goods by principal. So it is only principal who will avail the credit, though the goods are directly going to job worker. So it is receipt of goods by job worker is equal to receipt of goods by principal. Only principal will take the credit, rather bill invoice will be there only with principal. Right. Now also understand that when the goods are going to the job worker, there won't be any payment of tax, which means the document which will be there is delivery challan, not invoice. Whether the goods are directly going from principal to job worker or supplier is sending the goods directly to the job worker, in both the cases principal has to raise the delivery challan. In both the cases principal has to raise the, just because supplier is directly sending the goods to the job worker does not mean that delivery challan will not be there. It will be there with delivery challan. Yes, the supplier of the principal will give invoice to the principal and ship it to the job worker. That is invoice of the supplier. Principal simultaneously will create a delivery challan. Delivery challan. And it should be with intimation to the officer. Please understand this intimation to the officer means filing your ITC 04. Filing your, who is required to file ITC 04? Principal, not the job worker. If your previous year aggregate turnover is up to 5 crores, yearly ITC 04. After the year is over, 25 days. 25 days. If your previous year aggregate turnover is more than 5 crores, 2 ITC 04. Half yearly ITC 04. April to September, 25th October. October to March, 25th April. Now also understand that the goods have gone to the job worker. Job worker may be registered, job worker may not be registered. Now what is the entire intention of filing your ITC 04? This is only to ensure that principal gets back the goods within, for inputs within 1 year plus 1 year, for capital goods within 3 years plus 2 years extension. This time limit is not applicable for special capital goods being molds, dies, jigs, fixtures and tools, because they cannot be identified. They cannot be identified. So you have to get back your inputs either in the same form or a different form within 1 year plus 1 year extension, capital goods within 3 years plus 2 years extension. If you don't get that back within this time, it is deemed that you have supplied the goods right from the day they were sent to the job worker directly or through supplier of the principal. It is deemed supply from that date, which means you will end up paying GST with interest. With interest. And that is the entire reason why you are going to file ITC 04. Whether you have received back the goods given to the job worker within 1 year plus 1 year or within 3 years plus 2 years. If you don't receive, it is deemed to be supplied. It is deemed to be supplied right from the date of dispatch by principal to job worker or dispatch by principal supply to the job worker. Right from that date, it will be deemed supply. You will end up paying tax with interest. You have to end up paying tax with interest. After that 1 year plus 1 year or 3 years plus 2 years, if the goods are returned back by the job worker, it will be treated as a separate supply. It will be treated as a separate supply. Now it will not be treated as a mere movement. It will be treated as a separate supply. Right. So this is the importance of receiving back the goods within time. And that is the reason why government wants you to file the details so that they can check whether you have received the goods within time. The reason for your ITC 04. ITC 04. Now also understand that when you talk about job work. And by the way, when you talk about this time limit of 1 year plus 1 year or 3 years plus 2 years, if the goods are direct, from where it will start? If the goods are sent by the principal, it will start from the date of dispatch by the principal. If the goods are directly received by the job worker from the supplier, the time limit will start from the receipt of goods by job worker. If the goods are sent by the principal, time limit will still start from dispatch from the date of removal of goods from principal place. If the goods are directly received by job worker through principal supplier, it is the date of receipt by job worker. It is date of removal by principal if it is principal to job worker. If it is principal's supplier to job worker, it is date of receipt of goods by job worker. From that date, you will start calculating 1 plus 1 year or 3 plus 2 years. Now, can job worker within themselves transfer the goods to another job worker? Yes. Job worker to another job worker, another job worker to another job worker. But that will not increase the time limit. If you are giving the goods to multiple job workers, you have to get it back right from the time when you have sent it initially and get it back from the final job worker within the time of 1 plus 1 or 3 plus 2 as the case may be. This will not increase your time limit. Now, when the movement is happening from one job worker to another job worker, what is the document? Either delivery challan by the job worker or delivery challan by the principal on behalf of job worker, or you are talking about endorsement of the old delivery challan. Endorsement of the old delivery challan will work out only if the entire consignment is sent by one job worker to another job worker. Otherwise, only you have to go by the first two options. What are the first two options? DC of the job worker or DC of the principal on behalf of the job worker. But when you talk about endorsement of the old DC, no new DC, old DC, that is possible only when the entire consignment is being moved from one job worker to another job worker or job worker back to principal. Now, the last part of this discussion. Now, can the goods directly be given by job worker to the customer? It is ulta. Supplier to job worker. Now, job worker to the customer or principal. So, direct supply or export from job worker premises is possible if either job worker is registered or job worker's place is added as additional place of business in the registration certificate of principal, or for the goods notified by the commissioner. See, forget about goods notified by the commissioner. Two cases. Either job worker is registered or job worker place is added as additional place of business. Direct receipt from supplier of the principal, no condition. Whether you are registered, unregistered, added as additional place of business, not added as additional place of business, directly you can receive from principal suppliers to your place. But if you are directly sending from job worker's place to customer, reverse, then either you should be registered or you should be added as additional place of business in the principal's registration certificate. Now, who is responsible for this entire movement? Accounting is entirely the responsibility of whom? And that is the reason he is going to file ITC 04. Now, waste and scrap that is generated need not be brought back. They are giving a relaxation because then normally you have to bring it back within 1 plus 1 year, 3 plus 2 years. But waste and scrap, they understand that need not be brought back. But they are very clear. You don't bring it back, but we want tax amount. Either job worker, if he is registered, he will pay the tax on waste and scrap when it is being supplied, or principal will pay tax if job worker is not paying tax. Waste and scrap which is generated out of the process done by the job worker, they need not be brought back. That 1 year plus 1 year, 3 years plus 2 years is not applicable. Need not bring it back. But tax amount should be paid. Whenever that waste and scrap is sold from the job worker's premises, tax should be paid. If the job worker is registered, let the job worker pay the tax. If not, let principal pay the tax. Let the principal pay the tax. So that is everything about your section 19, section 143 read along with rule 45 and rule 55. Now, the last concept in your ITC which deals with your ISD. Section 20 read along with section 21 read along with rule 39. 20, 21 and rule 39. Now, what is this entire concept of ISD? An assessee is having multiple registration and moreover is having common input services related to multiple registration of multiple states, where he will get the common input services credit and distribute to the branches. So who is an ISD? The definitions are always discussed in section 2. ISD is an office of supplier of goods or services which will get a tax invoice from the supplier of common input services, take the credit, and then give a tax invoice to the branches and distribute the credit to the branches. What is meant by branches? Recipient. Branches, technically they call it as recipient. Now what do we mean by the recipient? Recipient means the supplier of goods and services having the same PAN that of ISD, which technically means they are the branches. Technical name is ISD, roughly we can call it as head office. Technical name is recipient, roughly we can call it as branches. Now, understand, ISD work is only to take the credit, pass on the credit, take the credit, pass on the credit, take the credit, pass on the credit. So, ISD will take the credit, pass on the credit. It will never ever make any payment. So, there is no payment. There is no payment. It will only take the credit, it will give the invoice and it has to file a return called as GSTR 6 within 13th of the next month. And ISD is technically blind. It will give all the credits. Whether eligible credit or ineligible credit, it will distribute everything. It will distribute. Remember, ISD is blind. Your head office is blind. It will not see whether you are registered or not registered. The branch is registered or registered, it will not see. Whether the credit is eligible or ineligible, it will recognize and give it separately, but it will give it fully. It will give it fully. Now, the distribution of ITC by IST should be done in the same month. And the distribution should not be more than what is availed. Very normal point. And the distribution should not be more than what is availed. And if at all there is an excess distribution, that will be recovered from the branch office with interest. See, IST has to give credit to two branch offices. Say in the ratio of, how to find out the ratio we will discuss. Say in the ratio of 3:2. It has given equally in the ratio of 1:1. So one branch has got extra and one branch has got less. That branch which has got extra, government will recover the excess credit with interest. Don't worry, ISD will also have a residuary penalty. For giving wrong credit, ISD will also have a residuary. But that branch which has got lesser, provision is silent. Obviously, you can give back that short credit back to the branch which has received less, but provision is silent. Now, understand that ISD will take the credit, pass on the credit, take the credit, pass on the credit. Technically, it will not pay any taxes. It is not in a position to pay any taxes. What if there is a common input service which attracts RCM? Which attracts RCM. What will happen in that case? In that case, ISD cannot accept an invoice which attracts RCM. Why? ISD cannot pay any tax. What will happen? One of the branch office has to come forward, take that common input services, pay RCM, take RCM credit, which is a normal thing, pass on the RCM credit to the ISD, then ISD will distribute to the branches. What are the steps? One branch office will come, it will pay the RCM, take the credit, reverse the credit and transfer it to ISD. It will take the credit, then reverse it fully and transfer it to ISD. Then ISD will distribute it. So normally we think that ISD will give the credit to branches. At times branch may pass on the credit to ISD. It is not only in this case. Say for example, one common input service, instead of ISC getting the credit, a branch has got the credit wrongly. What branch has to do? Give it fully to ISD, reverse it fully and give it to ISD. ISD will then distribute. Can a company have multiple ISD? Yes. It can have multiple ISD for northern part of India, southern part of India, eastern part of India, western part of India. It can have multiple ISD if it decides to go. Now, this is all the theoretical portion. Now let us focus on the practical portion. The questions that have been asked by ICA a number of times when you talk about calculation portion. How to distribute the credit. How to distribute the credit. Now I said, remember two important things. ISD will not see whether it is eligible or ineligible. It will give the credit. It will give the credit. It will bifurcate into eligible and ineligible, but it will give the credit. It is blind. Second, ISD will not see whether you are registered or not registered. Even if you are not registered, it will give you the credit. It will give you the credit. Now, how that distribution will happen? If at all you are talking about tax distribution, ISD is in one state, one branch is in same state. So, if at all the tax is C plus S, distribution will also be C plus S. If the tax is I, distribution will also be I. If the ISD and the branch are in the same state, color will remain the same. If the credit is C plus S, distribution will be C plus S. If the credit is I, distribution will be I. But if ISD is in one state, say for example Delhi, and the recipient is in other state, say for example say Maharashtra or Telangana or Tamil Nadu, then whether it is C or S or I, it will always go in the color of IGST, because it is going from one state to another state. If ISD and a branch, supposing there are three branches, ISD is in Delhi, one branch is in Delhi, other two branches are in Maharashtra and Telangana. So to that branch in Delhi, C, S and I will go in the same color, C, S and I. But to the other branches in Maharashtra and Telangana, whether it is C, S or I, it will always go in the color of I. It will always go in the color of I. So that is all about the distribution of the type of tax that you have to remember for calculation purposes. Second, how distribution will be done? If the credit is pertaining to one branch, that will go only to that branch. If credit is pertaining to multiple branches but not all the branches, it will go only to those branches. If credit is pertaining to all the branches, that is all the recipients, it will go to all the recipients on pro rata basis. If it is pertaining to a particular branch, it will go only to that branch. 2-3 branches, it will go only to those branches on pro rata basis. All the branches, all the recipients, it will go to all the recipients. Logical mathematical calculation. Now, the question is how to calculate that pro rata. How to calculate that pro rata. Rather, by the way, we have discussed this point. ISC is blind. ISC will give a credit to a recipient even if the recipient is engaged in exempt supply or even if that is unregistered. Even if that credit is ineligible, it will give the credit. Whether the credit is ineligible, whether the branch is registered or not registered, it will give the credit. It will give the credit. Very important for your calculation part. Don't think that, okay, it is ineligible credit, we'll block it here itself. No. ISD will not do this all work. It will give it to the recipient. The recipient will decide whether to take the credit or not to take the credit. ISD is blind. Remember this. ISD is, it will give eligible as well as not eligible credit. It will give to a person who's registered, branch which is registered, also to a branch which is not. Obviously, the branch which is not registered cannot take the credit as a different part, but it will give. It will give. Now, what is that pro rata basis? What is that pro rata basis? When it is dealing with multiple branches or all branches, it will be given on pro rata basis. Pro rata basis. Assume that the credit involved is, assume that the branches are branch office 1, branch office 2, branch office 3. And the previous year turnover, state turnover of that branch is say 5 crore, 10 crore and 15 crore. Branch office 3 is not registered because it is dealing only with exempt supply. It is dealing only with exempt supply. In the current year, for a particular month, say April month, there is distribution of ISD credit, say amounting to 1 lakh. 1 lakh. It relates to all the branches. It relates to all the branches. How you will distribute the credit? For April month distribution, 1 lakh multiplied by 5 divided by 30, 1 lakh multiplied by 10 divided by 30, 1 lakh multiplied by 15 divided by 30. If I tell that no, this was dealing only with branch office 1 and branch office 2. 1 lakh multiplied by 5 divided by 15, 1 lakh multiplied by 10 divided by 50. Pro rata. So the pro rata basis, it is based on previous year turnover. Previous year state turnover. Calculation means always state turnover. Calculation means always state turnover. It is based on previous year state turnover. Will it give even to branch office 3? Yes. It will not see whether you are registered or not. It will give. The branch has to decide what it has to do with that credit. If the branch office 1 is in the same state, if it is C plus S, it will be given in form of C plus S. If it is I, it will be given in form of I. If branch office 2 and 3 are in different state, whether it is C or S or I, it will be given always in the color of I. So we are trying to incorporate all the points that we have discussed. Are you clear with this understanding? So this pro rata basis is based on your previous year state turnover. What if you don't have previous year state turnover? You don't have previous year state turnover. When that will be that? When there is a new branch. When it is first year of business or when there is a new branch. If at all in the previous year there is branch office 1, branch office 2, branch office 3. In the current year you have only branch office 1 and branch office 2. Situation number 1. Previous year, current year. Or in the previous year you have branch office 1, branch office 2. Current year you have branch office 1, branch office 2, branch office 3. What is the difference? In the first case, your pro rata basis, you will still go with previous year state turnover because distribution this year is only to branch office 1 and branch office 2, for which you have turnover in previous year. For which you have turnover in. But in the second example, if at all a service deals only with branch office 2 and branch office 1 and branch office 2, still you will go with previous year state turnover. But if at all a particular category deals with branch office 1, branch office 2, branch office 3, then you cannot go with previous year state turnover because for branch office 3 you don't have any turnover in. Then you will go with last quarter's state turnover. Last quarter. Turnover in the last quarter of the current year. Turnover in the last quarter in the current year. If you are standing in the month of April, you cannot do anything. Month of May, you cannot do anything because you neither have previous year nor have current last quarter. June, not do anything. In July, you have last quarter. You have last quarter, April to June. Now in July, you will distribute the credit of April, May, June and July. August, you will distribute only August credit. Last quarter is April to June. September, only distribute the credit of September. Last quarter is April to June. October, only distribute October month credit. Last quarter, July to September. So on you'll go. When you go to March, only distribute the credit of March based on last quarter. October to December. April, which means the next year, now you are not going to go with last quarter because now you have all the 3 branches turnover in your previous year. That you have to understand. So normally the basis previous year state turnover. At times where it is not workable, go with last quarter's state turnover. Last quarter's state turnover. So in the second example, I never said I will always go with last quarter state turnover. If a particular common input service deals only with branch office 1 and branch office 2, I will still go with Previous year straight turnover because it is available. Only if it deals with branch office 1, branch office 2 and branch office 3. Where I cannot go with previous year straight turnover. I will go with last quarter straight turnover. So that you need to remember. The last small part. Surprisingly, ICI generally has the habit of not asking very tricky questions. But in the last small part, it did ask a very tricky question. When you're talking about, see, if at all a supplier has given invoice to ISC, ISC will give invoice to branch office. If supplier gives credit note to ISD, ISD will give credit note to branch office. If supplier gives debit note to ISC, ISC will give debit note to branch offices. Now, what is the problem? Supposing supplier has given invoice to ISD in the month of April 2023. It has given credit note to ISD in the month of May 2024. It has given debit note to ISD in the month of July 2024. Now, when ISD will distribute the credit of this invoice on pro rata basis, it will go with, normally it will go with which turnover? Supposing it is distributing to 2-3 branches, it will go with previous year state turnover. What is that previous year? Financial year 22-23. If ISD is getting a credit note, it will give credit note to its branches. It will reverse the credit. It will ask the branches to reverse the credit on pro rata basis to all the branches based on which year's turnover? Based on original ratio, which means it will still go with the ratio of financial year 22-23. Though you are standing in the year 24-25, for you the previous year will not be 23-24, it will be still old ratio. What was the ratio for invoice? 22-23. What is the ratio for credit note? Same 22-23. In spite of the fact that invoice was in financial year 23-24 and credit note is in 24-25, you ignore it. You go with the old ratio. That of invoice. But when it is debit note, ISC will get the credit and give the debit note to the recipients on pro rata basis based on previous year turnover. This time it will go with financial year. This debit note is given in 24-25. What is the previous year? 23-24. It will now go with a new ratio. It will not see the invoice ratio. It will have its own ratio. It will not see the invoice ratio. It will have its, see, branch officers will have ratio turnover differently in different years. Assume that there are only 2 branches. The old ratio, the old turnover was 5 crore is to 10 crores. So invoice distribution in financial year 22-23, the ratio was 5 crores to 10 crores. You will distribute it into the ratio 5:10, both for invoice as well as for the credit note. Though these 2 documents are there in 2 separate years, but with respect to debit note, which is there in financial year 24-25, the previous year of which is 23-24, the turnover in 23-24 of 2 branches can be 7 crore is to 9 crores. Now it will distribute the credit in the ratio of 7:9. For invoice, the original ratio, I am not calling it as old ratio or new ratio because it is the original ratio. For credit note, old ratio, and for debit note, you will go with the new ratio, its own ratio, new ratio. So that has been incorporated by ICI is one of the question to see your ratio and distribute the credit. Are you guys clear with this understanding? That is all and all about your ITC and ISD, Input Service Distributor.